Welcome to part 1 of the Precision Indicator course. In this part, we'll be focusing on simple moving average number 2. So we're going to go ahead and get that put on our chart here. Also, too, you may notice we'll be focusing in on the SPY ETF, and that's what we'll use for a baseline with all of our indicators. So that way we'll have a nice, clear, concise foundation between all the indicators to base them all off of. Of course, does this work with other ticker symbols, other company? Of course, but we want to keep it nice and clear on the same page. So again, moving average number 2, and you may wonder, okay, why moving average number 2? What really is that going? What value is that going to add? Well, there's a lot to be seen in a 2 moving average than most realize. I also too like to use it for purposes other than the indicator that it gives me, but also too because it's a nice line that I can use that runs through my other moving averages. So it's just a nice candlestick average, and yeah, it just provides some clear and concise cross patterns through other moving averages. But just to give you some other pointers on the 2 moving average, let's zoom in here. We're at the stock drop of 2020. So we're going to zoom in here. We're on the daily. So each candlestick represents 1 day of trading. Okay. So things to look for with the 2 moving average. Which side is the candle riding on? Is it riding more towards the bottom to middle? Or is it riding towards the top or middle? All right. So when you're in a downtrend, your candles will tend to ride on the bottom to middle of the 2 moving average. And then when you get a hard trend change, what do you get here? You get a nice V. Nice V or a nice mountain top in the 2 moving average. Also too, you can look for candles that are out alone by themselves. When you have a candle that's outside of the moving average, the majority, 80 to 100% of the candle or the wick is outside of the 2 moving average, that's also a strong sign of some trend change. All right, and of course we see that right here. So we're coming down, we have the V and a candle outside of the 2 moving average. All right, as we go down here, we're in a downtrend. All right, in a downtrend, as we see as we're going down here. We had some crazy volatility back and forth on this particular time frame. Yeah, very tough. But as we can see, once we got down to the bottom of this epic fall in March 2010, we had a nice V. Nice V in the 2 moving average. And again, as it started riding, building back up, the candlestick started riding on top, middle to top of the 2 moving average. Again, when we got a trend change, what we have instead of riding on the top to the middle, they'll start riding to the bottom. That's a sign that, hey, could be time for a trend change, and in this case, sure enough, peaked here and then came on down. Okay, but as we can see here, we have another candlestick that's all by itself, which indicates, okay, the stock is probably wanting to start to go back up. And sure enough, what do we have here? From this point, it starts going back up. The candles start riding on top of the 2 moving average. And then we start looking for candles that start riding, that jump to the bottom of the moving average. And sure enough, our first sign was right here. Jump from top to bottom, a lot of sideways movements. So again, we're looking for hard V's or candles that are out alone by themselves on top or on bottom. Here we see we have one that's on top. And then, of course, it was followed by a downtrend. Then we have one that's out pretty much by itself here on the bottom. And then, of course, change directions, head back up. Candles are riding on top of it, top. And then we get a pretty nice V right here, indicating that we're changing direction. And it came on down, candles on the bottom of the moving average. candle pretty much out by itself, and then change of direction. So that's just some simple ways to use the 2 moving average. Again, are we ever going to use it by ourselves? Of course not. But again, its synergistic value is pretty nice. And we see other instances in history where we got a nice V. Every time you see that hard V, you're getting some, or really steep mountaintop or valley, you're getting some major change in direction there. So that's the 2 moving average. Hope you got a little bit of value out of that. We'll move it to the daily, see if it, or the intraday, see if it holds true. We'll go with the 5 minutes used by the most amount of people. And what do we got here? Again, looking for our hard V's. As you can see, wherever you see that really hard V, you definitely get some change in direction. Now, what about as far as where the candlesticks are riding? Again, we had a downtrend here, candlesticks riding on the top, middle to top, and then what do we get down here? Hard V. Candles will start riding more towards the middle to the lower half until you get another change of direction. So, yep, so things to look for again on the 2 moving average, hard V's and candlesticks that are outside, that are not even touching the 2 moving average. Those are always a good sign that you're getting some trend change. Okay, so that's 5 minutes, 10 minute. What do we have here? Again, same thing, looking for hard V's, looking for candlesticks outside of the pattern. We've got a prime example one right here, candle all by itself, not touching or barely touching the moving average, and then it was preceded by a drop. So if it's left all up by itself on top of the moving average, trend down, or if you see a candle that's all by itself below the 2 moving average, it's more than likely time for an uptrend. So hope that helps you with the 2 moving average. Like I said, it's not a standalone indicator by any means, but at the same time, it does offer a little bit of value that can be used along with other indicators. So I hope you enjoyed that. We'll be starting our next indicator, which will be the 6 simple moving average. So look forward to seeing you in that video. Welcome back to the Precision Indicator course. In this part, we'll be going over simple moving average number 6. In our last part, we went over simple moving average number 2. And now let's see what benefit we can get from moving average number 6. I think this is one of the most underutilized moving averages out there. And it's such a beneficial moving average because in instances where you get hard drops or quick jumps in the stock, the 6 is such a guiding moving average. Your other averages, big moving averages, 50, 100, 152, they do you no good when you get quick and fast drops or run-ups. All right, so we're at the stock drop of, major drop of 2020. Let's see what we get out of the 6-day moving average. Now, the basics of the 6-day moving average, very simple. If it's below the 6-day moving average, you're bearish. If it's above, you're bullish. Simple as that. So if it's below the 6-day moving average, you think the stock is going to continue to go down. Once it breaks above that 6-day moving average, then you become bullish, ready for the stock to go back up. Okay, so what happens here at the stock crash? So the 6-day moving average, And again, just a reminder, focus on my big crosshairs that run through the page, not my little crosshairs that are a little off in the recordings for some reason. Don't know why, but just a reminder. So let's see here. So the 6-day moving average right here on the daily chart. Of course, we're using SPY as usual for the baseline. Now, ideally, we're looking for candles that form below the 6-day moving average, either mostly or fully formed below or above the moving average. And that's what we get right here. We get a candle that is, in this case, is completely formed. We're not really worried about the wicks, more the body of the candle. That's what we're focusing on. So we got a full body candle here underneath the 6-day moving average. So at that point, that's a very good entry point as far as puts. You want to, or entering a short position. Or if you're in a long position or a call position, that would be a very good sign to get out. So let's just say you got in here on a short position at $334. Well, let's see here. You just stayed in. Again, you're riding below the 6-day moving average. Well, our first candle that breaks above that, either fully or mostly, I'd say probably about 90% of the candle, was right here, 307. So that would have been an exit. Of course, the full day of the candle was from 302 all the way up to 312. Ideally, once I seen that it was fully on top of this 6 moving average, I would have been out. So right around 306. So 335 to 306. I'd say that is a great take-home profit there. All right. So again, you would have been out there. At this point, you're bullish. Well, what happens the next day? Well, it falls right back down. It sits right on the 6-day moving average. Well, at this point, it's a wait and see. All right, wait and see. Well, the next day, what happens? You proceed to fall below the 6-day moving average, fully under the 6-day moving average. Well, at that point, let's say you got in 296 or 297 entry there, and then, well, you're going to stay in the trade until you have another fully formed candle or mostly formed candle above the 6-day moving average. Well, you don't get that. You don't get that until, well, 242. 242, you get a mostly, I'd say this one's about 80% formed above the 6-day moving average. Well, let's just say you were being super conservative. Well, let's say you went with 244. Got a completely formed candle above the 6-day moving average. So from there, yeah, 297 to well, actually it started the day at 239. So that's I would say that's a pretty monster drop there that you could have 60 points. 60 points just off 60 point drop, and the profit on that would have been, yes, would have been quite large. And again, just from using the 6-day moving average. All right, so very simple here. Very basic again. If you're above the 6-day move, so again, let's just say you got in right here, or you got out of your short position here at 239, and you got into a long position. Well, you could have stayed with that long position until, let's see, it peaked all the way up here at 261. 261 it peaked and started coming down, and then, and again, just a reminder, it's always good to have multiple contracts, because when you get a big jump like this, like I said, you go from 239 all the way up to 260. Yeah, when it starts getting close to the 6 moving average, I mean, you gotta reasonably start looking at taking some profit. So let's just say you took some profit here, took some profit at 260. I mean, you got a 40 or a 20 point move right there. That's a nice gain there. And let's just say You waited till you went below the 6-day moving average. Well, it broke below at 253. You got a wick right here that broke below, or the candle itself. The candle itself broke below at 252. So that would have been for sure your exit point once the stock got there. And of course, it finished the day down at 246. All right, another instance. All right, where it jumps above. So we were below here, below, and then bam, we get a jump above. At 256, we were above the 6-day moving average. Full start of the candle, fully formed candle here. So 256, and you're in the stock until, well, again, why multiple contracts? Buying multiple contracts is always beneficial, because for me, you go all the way from 257, 256, all the way up to, you get a candle sitting right on the 6-day moving at 277, so it's right around a $20 move. I got to take some profits there. Yes, has it gone below it yet? No, but boy, that's just too hard not to take profit on a $20 move. But let's just say you stayed with it. So you sold one contract there. The next day it goes up a couple more dollars, and then bam, shoots all the way up to 286. So it's around a $30 move from our entry above the 6 moving average. Sorry guys, but I got to take some profit there too. $30. You got to be expecting to pull back at some point. Next day it comes and sets on the 2-day moving or 6-day moving average. Yeah, at this point you got to be taking some profits at this point. And sure enough, the day after that, it breaks down to 273. Granted, still a ton of profit in your pocket, even if you'd got out at that point. Okay, at this point, you're bearish on the stock. Next day, what happens? Comes up here, sets on the candle, comes and sits right on the 2 and the 6-day moving average, and then the next day you get a candle sitting on the 2-day moving average or the 6-day moving average. That's a nice entry point, 283, and you could have stayed in this. Oh, it goes all the way up to 295, right around 295. Again, you got to realize the stock has run a long way from the bottom. You can't be expecting to get $20 and $30 moves. So a $10 move, hey, that's a good spot to take some profits. Plus, too, you're at that point, yeah, you start the next day, you start coming down, yeah, and then the day after that, you break below the 6-day moving average. So you'd have surely been out by then. So again, the 6-day moving average is an excellent moving average, very well respected. As you can see here, this was before the crash. Look how much the candles respect the 6-day moving average. Look there, the wick sits on, wick hits it, candle hits it, wick, candle. I mean, it's never going to get too far away from the 6-day moving average. So excellent indicator. So let's move to an intraday time frame so we can make sure that this works the same on intradays, dailies, which I'll go ahead and tell you now it does. So let's go to a 5-minute time frame, one of the more common used time frames. Let's see here, our first full day we got here. The market opened right here at 9:30, and it opened right at the 6-day moving average. So we're looking for our mostly formed candle below the 6-day moving average right here. I tend not to worry too much about the first candles, the first couple candles of the day. Those can be crazy, as you know, right at the open. Right here, third candle of the day, 15 minutes in, you get a candle that's, say, about 90% of the candle itself is below the 6-day moving average, and then this one is completely below. So let's just say you enter here, 313, and you're in until you get a fully formed candle or mostly formed candle above. Right there, 313, you get one. So if that had been, you got it kicked out right there, that's totally understandable. But let's say you wait till you get to your next entry point. Bam, here you go. right at about 100% of this candle's form below. And so you're in here at around 313. So you're in, waiting for a fully formed candle. Above, right here, this one's mostly about 90% out there. Okay, understandable. Next point of entry, right here, 312. Well, you're in at 312. And where's your next fully formed candle, or mostly formed candle above the 6-day moving average? Right there. All the way at 309. So you got in at 312, out at 309. $3 move on the SPY intraday. Great profit. Yep, we'll take that every day. So just gonna scroll to some random days. I'll just, wherever it stops, I'll zoom in from there. That way you can see that I'm not picking and choosing here. Unfortunately, that I've seen that before. People have these special indicators they use, and yeah, you can always find a certain day and time that makes any indicator look like it works. So the start of our day, right here. Okay, so start of the day right here, well above the 6-day moving average is our first candle. So we're very cautious there. We want to wait till it gets to the 6-day moving average and see what it's going to do. Well, our first one here, right in the middle. This one, yeah, this one is mostly below it, and the next one's mostly above it. Yeah, this is a lot of back and forth sideways stuff. Yeah, this would have been hard to play right here. Plus two, you got your 2 moving average. Yeah, they're running very, very tight together. That's another thing to look for. Whenever the 2 MA and the 6 are really tight together, running into each other, that indicates a lot of sideways movement. A lot of sideways. Now, where do we get a nice separation between the 6-day moving average and the 2? Right here. Bam, we get a nice separation. See your 2-day moving average here, and then your 6 is all the way up here. Man, this would have been a great entry right here. Candle. So let's say you entered around 314. Was this 314 to 38 or 315? Let's see. Looking for your next fully formed candle above, and you don't get one for the rest of the day. So 315-ish all the way down to 314. So nice one there. Again, we're on the SPY. Now, this works on any stock. And of course, other stocks you can get bigger moves, but like I said, if we can make indicators work on the 2 or the SPY, which is for all intents and purposes doesn't move crazy for the most part in a normal time period, then yeah, it's usually a pretty good indicator. All right, so we got another day here, start of the day here. Yeah, the first candle of the day, pretty much fully formed underneath, stays underneath till right here. Then we get a fully formed candle on the top. So they entered there, 314.67, and say you wrote it up all the way to 315. Hopefully maybe took some profits there, and then bam, you get a mostly formed candle below. Downtrend, let's say you got in around 314 and rode it all the way down again. Got a nice gap between the 2 moving average and the 6 moving average. Nice channel for the candlesticks to run through. So say you got in around 314. It ran all the way down to 309. Now hopefully you took some profit in there. Can't get greedy. You can't get greedy. You get a nice $2, $3 drop. You gotta start looking for to take some profit. Anyway, in there we get a nice V in the 2-day moving average. Good sign that we are changing directions. And then right here at 311 is our first candle above the 6-day moving average. So So yep, that's what you want to look for. Fully, mostly formed candles riding on the top or the bottom, and some separation between the 2-day moving average. Nice to look for. Here's another day. See the 2-day. The 2-day and the 6 are really tight together here. Don't really like that. See, would they really start breaking apart here? Getting some distance between them. Really right in here. Yeah, that's when we that'd have been a nice entry point right there. Again, we got some space between the 2 and the 6. Fully formed candle underneath the 6. 6-day moving average 307. And let's say you're waiting for another candle to be fully or mostly formed above that point. Well, say you got in here at 307, you dropped all the way to 301. Don't get greedy, guys. You had to take some profit with that kind of monster drop. So, but let's say you didn't. Wait to the first fully formed candle above 302. That's still a nice little profit there. 307 to worst case scenario 302. Yeah, I'll take that $5 worth of profit there. And again, from here, let's say you entered here for a call or long position. 302, waiting, stay in it until you get a candle that is fully or mostly formed below. Get one right here. Yeah, again, you run up $3. Yeah, and you start getting really close to that fully formed or mostly formed. Yeah, that's totally understandable to take some profit at that point, and you would have been rewarded for it. Yeah, very, very much rewarded for it. So, again, the rest of this day, you see that for the most part, the candles stay underneath the let's say you're ultra conservative and went right here, fully formed candle underneath the 6, 302.64, stayed in it. Yep, stayed in it all the way until right around 295, 300. So, yep, nice profit there, $2 to $3. So, as anybody that trades the SPY on a regular basis, they'll take $2 to $3. They'll take a $2 to $3 move, yeah, any day, anytime. So I hope that helps. Holds the same for the 5 minutes, 3 minutes, all your time frames. So again, just yep, definitely encourage you to add the 6-day moving average to your moving average list. Yeah, it's a very very powerful indicator, and it'll definitely help you make some money for sure. And used in unison with our other indicators, you'll see that its value only gets even more valuable when used with the other indicators that we're going to be discussing as we go along. So anyway, I hope you enjoyed this part on the Precision Indicator course. Indicator number 2, which is the simple moving average number 6. Our next indicator that we will be discussing will be the simple moving average number 13. Look forward to seeing you there. Welcome to part 3 of the Precision Indicator course. In part 1, we considered the 2 simple moving average. Part 2, we considered the 6 moving average. And in part 3, we'll be considering the 13 simple moving average. Go ahead and get that put up on our chart. And let's go with, I'm going to go with green. All right, now first things first. Remember the general rule of thumb with a moving average is to look which side are the candles writing on. Are your candles or your line, whatever it is, writing on the top or are they on the bottom of the moving average? So we'll go back up here as usual. We're using the S&P or the SPY ETF. And let's see how the 13 moving average reacts with different candles. Now, as you'll see, when we had the big stock crash of 2020, we were under the 13 moving average. Now, we didn't get above the 13 moving average until we pulled out of that hole that we dug. Now, what's nice is, keep in mind, as the moving averages get bigger, they don't move as drastically, especially on a daily time frame or your bigger time frames. That's why the 6 moving average and the 2 moving average are very, very valuable, because when you get big, sharp drops or run-ups, yes, the 6 and the 2 are very, very, very valuable. So, as you can see here, we went under the 13 moving average right here. Oh yeah, and just a reminder, focus on my big crosshairs, not the small crosshairs. We went under the 13 moving average and used it as overhead resistance. Again, remember, resistance is the ceiling and support is the floor. So you can think of the floor in your house as the support, but at the same time, if you jump up and hit the roof, you'll see what resistance is. So anyway, so at this point it was acting as resistance, the 13, and then it was preceded by an epic fall. And then we see here, when the stock gets back on top of the 13 moving average, well, look how much it respects. That's, and all the back testing of all these moving averages, that's what was done. Went back through history to find out which moving averages are most respected by the stock and the way it moves. Now we can see here, when the candle or the market gets back on top of the 13 moving average, look how much it respects it. Comes down and hits it here, comes down and hits it here as a floor or resistance or support. So support, 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 wick down to it, support, and then support, 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 overhead resistance, support, 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 resistance, resistance. So again, the 13 moving average is very much respected, very much respected. And again, a simple little strategy here is, when it's above the 13, we're buying. When it's below, we're looking to sell. Okay, simple as that. All right, so we're going to take it down to a smaller time frame, an intraday time frame, and we're going to look at a 5 minute. Now, I'm just going to scroll, just random scrolls until so that way that you don't get the feeling that this is some planned out. Because again, I've seen it many times where, unfortunately, they had this certain indicator and they use certain time frames, and yeah, ideally, if the indicators work, they'll work on any time frame and they'll work on any stock. So, all right, so let's zoom in on this day. what day is this? 6/17. All right. So the start of the day was right here. And let's see. So the stock market opens, and what do you know? First candle of the day hits the 6 as overhead resistance, stays below that, and then it hits off the 13 right here, pushes back, hits off here, runs through a little bit here, and then finally breaks through the 13 moving average right here. So let's just say that you were just doing a below the 13 entry and above the 13 exit. Well, you'd have got in here. Oh, let's say worst case scenario, you'd have got in here right here at 313, and you'd have stayed in until 312. So you had right about a dollar drop right there. Another technique you could do is when you're below the 13 entry, and then when you have a full candle break above the 6, use that as your exit. If you'd have done that, you'd have had an even more precise exit. And then we see the rest of the day. What happens? Well, you got your 6 and your 2 moving average crossing each other. Not always a good idea to avoid that when you see that the 2 and the 6 are close or crossing through each other. It's a wait and see kind of approach. So a lot of cross through right here. When you get your moving averages all jumbled up in one area, it's always a good rule of thumb to just wait. Wait. But as far as our 13, you see we had some chop here. And at this point right here in the day, you see that 13 becomes strong support. You start getting support here, went all the way down, came all the way back up. And then here again, supported on it. And then again, support. So you get 3 support candles riding up the 13. That's a pretty good sign that, yeah, a long position or a call position is not a bad idea. So you had 1, 2, 3 candles. So let's just say you entered here, 312, or right at just under 313. And again, you were waiting until you had a fully formed candle under the 6 moving average, or a cross back through the 13, and that happened right here. So dollar moved there. If you have multiple contracts, you did very, very well on that. So the rest of the day, what happens? You get some crossing of your moving averages right here. Yeah, they're all jumbled up together. Better to wait this out until you get some clear, definitive direction. And then what happens? The 13 becomes the ceiling. It becomes overhead resistance. Resistance there, and it resists there. And let's say you got in at around 1350. And what do you know? You're waiting for a fully formed candle above the 13 or the 6 moving average. And you never get it the rest of the day. So again, easy little strategy using the 13 and the 6. Again, once it finds support or resistance on the 13, you enter, and then you exit when you get a fully formed candle above or below. So, easy little strategy there with the 13 moving average. Again, we'll scroll here. Wherever it stops, we'll look. Okay, so we stopped here. What do we got here? So, start of the day at 9:30 right here. Wouldn't you know, it starts the stock, finds support right here on the 13. Support. All right, but again, your moving averages are all real tight right here, crossing through each other. 2 and the 6 are crossing. I don't like that. I steer clear of that. That, to me, that's sideways movements. Now, what happens here? You get separation, nice separation between the 2 moving average and the 6 moving average, and then the 13 becomes overhead support. That's what we're looking for. All right, so let's say you entered here. All right, because again, 6 is acting as overhead resistance, and 13 is acting as overhead resistance. Strong indication that we're heading down. So let's say you entered here at around 307.50, and again, you're waiting until a candle breaks above, fully formed or mostly formed above the 6 moving average. Well, right here, this one is mostly formed about 60-70%. Or this one's completely formed above. See, it pierced through and then came back. As soon as it comes back through there, yeah, that would have been a good exit point. So 302. So we dropped from around this point right here, 307.50. Oh, and then say we got out here, worst case scenario, when it started using the 6 as support at 302. So yeah, $5 move. That's very, very nice. And then it proceeded to go up here. We see the 6 became support. We crossed through the 13. Now the 13 becomes support. All right, that's a good entry point right there. Again, the 2 and the 6 are nice and far apart. 13 has become support. So you enter there, 303, and then you're waiting for it to cross back through, mostly or fully through the 6, right here around 305. So yeah, nice little $2 move there. So just a little simple strategy using the 13 and the 6. Again, here we go again. We have a fully formed candle underneath the 6, and using the 13 as support right here. This little doji candle. That'd have been a good entry point for me. Right around 304.30. And again, we're going to stay under it. We're going to stay in it until we get a fully formed candle above the 6. Well, we'll get one there. Now, and this is one of those situations where it's up to you. Breaks above the 6, or if you want to be a little bit more risky, you see what it does in relation to the 13 since it's right there. For me, I'd kind of want to see what it does with the 13. And sure enough, what does it do? It finds overhead resistance on the 13 and continues down. And it goes down, again, using the 6 as resistance, overhead resistance. Yeah, it wicks through, but we're mainly focusing on the candle. All the way down. And we don't get start getting a fully formed candle above until 299. So, yeah, $3-4 move right there. So very, very, very nice. So that is the 13 moving average. Again, hope you're starting to see the benefit of using these moving averages synergistically, how much value you can have when you use them together. I don't use any moving average standalone. They're always use them together. That's where you get the most value. Anybody that says that there's a holy grail of one particular moving average or a particular indicator, well, more than likely he's just trying to sell you something. So, all right, I hope you enjoyed this part on the 13 moving average. Our next precision indicator will be the 21 moving average. Look forward to seeing you in our next video. Welcome to part 4 of the precision indicator course. In this part, we'll be focusing on simple moving average number 21. We'll go ahead and get that put up on our chart here. And I personally like purple for the 21. Of course, you can pick whatever color you want. Now, just as a review, in the last video we went over the 13 moving average and how we can use an easy strategy technique between the 6 and the 13, using the 13 once it finds the candle finds support or resistance above, using that. Again, here on the S&P 500, we found support or resistance, overhead resistance on the 13 right here and the 6. And then remember the strategy was enter there and then use the 6. Wait till we have a fully formed or mostly formed candle above the 6 moving average for an exit point. So here there was overhead support with the 13 and the 6. So let's say hypothetically we got in here, and again, waiting for a fully formed candle above the 6 or the 13, depending on your preference. Had one right here. Again, that would have been a nice, very nice 25-point drop. And again, we go back beneath, and again, waiting for a fully formed or mostly formed candle right there or there. Or again, if you're using the other technique where once you go below or have support or resistance on the 13, you can wait for the 13 to exit. So enter using the 13 at support or resistance, and then exit. So in this case, it would have been resistance, overhead resistance on the 13 here. We would have entered here, and then would not have exited until right here, until we found another candle at support. So now the 21 moving average. Again, all these moving averages were back tested through history to find out, well, which moving averages were most respected. Not because, the general public says, oh yeah, use this moving average, this one, this one, this one. No, I wanted to find moving averages that were historically respected. And what I mean by respect is when the stock gets to it, very often it uses it as support or resistance. Now, the 13, or the 21 rather, let's see how well respected it is. Of course, in a drop, when you have a major drop or a major run up, the 21 isn't going to do you much good. But once the stock comes back to earth, then let's see what we got here. So 21 was used as overhead resistance here. Pierced through it right here, came back up, and then once it got close to it again, found support on it here, overhead resistance here, support here, support here. So as you can see, it's well respected. Overhead resistance here, support here, support. So great indicator. So let's get down to the intraday time frame, and I'm going to see what we have here. Tell you what, we're going to take extended hours off, so we can see at the start of our day. All right, so we're on the 5 minute. Okay, we're just going to do some random scrolling, and we will zoom in on whatever our first day is here. Okay, so a lot of pretty much a sideways day here, not much going on. Start of the day, gapped up. Now remember, on a gap up like this to the start of the day, we want to wait till the candles get to the 6 moving average. Okay, so in this case we can see that they were riding underneath underneath the 2 moving average, so that was acting as overhead resistance. Okay, then we finally get to the 6, finally touches the 6. But again, our 2 moving average and our 6 moving average right here are really tight, crossing through each other. We don't want to have any part of that. And it continues. And then finally we get to our 21 moving average. Sure enough, the stock finds support on it. Support. Now, if you want to enter at that point, when you see support on the 21, more power to you. 288. And really, your first full formed candle below this, yeah, you'd only got about $1 out of it. So a day like this, this is a day, prime example of a day where it's best set on the sideline. When you got moving averages that are just all clumped up together, real tight, sideways market, avoid it. Yeah, the best way to play a sideways market is from the sidelines. So remember that. All right, so let's go scroll to a different day here. Hopefully we don't land on a sideways day. All right, so here's the day. Start of the day here, gapped up, and waited for it to come down to the 6 moving average. Well, it comes to the 6 moving average, finds overhead resistance rather, on the 6 moving average, and then goes below our 13, uses that as overhead resistance. At that point, that's a great entry. Nice separation between our 2 and our 6. Entry point around 289. And again, you're going to stay in this. Oh, and also too, worst case scenario, you found overhead support on the 21 as well. So let's just say for all intents and purposes, overhead support or resistance on the 6 wasn't good enough for you. 13 wasn't good enough for you. Well, here it is on the 21. I don't know how much more overhead resistance you need there. So let's just say hypothetically you got in there right at around 289, and you stayed in until you had a fully formed or mostly formed candle above the 6 moving average. Well, here you go. It breaks above the 6 moving average, 287. So nice $2 move there. Very nice. Then it proceeds up, breaks through the 13. But again, the 21's right here. So I'm thinking in this situation, okay, what do we got here? Yes, it's shown that it's going to use the 13 as support, but 21 is right here as overhead resistance. Sure enough, what happened? It got to the 21, and it became overhead resistance. It could not fight it. But at this point, you got so much congestion with your moving averages. The 2 and the 6 are close. 13 is just, yeah. I'm not personally, I'm not touching any of this sideways choppy market right here. Really, the first really, yeah, just really tight. You see how the 2 is crossing into the 6. Yeah, don't like that. That's not what we want. So let's find another day here. Do some random scrolling. What do we got here? First day here. All right. Nice day. Gap down. Again, we're not placing a trade until we get to that 6 and see what it's going to do based off of that. Our 2 and our 6 are crossing. Don't want any of that. And then what do we have? Our first really good sign here is whenever we see that the 13 is holding as overhead resistance. Candles are hitting their head on it. And then let's say here, now you have the 6 and the 13 as overhead resistance. Say this was one a nice little entry point right here at 276. And again, you're in that trade until you get a fully formed candle above the 6. 273. So, yeah, $3 move. That's very, very nice. And again, as we go through the day, the 21 rather, proved as nice overhead resistance right here. And then, of course, it turned into nice support the rest of the day. Support, support, and then it became resistance. So, again, the 21 moving average is just another piece of the puzzle. All right, let's scroll through here one more day, see what we got. All right, what do we have here? Start of the day right here, we had a gap up. And again, we're waiting until the candles get to that 6 moving average so we can get some definitive direction. What happens, it gets to the 6 and, well, had one candle support, use it as support here. Ideally, it's always nice to get 2 candles. See if you can get 2 candles worth of support or resistance. In this case, you got 1, and it was already a big red candle, so yeah, you'd already been looking for the stock to go down at this point after it runs up at the open. And sure enough, what happens? Comes up, runs into the 6 moving average and uses it as overhead resistance. Got a nice separation between the 2 and the 6. This would have been a nice entry point. Again, you have to make these decisions in real time. So 279, and again, you're going to stay in the trade until you get a fully or mostly formed candle, or until you break, until you hit your stop loss. In this case, it broke back above, and pretty much at that point, you would have wanted to have got out for very small profit, or right where you got in. So in that situation, what do you have from there? You see that you get support on the 6 moving average right here. Starts riding up as support. It's a good sign there. Say you'd entered there 279, and then comes below the 6 here. Yeah, would have got out. That would have been a good exit point right for about break even. So, but again, if you would have been, I totally would understand you not wanting to get in at this point, because again, you have your 6 crossing your 2. All of your moving averages are just all nice and tight together, which is not good. You always like to see when they start spreading out from each other. That's where you can get some clear direction. So really, the rest of this is just a bunch of, is more sideways movement. Really, the only, for this day, I would have looked at would have been right here whenever you had support. You had support with the 6, the 13, and the 21 at this point. I would have possibly looked at that for an entry point. So 279, and I'm waiting for a fully formed candle or mostly formed candle below. And again, all the moving averages got really tight here. So I would have honestly waited until I had one break below the 13 at this point. And you get one right here. So 280. So got in at 278.90. So a little over $1 move. So again, if you're using multiple contracts, yeah, you can do really well on that. So yeah, not the greatest of days there. A lot of sideways, but hey, not every day is going to be a great trading day. You just want to look for the days where everything lines up very nicely. And here, the following day would have been a great example of that. So what do you have here? The open. You break below the 13, the 21, and the 6. Man, that's a great entry. Yeah, you got all of this as overhead support, or resistance rather. And yeah, that would have been a nice entry point. So let's just say you enter there at 277. And again, you're waiting for a fully formed or mostly formed candle above the 6 or the 13, depending on. Now, if you get multiple contracts, that's another good thing with that. Is take, for instance, so say you entered here at around 277, you get a fully formed candle above the 6 right here at 275, $2. That's a nice drop. Been a perfect time to wait to take profit right there. And then you could have saved your next contract or your following contracts to see if you would have broke above the 13, which you didn't. In this case, what did it do? It turned south and continued to head back down. Again, you're waiting for another fully formed candle above the 6 at this point, right there, 272. So yeah, $5 move. So sold another contract here, and then once I seen that it crossed over the 13 and used that as support, yeah, I would have been more than likely completely out of the trade at that point, looking for calls or long positions. So let's say you did that. So you had a little bit of choppiness here, and then you got some clarity right here on this candle. Use the 21 as support, got above the 6, and let's just say you might have entered there, 273.50, and again you're waiting for a fully formed candle or mostly formed candle under the 6, and here you get one, 270, right around 274. Not much there. 50 cents, 50, 60 cents, something like that. And then from there, yeah, sideways. All your moving averages are nice and tight and just clumped up. That's not what we want. Not what we want. We want some nice clear separation. Oh, let's see here. It's another day, gap up, and waiting for it to get to the, yeah. So you're waiting for the candles to get to the 6 moving average, gets to it here, uses it as overhead support, or uses the 6 as overhead resistance rather, and it proceeds to head south. So 272, waiting for a fully formed candle, and you get one at 270. So $2 move there. From that point, a lot of sideways, or a lot of chop sideways, moving averages running through each other. We don't like that. We don't want that. So we patiently waited, and a little bit later on in the day, what do we get? Well, we get all of a sudden, we start seeing that candles are using the 6 or the 13 as overhead resistance, which is good, and then the 6 becomes overhead resistance, even more confirmation. See how the moving averages start fanning out here, all stacking on top of one another. Anytime you see that, that's a beautiful sign. When you start seeing moving averages stack on top of each other in order, again, 21 up here, 21, 13, 6, 2, nice stacked on each other. Oh, that is great. That's what you want. So let's say you entered here, 272, waiting for a fully formed candle. Right here, 269, nice $2 move there, $2+ move. Say you sold a contract there, but again you were saving another one until it passed the 13. Well, it sure didn't. Continued to head south, and then you finally break above right here. Use it as resistance at $67. So yeah, that's nice little $5 move there, and then you get choppy the rest of the day. So want to avoid that. Like I said, we want to find nice clear. Okay, so let's look at this day. So 4-2. Oh, so the start of the day, whew, crazy. all kind of candles all over the places, moving averages running all through each other. We don't want none of that. What are we looking for? We're looking for some separation between these moving averages. And what do we get? Right here, we started getting it. Use the 6 as support here. Uses it as support here. That's a great, good entry point there. Again, all the moving averages are stacked. 21, 21, 13, 6. Great, right there. 246 entry. And again, we're waiting till we have a fully formed candle underneath. And which, I ain't gonna lie, guys, whenever you get these crazy peaks like this, and then you see a big red candle starting to form, I mean, yeah, that's, I don't need a moving average or an indicator to tell me to get out when I've had that much run up. Because again, you entered around here, 246, and it runs all the way up to 252. Oof. I mean, it can't run up forever. You get that many green candles in a row. Oh yeah, that would have been it would have been hard for me to, when I got above 250, not to start looking to take some profit. But again, once you get this big red uh, explosion candle right here, that would have been a really good sign to get out of there. And then worst case scenario, say you wanted to just wait till you got a fully formed or mostly formed candle that used the 6 as resistance at this point, would have been right here at 250. So worst case scenario, 246, or yeah, 246, and then right there 250 use the 6 as. So yeah, that was very nice trade. And then from there, what do you get? You get a bunch of the 2 moving average crossing through the 6, and yeah, and then the 13. Yeah, too much sideways movement here. Moving average is way too tight. If anything, when you seen that it started riding the 21, the candle started riding the 21 moving average, you know, that's a nice bullish signal if you want to go long or buy some calls. But again, they're still running all through each other. But let's just say you felt strongly that the 21 was going to hold as support. Again, you had 1, 2, 3, 4 candles used it as support. So that's a good sign. So let's say you entered here to right around worst case scenario, let's say 250, and then you've seen that the 6 became support as well, and you're all the way in the trade until a mostly formed candle. So 250, around 251. So not bad. Little $1 move there. So that is the 21 moving average. Hopefully you got some value out of that. Again, the 21 moving average is just another piece of the indicator puzzle that we're using to get a nice picture of where a stock is going. So hope you found that valuable, and we'll see you in the next video. That one we'll be looking at simple moving average number 30. Welcome back to part 4 of the Precision Indicator course. Thus far, we've covered the 2 moving average, 6 simple moving average, the 13 simple moving average, and the 21 simple moving average. For this video, we will be covering simple moving average number 30. So we're going to go ahead and get that put on our screen here. I always like to keep mine blue. Alrighty, so let's go ahead and zoom here. Of course, as usual, we're using the SPY. And why do I like the 30 moving average so much? I think it is possibly the best buy and sell moving average that there is. The next moving average we'll cover in the next video gives it a run for its money. But overall, for entries and exits, the 30, yeah, I think the 30 is the best, to be quite honest with you. So what do I mean by that? Well, the 30 is extremely respected by the candles, and let's see some evidence of that. So we have the drop of 2020, the major drop, major crash, whatever you want to call it. And let's see what our 30 looks like. Now keep in mind, bigger time frames, these bigger moving averages don't do you a lot of good. They simply don't. Day to day, when it drops hard like this, look at this. The 30 was useless to you in this situation, other than the fact that the 30 is a major buy and sell indicator. So what that means is when the stock goes below 30, it's a very strong indication, hey, time to sell any long position, any calls you have, to buy short positions or buy puts, because more than likely we're heading down. And what did we have here? Sure enough, whenever it crossed up underneath the 30, well, it never came back and touched the 30. Ended up being, from that point, it went below at around 330 and didn't give you a buy signal, because again, it went above the 30. So when it goes above the 30, it's telling us it's a buy, time to buy. And so yeah, it would have been right around a 60 to 65 point move based on that. So not too bad. And then let's say you bought here at 365-ish, because again, it gave you the buy signal, one above the 30. Let's see where we got our next candle. We had one that came down and tested it, came right back up. Let's see where we get our first candle showing. So yeah, up until this point, there has not been a sell signal on the 30. And as you can see, from 265, well, honestly, you had at the peak here, so potential for, yeah, you had a nice, nice 655, 55 to 56 points that could have, or dollars in profit that could have been gained in here just by simply saying, hey, I'm buying above the 30 and I'm selling below the 30. So also to keep in mind, when I'm using my crosshairs, focus on the large crosshairs running across, up and down, and sideways on the screen. So yeah, at this point we still have not got a sell signal yet. Again, we're looking for a fully formed candle. That for a sell signal, we would be looking for a fully formed candle underneath. That's showing that the 30 is overhead resistance. So once it hits its head on the roof, the resistance roof of the 30, then yeah, look to sell at that point. So now let's bring this down to, let's just look at it historically here. So historically, again, great. I don't understand why hedge funds and other places don't just buy and sell off the 30. I mean, it blows my mind. But anyway, so we see we had a right here at 297. We got a, again, keep in mind we're on the daily. We got a buy signal right here at 297. Went above. Again, it went above the 30 at 297. So right here in this area. And it didn't give us a sell signal on the 30 until, yeah, man, and how long was that? That was October. That's crazy. Yeah, that's a long time. October 2019, didn't get a sell signal on the 30 until February 2020. Yeah, that's pretty good while. And even on that, you got one day's break. Well, actually, it was in January 27. You actually had a candle break below. So one candle break below. Again, I usually like to see 2 candles, but you know, when you're dealing with the daily, I mean, you can get a lot of drop in one day. So um, so yeah, in this case, got out here. Again, that would have been a nice, very nice gain from there to there. So again, of course, it told you to get right back in the market right there, and then got back in. Told you to get back in right here, 328, all the way up to 338. It went up to. So it's a great historical indicator, and we'll look at it a little bit more historically here. Again, as you can see, I'll highlight it here. Again, look where the candles dip below and then where they come back above. As you can see here, gives you some nice, gets you out early, relatively early on a major drop, and then it gets you back in whenever it's safe to get back in. So prime example down here. Well, first of all, it had you get in right here, 270, and saved you from this massive drop back in 2019. Yeah, would have saved you a lot of money there. And they had you get in here at 258 and didn't really get a buy signal or sell signal until right around 287. So had you get out here, back in. So again, you see how nice the 30 is for helping you to get out before something when things are getting bad, and it helps you get back in and actually make some extra money on the way back up. So great historical indicator. Yeah, it will save it'll save a lot of people a lot of money if they would just use the 30 as a major buy and sell indicator. Again, right here, here's another prime example of it. 246. Yeah, you got a buy signal right around 246, and you didn't get a sell signal on 30 until 275. So, I mean, we're talking months here. So from September to February, this kept you in the stock. Told you it was safe to stay in. And again, also too, another strategy you can look at is 30 for entry. Again, you can do this with the other indicators as well. Remember we talked about it a little bit before. You use the 6 moving average as an entry, and then the 13 as an exit, or the 21 as an exit. Again, that's just going to make your entries and exits more precise. So again, let's just say that we were testing that with this. Let's just say we were using the 13 and the 30. So we get an entry here on 246 on the 30, and we're going to use the 13 highlighted here in green as exit. Okay, so we got an exit right here, and then it proceeds to jump back in. So the next day we jump right back in, 258, and then once the next time that it passes underneath the 13, right up here. Now that's a precise entry and exit. Yeah, very nice. So 282, and you can see the 30 had us get out at 275. So would have saved you about $5 to $6 by using the 13 as an exit point rather than the 30. But again, 30 is a great entry indicator. Okay, I love it. Love it for entries. And again, exits, I love my 6, 13, and 21. But more so the 6 and the 13. Okay, let's see some other examples of that. Again, so here you got the sell signal. The entry point on a sell, 275. And again, we see here we get a mostly formed candle right here. So that would have been a nice entry point. Or if you wanted to wait for the 13, had one right here to get out of those short positions. So would have made a little bit of profit there. Nothing crazy. A lot of choppiness in here. Remember we talked about when you have moving averages all nice and tight running through each other. Yeah, it's always a. Oh, and I forgot to put our 2 moving average on there. All right. Very nice. So, something to keep in mind, and of course, what's nice about the 2 is you get some nice, clear direction whenever it crosses through that 30. So, makes it nice and clear there. All right. So, with that said, that is the 30 on the daily. And again, fantastic indicator. You want to look at the week? Let's look at the weekly. Yeah. See how beneficial it is on the weekly. Again, entry point 275, and you don't get a candle, fully formed candle below it until the crash here, 309. So, yep, very nice. So it gave some nice clear indication there. All right, let's see here a little bit more historically on the weekly. See here, beautiful right here. We get an entry point right here, 136. We're all the way back at 2012. 136 entry on the 30, and then we're looking for a fully formed candle that's hitting its head. The first fully formed candle to hit its head on the 30 and use it as resistance, overhead resistance. So from there, again, we had an entry there at 136. We don't get another. Oh, this is crazy. So this is the middle of 2012. 1 year, 2 years, over 2 years later, you get a indication to get out. Because we may be looking at a big drop. So, needless to say, that's a pretty big move. Tells you to get back here 196, and yeah, as you get out, about 6 months later. So, again, very protective. Let's look at where was another major drop in history. 2009. Let's look at that. What happened there? What did it look like? So, if you were using the 30, what would it have told you? Well, would have told you to get out all the way back in 2007. Okay, would have gave you the sell signal to get out in 2007. 148, and we're looking for a fully formed candle that jumps on top and uses the 30 as a floor, and you don't get one until after the crisis over and you start on your way back up. So look at the money that the 30 would have saved you there. Yeah, a lot of money. So again, had you get in right around here, or had you get out of the market right around 150, and didn't have you get back in until $86. That's that's $65 worth of, well, that's a whole lot of loss. Imagine these people that have hundreds of thousands, millions of dollars in their portfolio. Think of the money that would have been saved. Because again, a lot of people are just, hey, the only people, as the saying goes, the only people that get injured on a roller coaster, which, as you can see here, the stock market is a roller coaster. They say the only people that get injured are the ones that jump off. Well, that's true, but in my opinion, if you have indicators, precise indicators that can give you precision entries and exit points on the market, why wait in the market? Why take all this loss? I mean, why? It makes no sense. Now, if you're just somebody out there that's just relying on somebody to put your money in somewhere and take it out or trade it for you, then hey, then yeah, you're at their mercy. But with these technicals, with these technical indicators, you don't need anybody else. It's very simple. You can manage your own money, and you can do it with confidence. So, and again, it had you get back in. It had you get back in at around $86, and you got to start collecting all that profit. And you didn't get a sell signal until 112. Got a sell signal here. Lasted for several months, and then had you jump back in the market about 112. 112 all the way up to about 130. So again, it's extremely valuable. What about the dot-com bubble? What about there? Would it have done you any good? Would it have done you any good during that time? Yeah, yes it would have as well. And you see this massive drop here, right around 2000. And yeah, how'd you get out right around 145, and you didn't have a fully formed candle above. I used that support all the way down here until 115, and then had you get back out at 112, and didn't get a buy signal until got a 1 day worth of buy signal here, 1 day worth of buy signal here. So yeah, and again, we're on the weekly. Another strategy for more precision. 30 is entry, 13 is exit. Okay, that's another strategy there as well. What about the monthly? What does the monthly look like? Well, as you can see, the monthly had you get in, nice buy-in entry point right here back in 2010, and you didn't get a fully formed candle or a candle that used the 30 as overhead resistance until didn't have a candle really break through that until the big drop. So took 10 years to get a sell signal on the monthly using the 30. So, and from there you got the entry was around $100, and it had you get out around $280. So $180 worth of profits over that decade, compounded over all the different shares that you had. So yeah, not too bad there. Again, that's the monthly, and of course you could have been even a lot more precise by using the 30 as entry, 30 as an entry, and the 6. Again, we're on the monthly, so because of the way the time frames are, the 6 becomes a great exit point. So, for example, had you enter right here 108, the 6 had you exit at 129. All right. And it comes down here, hits off the 30 entry point, and it comes above the 6 entry point here. Exit here, entry here, and then the 6 doesn't give you a sell signal for even the 6 moving average on the monthly went from 2012 to went all the way to 2015 before giving you a sell signal on the 6. So yeah, the 6 is a great moving average for the monthly, to be honest with you. Yeah, it's a great moving average. The 6 had you get out right around 300. Yeah, right around 300. And as you can see, it where the market is right now, look at that. Came down, set right on it. Again, that's the 6 moving average on the monthly. So I wouldn't exaggerate when I told you that these indicators are very, very much historically respected. And why more people don't use the 6 moving average or the 13? You got a lot of people use the 20. The 20, of course, I use the 21. Why do I like the 21? I mean, prime example right here. You see these candles? Look at it. The wicks hit right on the 21. Right here, right on the 21, right on the 20, or we're on the 13, I'm sorry. Right here on the 21, right here on the 21. I mean, it is, yep, it's a very, all of these indicators, again, like I said, are very well respected. So let's see what it looks like on an intraday time frame. See what we got. For all intents and purposes, let's take off. I need to take off. Let's see. Let's go ahead and take off extended hours. So this is intraday. What do we got here? So where was the start of the day? Start of the day was right here. And what do we have? The day starts, a little bit of a drop down or a gap down. We're well below our 6 moving average. We're on the 3-minute time frame. And what happens? First candle of the day is there. I like to wait for it to get back to the 6 to see what it's going to do. Comes right here, bounces off, rejects off the 6. Good entry point there, 303, and it goes all the way down to 301. Again, you got multiple contracts. Yeah, you start getting multiple dollar moves on S&P, man, you gotta seriously consider taking profits. But let's just say here you were waiting for it to break above and find support on the 6. Well, here it is right here. 302. So even with that, you still had a nice little gain. But anyway, once it finds support, you can definitely look for calls at this point. So let's just say you jumped into calls here, 302, and you're waiting for a fully formed candle below the 6. Well, you don't get one till 304. So nice couple dollar move there. But for our 30, what's nice about the 30? Well, as we can see here, we had already broken under the 30. So that's a great sign for an entry point. Okay, and of course we're below the 30, we're selling, we're above the 30, we're buying. So take for instance, when you came up here, so you bought in here above when it jumped above the 6. Well, when it jumped above the 30, then you felt really good about that. And as you see, as it goes up and it uses each of these indicators, so again, it runs up, supports on the 13, right there on the 13, then it goes up, supports on the 21, and then continues to make its way up. 30 supports until it finally breaks that trend, goes up underneath the 6, and it starts a downtrend. And then you just get some crazy sideways movements. Choppy. You did get a nice break here below the 30. That would have been an entry point, say 303. Came down around 50. Well, at the most it came down right around a dollar. So if you're doing a lot of intraday trading, yeah, you gotta be content with you get a dollar move. Hey, that's great. And then choppiness. Then you get a really nice. You start getting some clarity here. Another strategy you can look at too is when the 6 moving average runs through the 30. That's another way you can get some clarification right there on when to enter. Okay, or when the 2 crosses through the 30 as well. So as you can see, when the 2 crosses through the 30, it can be a very nice entry and exit point. So let's say here you got in here, it went above the 30, found support on the 30. All right, nice entry, 303. And you're looking for the first formed or mostly formed candle under the 6 for an exit. Because again, I mean, yes, you can use the 30 for exit as well intraday. The only issue is you're going to get back a lot of profits. That's why, again, 30 is ideally, for an entry, whether that be an entry into a short or put, or an entry into a long or a call. And then one of our more precise indicators would be best for exits. So again, got here support at 303, and we got a fully formed candle right here at 304. So nice dollar move there. And again, when you're trading the SPY, dollar moves are great. Then you get choppiness, moving averages running all through each other. A little choppy for my liking. So that's that day. Let's just go to a random day here. See if we can get our rest of our map to pop up here. That's interesting. It's not wanting to give me Let's see if I can get it to pull more of my map up here. Okay, there we go. For some reason I had to change it to the 5, but anyway, it works no matter what time frame you're on. So let's see here. Start of the day right here at 624. Now again, when you see this nice fan, when you see these moving averages nice and stacked on each other, strong sign of a strong trend. Remember that. When you see the fan or the stacking of the indicators all in order, perfect. Yeah, I mean, that's a great sign of a downtrend. What happened? So the start of the day was right here, first candle of the day. Again, I'm waiting for it to get to the 6 before of course, with all these stacked here, it's telling me it's going to be a downtrend, but I still want to verify it. So what do we get? Get over here, comes up to the 6, uses it as resistance, overhead resistance, and we start our down. So let's just say you entered there once you've seen that it was going to reject off of the 6 and start making its way down. 310, and you start getting a fully formed candle here at 307. So nice move there. But again, if I would have bought multiple contracts personally, yes, I would have sold one contract here. But ideally, I have another contract or two, and I'm waiting to see what it's going to do up against my next moving average. And as you see here, because more times than not, when you get a strong downtrend like this, it'll just run up to the next moving average and get rejected. And sure enough, what did it do? Runs up to this moving average, gets rejected, and starts making its way down. So again, I'm looking for my next fully or mostly formed candle above the 6, and I don't get another one until this one's right there on the border, right here. So 303. So from 307, or actually 308. 308 to 303. So $5 move. That's, yeah, very powerful. A lot of money there. A lot of money there. And then we see finally the trend breaks. You find support on the 13. Get rejected on the 12. Support on the 13. Or rejected on the 21, supported on the 13. When you start having this bouncing in between, that's not the time to enter a trade. And again, you also see how as you start getting at the bottom of the trend, or this major trend of the day, this downtrend, the indicators will start getting closer. That's another sign that you're about to have a change in direction, or you're about to start getting some sideways movement. And sure enough, that's what you get here. You get a little sell signal here at the 30, jumps up on top of the 30, but it doesn't last long. So if you would have got in there, as soon as it comes below this 6 again, out right there, right around break even. And yeah, then you just get a lot of, again, all these moving averages are just all bundled up, bunched up, indicating sideways movement, no clear direction. So yeah, that's it's better to leave that stuff alone. We want the best of the best. There's no need to risk. Okay, let's see here in the start of another day, gap up. Again, I'm not doing anything until I find out what it's going to do in relation to the 6 moving average. Comes over to it, finds overhead resistance on it, and at this point, yeah, this is kind of a tough situation right here, because you still have, remember, our 2 moving average. Whenever it's running towards the bottom to middle, that's showing support. So right here, this is indicating to us that you're getting support from the 2. But of course, you have overhead resistance on the 6, so this would have been a tough one. So, and then sure enough, it finally breaks away from the 6. The 6 and the 2 break away from each other. Let's just say here you might have entered at around 313 when it's found support on the 6, and got out right here. Yeah, break even. But again, keep in mind, when you're above the 13, you have a buying bias. When you're below the 30, when you're above the 30, you have a buying bias. Okay, buying, you think the stock is going to go up. And then when it's below the 30, you have a selling bias. You're biased towards this stock going down. So keep in mind there. Tell you what, let's zoom out here and just go to a random, just zoom. I'm just going to zoom out and scroll and just find some randomness. All right, what we got in here? 512 was the start of this day. What do we get here? Start of the day. Well, it wants to run up. It's above the 30. Things are all looking green, and then what would you know? Now, again, you see here, start of the day, you're sitting on top of the 30. Okay, so you wanted to enter that. Well, you always have to be leery on the first candle or two of the day because you never know what's going to happen. But from there, it ran up a quick $1. Well, if I get that kind of a quick move right at the start of the day, yeah, I got to take some profits. And part of the reason why, too, I would not have felt very confident about this continuing just to run up is because we don't see the fan. We don't see all of our moving averages stacked on top of one another like it's supporting it on the way up. What do you have here? You actually have them. The moving averages are actually going down. So not a good sign that this was going to be a long-term uptrend. And then, of course, sure enough, yeah, it because again, another thing that would have told you that this wasn't going to be a long term was the 6 moving average, way away from the candle. Again, always the candles always want to come back to the 6. It's not going to get too far away from the 6 here, way too far away for that. So ideally, great entry would have been right here. We see the 30. Candle goes underneath it, uses it as overhead resistance. Entry there, 293. And again, you're in it until you get a mostly or fully formed candle above, right here at 292. So about a dollar move. Now again, you're still below the 30, so in the back of your mind, you still have some sellers biased. So you know it can be a little bit more risky to jump into, especially when you got some nice, when your moving averages, your 2 and your 6 are real tight right here, and your 13 all this. Yeah. Yeah, you could have said here, oh, well, it's sitting on top of the 6. It's time to go up. Well, you still got the 13 as overhead resistance. You still got the 21. So, again, below the 30, again, you're thinking puts, you're thinking short. And then once you get above that 30, that's when you can feel more confident in long entries and call contracts. So yeah, not bad there. Let's go to the next day. What do we get here? The next day. Man, what a start to the day. Look at this. We got the fan. All of our moving averages stacked on each other. First candle of the day, 286. And then, yeah, it goes down to 284. But again, if you would have wanted to waited until it, see what it did on how it interacted with the 6, totally understandable, because sure enough, yeah, you say, oh, well, this is for sure going down. We're going to have a big down day. Well, that's true, but you got to realize that, yeah, that the reality of it is you want to see how it reacts with the 6. And then here it finds support on the 6, but again, it's still below the 30 and all these other moving averages. So you're leery. You're leery of getting into long or call positions, and it would have served you well because, well, you come through here, still nice and tight. Yeah, it breaks through the 21, and then what happens? Well, the 30 proves to be too strong. It breaks below the 6 right here. Breaks below the 6 right here at the 21 as well. So let's say you wanted to play it really safe. You waited till I got under the 13, the 6, the 21 right here at 285. And again, you're waiting for your next fully formed candle, or mostly formed candle above the 6. And you don't get another one until 280. So, yeah, that's that. Yep, so a $6 move. Yeah, that's a lot of profit there. And again, this is on the 5. You get more. You get more precision. Let's go to the next day. 514. Start of the day. You get some fanning, which is a good sign. So your first candle of the day right here. It's far away from the 6. I'm leery of that. The second candle of the day came all the way up here and then started rejecting. Well, that would have because again, you had all these moving averages starting to fan out here. Yeah, that would have been, for me, that would have probably been some strong confirmation of a continued downtrend to see it reject there. But let's just say worst case scenario, you got in here at 278, and yeah, it ends up dropping all the way to 276. $2 move. $2 move on the SPY is a great move. But let's just say you were stubborn. You wanted to wait till it got above the 6. And sure enough, right there, 277. So still not a bad move. And now at this point, I get cautious. I get very cautious when I see this. Because again, it comes up here. But again, I got all this overhead resistance. So yeah, I don't necessarily jump. As soon as it jumps above the 6, I don't. On a downtrend like this, below the 30, because again, below the 30, we have a seller's biased, or a put bias, or a short bias. So here, I got to see. For me, I like to see it jump on at least the 6 and the 13. When I see it jump on top of the 6 and the 13, I feel more confident. And then here, what did it do? It did that. So right around 277, 278, it jumps on top of the 13, and that becomes support. And then from there, from 278, you didn't get, again, it goes above the 30. That would have given you even more confidence. It used the 21 as support right here. And yeah, you don't get another candle formed above until 280. So 278, 280, $2 move on the SPY. Awesome. Now, keep in mind, if you're using this on bigger moving stocks, the same strategies, I mean, these same moves, $1 and $2 moves are, you know, $3 and $5, $5 and $10 moves on, you know, something like right now, a Netflix or an Nvidia or an Apple right now, or a Tesla. Oh yeah, God, yeah, Tesla. It's yeah, these are monster moves on those stocks. So, and again, I'm just trying to help you see if you can use it on the SPY, you can pretty much use it on anything. So, so you got your exit there. So exit point there. Now at this point, you ran through the 13. Yes, you could have been like, okay, let me get into a short or put position. But again, above the 30, you got a buyer's or a long or a call biased. And sure enough, what did it do? Comes down here, hits on the 30, finds support on it, bounces back up. For me, I've already got a buying, a call biased, so I'm entering calls right there. And it's riding the 30. Oh yeah, nice, a lot of confidence there. So 279, I'm in. And again, it proceeds to go above the 6, above the 13. My confidence is growing. You get a fully formed candle below here, right here. So what you got there? 279, 28. So about $1 move there. So let's just say, for all intents and purposes, I sold a contract there. Well, what proceeds to happen? What did I tell you? A lot of times it'll find that 30. When you're on a major trend, again, uptrend, you're above the 30. So that's your major trend. Found support on the 13, bounced right back off of it. And didn't get another sell signal until 282. So, not bad there. So from 279 to 282. Very nice. Yeah. So sold a contract there, and then when it goes below this 13, yeah, I would have been more apt to get out of the whole position, especially when it goes below there. But again, what happened? Bam. Hits off the 30 and then comes back up. So entry there, 281, 282, and then goes above a little bit, which, hey, at this point in the day, that's another thing to keep in mind, is what time of the day is it? You're getting later, keep in mind, you're getting later in the day. you're not going to get the same kind of movement. So, yeah, you may get a $2, $3, $4 move earlier in the day, but by the time you get to midday, when New York, the New York Stock Exchange, when it starts going to lunch around 12:30, their time, things tend to start slowing down a little bit. So this time of the day, a $1 move, oh god, yeah, that's great. You'll take that any day. But so let's see here. So it came below. Let's say but again, keep in mind the 30 was still trending up. So yes, it dipped below the 30 here. But again, your trend, your major trend entry point is telling you, hey, we're still trending up. So yeah, it dips below there. I wouldn't feel extremely confident in that. And sure enough, what does it do? It comes right back on top of it. 282 entry point, uses it. You got the 6 as support, 21, 13, all of them at support. Heading up 282, and you don't get a sell signal. You get somewhat of one right here. Again, you keep in mind you're getting to the end of the day. So let's see, so one here, a contract here. Want to see what it did right there at the end of the day. It hit off the 13 as support and ran right back up to finish the day. So that sold that right at the end of the day. 285. So $3 right there at the end of the day that you get it collected. That's hard to complain with there. So again, the things to keep in mind: 30 is a major entry. Moving average, and again, things to keep in mind with it is when it goes above it, or below it, and also too, where is it trending? Is it trending up? If it's trending up, I feel better about first and foremost. If the candles are above it, I feel very strongly about call positions, long positions, and then it dips below it, but it's still uptrending. I don't feel very confident there. I don't feel very confident there. Now, if this 30 was flat, it was more flat, moving more horizontal, and then it dipped below the 30, then I would have felt more confident about maybe jumping in right here. But again, you got a nice uptrend, so I would have been leery about getting into any short positions at that point. So that was that day. Let's look at a few more examples here. Let's see what we got here. Here's the start of the day. Oof, man, what a drop here. That's a drop. Drop. Everything's fanned out. Major downtrend. So what would I have been looking for? Okay, I'm waiting for it to get to the 6 before I really want to do anything. What does it do? Jumps on top of it. But again, the 30 is telling me that we're in a major. Again, we're below it, so we have a seller's bias. So just because it jumps above the 6 here, that's not a lot of confidence there. I want to see what it does with the 13 or the 21. Well, jumps above the 13, but again, it's still moving sideways. And the 6 and the 13 are really tight right here. So in that situation, I would have sat on my hands. Wanted to see what it did with the 30. And we see once it got to the 30, look at that point there. We get the 6. It goes underneath. And then sure enough, the 21, the 13, and the 6 all become overhead resistance. At that point, that's when I'm looking for a decent entry right there. So 284 entry. And again, I'm waiting for my next fully or mostly formed candle above. Right there, 282. So, yeah, almost a $3 move. But again, I got multiple contracts, so I sold one there. I'm waiting to see what it does on the 13 at this point. Well, it holds, the 13 holds this overhead support really well, all the way down until 282. So, from 285-ish down to, all the way down to 282. So another contract. And again, it stays below at that point. I got a third contract. I want to see what it does on the 20 up against the 21 for my final contract. Well, gets rejected off of the 21 there. See if I can zoom in a little bit better here. Again, it gets rejected off the 21 overhead resistance, and then honestly, all the moving averages start getting really tight. You notice how they're wide here. They start getting tight. What does that tell us? We're moving sideways, or we're about to change direction. Again, this trend has been going on all day long. Again, this downtrend started at the beginning of the day, and yeah, it lasted. It downtrended most of the day, and then for the last part of the day, it was sideways. So, day like that, hey, take your gains at the beginning of the day and realize when you start getting to midday, expect a slower. You're not going to have as much volume in the market. Sideways and slower movement is coming. Now in power hour, yeah, the last hour or so of the day, hour and a half, you can get some decent movement. But other than that, yeah, the first half of the day, in the last hour or so is where you're going to get your most movement. So, simple enough there. Let's see, the day before, let's check this day out. First candle of the day, boom, it starts right here. Again, I'm way away from the 6. Yeah, I just have to wait. I got to see what it does in relation to that 6. Because let's just say you jumped in somewhere around here at 291. Oh yeah, let's all jump into the 7. Well, yeah, you could have came down here and got a dollar. Let's see, maybe a $1 or 2 move. Could have. The thing is, it was very short-lived. Let's just say you got in somewhere around here. Well, once you've seen this candle right there, I mean that's, yeah, the 2 is crossing through the 6. Yeah, that would have been a point. I would not have felt very confident right there to stay in a short position. But again, I wouldn't felt very confident to get into a long yet, because again, we have the 30 up here. Again, we're below the 30, so we have a seller's bias, or a put bias. So what do we have here? Again, goes above the 6. Again, we're in a downtrend. 30's up here, trending down. I need to see what it's going to do in relation with the 13 or the 21. Well, it comes over here and somewhat gets rejected by the 21, runs down it, and then bam, uses it as support, bounces up here. Okay, at this point, I'm looking to see what it does up against the 21. Goes to the 21, uses it as overhead resistance. Now that right there would have been an entry that I would have possibly looked into, because again, I'm below the 30, I'm downtrending on the 30, downtrending on the 21, so it finds resistance there. So let's just say worst case entered on the next candle as it showed to be overhead resistance, 291. Came all the way down, fell $1 on that candle. Yeah, that would have been hard not to take some profit there on that dollar move, and then it proceeds to start making its way back up. 13 overhead resistance here, holding as it resist, then breaks through. But now keep in mind what's starting to happen now. All of our moving averages are starting to get really tight. We're still under the 30, we're still downtrending, so we still have that bias. But again, we're starting to get tight, so we become leery of sideways movement. And that's what we get for the most part here over the next hour or two. The next really good looking entry point for me would have been right here. We dropped below the 6, right there at 291. Yeah, that would have been a nice entry point, because again, I have the 30 is overhead resistance, the 13, the 21. See the 13 right here? Finds overhead resistance on it right there, 291. So I would have liked to have entered there. 291, waiting for a fully formed candle above the 6, mostly formed, and we don't get one until we don't get one new day until 289. So that's 291, $2 move. Yeah. And again, sold a contract. You could have sold a contract there and seen what it did in relation to the 13. Well, it pops through it, uses it as support. Yep, sold another contract there. And then we see it comes up to the 21. Kind of does a 50-50 thing on it. And then falls right back down. Uses the 13 as support. Again, just a reminder, look how much the 13 is respected. Man, and the 21. Very, very respected. So yep, and then as we get towards the end of the day, the volume leaves. The moving averages all get nice and tight in here. Yeah, sideways movement. Avoid that. And then the last hour of the day, was there anything significant? No, not really. Last hour of the day, you did go above the 30, find support on it, 289, so you got in. You got your little dollar move out of it right there. Took some profit possibly. And then a little comes up below here, fully formed underneath. So, yeah. So I hope that's been helpful. Again, that was the 5 minutes. But again, whatever time frame you're using, it's going to it's going to hold true for you. Right here we got the 15 minutes. And let's zoom in here. Let's see what we got. First start of the day here. Yeah. Moving average is nice and tight. Again, we're above the 30, so we have a buyer's or call biased. And what do we have here? 15 minutes, just a bunch of First really strong signal of the day for a sell signal. Right here, you're underneath 30 and several other moving averages, 295. If you had stayed in this to, $3 move there. So I do like the 15 just to give me a general double check on my intraday. So we see here, this day, start of the day was right here, 9:30, and this is a tough one. You see that the 30 is trending up, and then it breaks below your candle goes below the 6, so that's a tough position at that point. I'm not doing anything. I gotta see what it does on the next candle or two. Well, then it breaks below the 30. Well, at that point, I am a seller. I have a seller's biased at that put biased, and then it jumps below the 13. At that point, I'm very, very bullish. So 296, definitely in, and it fell all the way to 293. Yeah, that's a good $3 move or so there. Hard not to take some profits there. When you get keep in mind, when you get a really quick drop, really quick falls down like this, and then it starts backing up, and you see about 50% of the candle, and then the next candle starts going up. More time, and again, this is a bullish engulfing candle, means that it's engulfing or bigger than this candle. Until it tells time to get out. So we'll go over some candle strategies later on in the course. But again, that's the 15 minutes. I do like to check it during the day just to see where things are. 3 minutes. We talked about the 3 minute. I like a 3 minute at the start of the day. Great candle, or a great time frame to use. I like the 2 minute as well. Start of this day right here, we see it runs up. Again, start of the day was right here. Look how far away we are from the 6. I gotta see what it's gonna do in relation to the 6. But again, I have a seller's bias because 30's up here. We're fanning down, and we'll see it goes up to the 6, and then starts. We get 2 candles worth of rejection, and great entry. 310 and 307 is the exit point when it jumps above. So first contract sold there. See what it does on the 13. Breaks through it. Another contract sold there, and then it's not enough to it can't handle the 21, gets rejected there, comes back underneath the 13 and the 6. You still got a contractor, want to get some more contracts at this point, good position. 307, and you don't get another strong selling point until 302, 302, 303. So, yeah, that's $3 or $4 move there, not bad. For some reason my map is running short on me. But let's check out this day, 6:15. So, start of the day is here. Again, we're on the 3 minutes. Start of the day is here. We're so far away from the 6. I got to see what it's going to do in relation to the 6. It goes to the 6. Looks like it's going to get rejected, possibly keep heading down. Let's just say you were just gung-ho, you enter there, $2.99, and then it comes down here and then bounces back up, then find support. Yep, so get out for break even. And from that point, it continues to go up. But again, we're below the 30, so we have a seller, but so we don't feel very confident about jumping into long positions yet. Again, I'd like to see what it's going to do in relation to the 13. Well, what does it do? It comes up here to the 13, finds support on the 13, then has support on the 6. $2.99. But let's just say you hypothetically entered here. Again, your 30 is right here, so I'm expecting it to get rejected at the 30. I mean, the 30 is downtrending. I'm expecting. So if I enter here, I am 100% ready. As soon as it gets to this 30 and I start seeing it bounce off of that, hey, I am selling my contracts until I can see 1 or 2 candles get on top of it and start showing that they're going to go above. So it gets rejected here, and it comes down below the 6 here and the 30. For me, that's a good entry point. 300, and yeah, 50 to 75 cent move there. Comes down. Well, no, actually, if you'd have stayed into the bottom, yeah, you'd have been right around $2.99. Yeah, almost $2 move there. Yeah, so, but again, your moving averages all start getting really nice and tight, indicating sideways movement or a trend change. Well, what happens? Well, our candles jump on top of the 30. So now we have a buyer's biased, call biased. Well, we'll get there. 2 candles of support on top of the 30. So say we enter here 364 cents. And again, we're waiting for a fully formed or mostly formed candle below. And we get it right here, 302. So, yeah, $1.50, $2 move there. Not too bad. Not too bad. And the rest of the day, moving averages get really tight. The 30 gets very horizontal. So, sideways. So avoid that. We don't want to trade. Best place to be with sideways movement is on the sidelines. Let somebody else have that. But as the day goes on, we start getting separation here. All right, we found strong support on the 30. Support. But again, my moving average is all nice and tight. My 6 and 30 are really tight right there. And then, well, it finally jumps on top of the 6, jumps on top of the 13, the 21. So let's see here. Again, we're above our 30, so we got a buyer's bias. So right there, that's a nice entry, 301.96. And we're going to stay in this until we can get a fully formed or mostly formed candle above or below the 6. Right there, it's 303. Yeah, so a little over $1.50 move right there. Not bad. Not bad at all. We will take that. So say you sold a contract there. As soon as you sell that contract, you got your next contract queued up, ready to sell, waiting to see what it does on the 30. But again, you have, your bias is that it's going to continue to go up. The 30 is trending up, 21 is trending up. So sure enough, what happens? Find support on the 13, keeps riding it up, and we don't get another sell signal until it crosses right here, 304. So if you held that contract from there, 301.89 to 304 or 304, 305. Yeah, a nice $3 move or so, not bad. And then again, it comes down, uses the 13 as overhead resistance, still has the 21 to get through. It doesn't, and then finally it's able to break through them. But again, all the moving averages are really tight, and we're very hesitant to start buying puts or get short when we're still above the 30. So that would have been a good time just to set on your hands. Again, you're going down, the 30's uptrending, the stock is heading down. Better to wait and see what materializes. And you got to keep in mind, you're towards the end of the day. Yeah, you only got an hour or two before close. Very slow, couple hours before close, slow time of the day. Yeah, you're not going to expect fireworks. But of course, power hour or the last hour or two, you start getting get a major explosion here. Riding there, and then bam, bust above all of them. Yeah, if you wanted to jump in when this candle got to about right here, breaks above everything, that would have been, I had my blessing on that. Right around 305. 305, but I'm not going to lie, it runs all the way up to 30. $1.50 move real quick on that candle. And then, I'm pretty far away from the 6 moving average. At this point, I would have been getting I would have wanted to take some profits off the table. Again, I know this stock is, these candles are going to come back to this 6 moving average. It never gets too far away from the 6. And sure enough, what does it do? Tractor beam, pulls it right over to it. Yeah. So, but again, you don't get a sell signal. Say you sold there. It runs up $1.50 at the end of the day, last hour or two of the day. This point of the day, you get that kind of move. Take some profits, please. But you don't get a sell signal really until right there, 307.50. So, that is a nice, almost a $3 move right there if you'd have got in. At this point, it starts going down, heading back towards the 30, but again, the 30 is trending up, so we're hesitant to get into short positions, call or put positions when we see our 30 trending and we're heading back to it. Because more times than not, it likes to bounce right off of it. And what happens for the most part, you get sideways movement. Moving averages all get nice and tight. And you don't really get any clear direction, any clarity on anything until right here. What happens? Stock breaks, or the candles break below the 60 right here. All the moving averages right there. Hits its head on the 30 and all the other ones. Then it hits its head again. Yeah, at that point, if you want to enter a short position or a put position there, and at the same time, be ready to get out of it real quick if it jumps right back above the 30. But at that point, that would have been a nice entry there. You got 2 candles hitting their head on the 30, right around 307, and you don't get a sell signal until around 35, about $1.50 move. So the power hour move there, and again it goes above, but again we're below the 30 at this point, so at this point we're kind of hesitant about about going long or getting calls when we're below the 30. Again, usually I had to wait till seeing how it reacted on the 13, but again, we're right here at the end of the day. It's still under the 30. Yeah, time to give it up. You made enough. You made plenty of profits. So yeah, that's the 30 moving average. Again, just to repeat, is a great entry and trend moving average. Again, we're below it. We're looking to short or buy puts, biased. If it's above, then we're looking to go long or buy calls. But again, keep in mind also too which way the 30 is trending. Is it trending up? Is it trending down? Is it trending sideways? Those all have to be taken into account as well. So I hope that gave you a little bit more clarity on the 30 moving average. Hope you have a little bit more appreciation for it now, and why I personally feel very, very strongly about the 30 moving average. So that'll end this part. Our next moving average. So far, again, we've done 2 moving average, 6 moving average, 13, 21, 30. So we're 5 moving averages in. We have the next moving average, which will be the 50 moving average. So look forward to seeing you in the next video. I think I called this one at the beginning of the video. I think I called it part 4. It should have been part 5, but anyway, apologize for that. But our moving average will be that is going to be part 6, and look forward to seeing you back for that and seeing what value we can get from the 50 moving average. And again, keep in mind all of these indicators are all just pieces of the puzzle, just allowing us to get a clear picture of what the big picture is. So thanks for joining us in this video. Welcome to part 6 of the Precision Indicator course. In this video, we'll be going over our next major buy and sell indicator, which is the 50-day simple moving average. Go ahead and get that put on our screen here. Remember last time, we like red. Remember last time we covered the 30. We talked about how it was a major buy and sell indicator. Well, the 50 is, yeah, it's the safest buy and sell of all the major buy and sell moving averages. So why so? Well, again, the 30 can get you out a little bit sooner and get you back in a little bit faster. But when you're looking for a little bit stronger assurance of a downtrend, then your 50 is your one to look at. So again, as usual, we're on the SPY crash of 2020, and as you can see here, just like the 30, again, it's as a buy and sell indicator, it went under, the candles went underneath. Again, make sure you focus on my big crosshairs. The candle went underneath the 50, and yeah, it proceeded to drop like a hammer. And when it gets underneath the 50 and shows that it's going to, really this candle right here is really the one that was the really telltale sign, showed that it was using it as overhead resistance, hitting its head on it. So strong sign there of a downtrend. Now, as you can see here, on a bigger time frame or a bigger drop like this, the 50 didn't do you much good. Take, for instance, the SPY went all the way down to 218, 218.26, and you didn't get a buy signal on the 50 until 280. So yeah, that was $60 that you would have missed out if you're using the 50 as an exit. Now, as an entry point, hey, to enter a call or enter a put or enter long, very understandable. But to use it for an exit, especially on these big time frames like this, not always the best. Not always the best. So keep that in mind anytime you get some swift drops or run ups. Take for another prime example was right here. You had a drop from 332 all the way down to 320. So nice little 13-point drop. And hey, before the days of the 2020 crash, hey, that was a huge drop. Now, yeah, it didn't seem so bad when you take into consideration this fall off a cliff here. But once upon a time, that was a very big drop. So you see here that the 50, well, it was nice because it helped you to see that it found support on the 50. All right, so that's again, the 50 is a very strong support and resistance, and of course it held true right here. But in this situation, would you have wanted to use it as an entry point or an exit point? No, because it would have never had you exit. You would have lost $13, which again back then was a huge move. You'd have lost $13. That's a lot of money to be lost. Whereas if you would have used the 6 or the 21 or even the 30, it would have been you'd have been better off using that as an exit point. So something to keep in mind. As we go on, you'll see as we look at our other indicators, you'll be able to use these moving averages along with the other indicators to get better clarity. But I'm just trying to help you see that you can use just moving averages. If you needed to, all you had was moving averages available to you. You can use these to make precise entries and exits. Will it be perfect? No, but you can be pretty precise. So let's look at the 50 historically. We see there, found great support on it. Actually broke through down here. And again, when it broke through, it came on down, came back up, retested it, hit its head on it as overhead support, came back down, hit its head on it, and then finally broke through. See here, came down, broke through, had to gap down to get through the 50. That's another thing you'll see a lot too is the stock will gap down or above to get over the 50 because it's such strong support and resistance. You see it right here, gap up. See it here, gap down. So yeah, very strong gap down here. So it was down here, it had to get here, gap, and then gap up. So yep, it has to work really hard to get over and under that 50 more times than not. And change my color on my 6 so it's a little bit clearer for you. Let's see here. All right. Don't want to be have any confusion between the 50 and the 6. So go back through, continue through history. What do we have here? Comes down, sits on the 50. Well, what does it have to do to get through it? Gaps down. Then it comes up, hits its head on it. All right, and then comes up, sits on it, comes below, hits its head on it, hits its head, and then continues down, comes back up, sits on it. So as you can see, the 50 is very much respected. Okay, so 2019 here, we get into a big downtrend. So what do we have here? comes down, and our candles, tell you what, I'm going to take the 2 off from right now. Alright, so we see it comes down here, hits its head, comes down, hits its head, tries to go up, hits its head on the 50. Good sign. We're in a downtrend. The next day it starts right here at the top of this candle. Again, even more sign that we're in a downtrend, and sure enough, it continues down. And then we don't get a buy signal. Gap above the 6 right here. So that's an indicator that we're changing direction. And then it comes up to the 50, uses it as overhead resistance, comes up here, uses it as a resistance here, pops up above it one day, next day comes, and then right back below it again. And then drops below the 30, which is even more bullish, or bearish rather, and then it continues to go under the 21, the 13, and then finally under the 6, and yeah, you start seeing the fan. Yeah, when you start seeing the fan, know that a downtrend is imminent, very much imminent. So, again, all under the 50. And we see here whenever it got to the 50, hit its head on it, gapped up above it to get away from it, use it as support, 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 support. Oh, support and support. That was the 13 there. And then it continued up from that point. So again, it's needless to say, it's very, very well respected. So yeah, well that's it on a daily. Again, you can see how the stock, it tends to yeah, in a bull market, it's going to stay use that 50 as support and continue to run up. And then when that does become a bear market, it will drop below that 50. But again, even if you were just using the 50 as an entry and exit, here it hit its head on it at 287, and you had this one day where it popped above, but other than that, it really didn't give you a clear buy signal until about 263 to get back in the market on the 50. Of course, a much better strategy if you want to use the 50 as an entry. You enter your shorts or you sell your long positions here, and then you don't buy back in until, again, you get a full or fully formed candle or mostly formed candle above the 6 or the 13. And of course, if you'd have done it above the 6, you'd have got in 246. So yeah, that was and that would have been pretty close to the bottom. And with our indicators that we're going to go over in the future, you'll be able to you'll have even more clarity as far as when to get in at these bottoms. It's part of the reason why I had some help when I guessed that the bottom would be 215 to 220 on this massive drop, and it ended up falling right in there at 218. Fell right in between my my suspected fall bottom of the market. And of course, I have screenshot messages to prove that one. So again, 50, great buy and sell indicator. Now let's move it down to, well, firstly let's look at it on the weekly. So we can see that the 50, you're just looking at when the stock is above it. Yeah, really, other than the major drops, protects you from the major drops. So and again, it keeps you in the bull markets. So again, great indicator. Definitely, if you had to have just one, yeah, especially for a long-term investor, the 30 or the 50, that would be your go-tos. So great indicator. So let's go down to the daily, see how it reacts in a daily market. All right, so we're on the 3-minute time frame here. We see that this day we had a substantial drop, and of course, why did I get in and make a nice profit on this day right here? Well, what did I see? Pre-market, I saw the fan. It was fanning out here, continuing to come down. The market open, had a candle use it as overhead resistance on the 13, and then eventually it started using the 6 as overhead resistance. That's even more confirmation. So let's say you got in here at 305 and you got out at your first fully formed. Well, that right there would have broke you even, but say you sold a contract there. But again, remember, in these, when things start fanning out like this, it's good to have multiple contracts, so that way you can see how it interacts. If you want to be quick to get out, you can sell just one contract. You're trying to minimize losses, which me personally I like to do for sure. But then you see how it interacts with the 13, because again, remember, the 13 is highly respected. So what happens? Runs up to the 13, gets rejected, and then from there, look at that drop. So from 305 all the way down, didn't get another fully formed candle above the signal, still 301. So monster drop. And then from there, what happens? You have the 6 moving average that runs through the 13 right here, makes this X. And then you got your 21. Again, all the moving averages start getting nice and tight. Again, which we don't like, jumbled up. But again, keep in mind, at this point, we're still below the 50. Something to keep in mind. We're below the 50. We have a seller's bias, or we have a bearish bias. So above the 50, bullish. Below the 50, bearish. Now, does that mean that you can't sell long positions or call positions when you're below the 50? No, you just have to be more careful. So again, when you're below that 50, below that 30, again, strong bullish sentiment. Above the 30 and the 50, strong bullish sentiment. So please ingrain that into your mind. That's your bias. That should be your bias. Now, does that mean it always holds true? No. Take, for instance, when you get a massive drop like this, at some point, you're going to have to make a reversal. And hey, do I like to make money whenever it hits the bottom and starts reversing? Yes, I do. But again, I'm more cautious, because I've seen it more times than not. Like, take, for instance, here for me, when I seen that it used the 13, popped above the 13, yeah, I would be very tempted to get out of all positions. Once I see it use the 13 as support, that usually means we're going to get a decent trend change. So from there, you got 301.84, and all the way up to, ran up $1. But then once I seen that once I see it start getting close to this 30, I'm really getting taken seriously, selling my contracts, or selling a contract, because again, I know I'm still under the 30 and under the 50, and they're trending down. Again, it's not only being above or below them, but which way are they trending? Which way are they trending? In this situation, they're trending down. So again, I would not be very bullish. Once it gets up here, starts, getting around this 30, I'm getting very much nervous about keeping these contracts. And then, of course, gets rejected there. Oh, I'm out of here. I am out. If anything, I'm getting back into puts at this point when I see that or shorts when I see that it is rejected as the 30. And then sure enough, let's say you got in there, you had 3 candles of rejection. That's pretty strong sentiment. So 302, and then you don't have another fully formed candle above the 6 until you start getting one right here. So yeah, you could have got out, made a little bit or broke even. But again, I'm not very keen on trading this because again, you got indicators or moving averages all running through each other. I don't like that. Yeah, I don't like that. I want to have more clarity. And I got that really when it came up to what happened. I had a candle come up here, kiss the 50, and then once I seen that that was rejected, hey, that's a good entry point. 302.67, and sure enough, bam, rejects hard, comes down. Honestly, whenever we get to the indicators on support and resistance or buy and sell levels, you would have seen why selling right here would have been very smart. So again, that when we get to the indicators on buy, on support levels of buying and levels of selling, that indicator, you'll have even more clarity on why you should have sold at least one contract right here. But worst case scenario, you sold above the 6, fully formed candle above the 6. So, and then what do you have from here? You're in downtrend, and you got a bunch of, it starts getting tight. I mean, you could have said, okay, it rejected off the 13. I want to get back in 301.60, and then you actually came on down to, you dropped about $1 or so. And then you start trending up, but again, you got the 50 right here. But notice how the moving averages are starting to flatten out. That's a very, very good sign, especially, again, this is later in the day. The volume is slowed down. Ideally, you don't want to take much risk. The further you go into the day, especially the middle of the day, you have to understand it's low volume, a lot of choppiness, easy to lose money. So knowing what time of day this was, New York was at lunch, time to be very, very cautious in the market, unless you just get something that is just undeniable. Even here, I see it bust above the 50 and the 30. Hey, that's a very bullish sign right there. You could have said, oh man, I want to jump in that if you just needed to be in a trade. 301.80, and then got right back out for right around break even. Fully formed candle above the 6 or below the 6. And then from there, as the day goes on, you get a little bit more sideways choppiness, a lot of sideways movement. Then finally you get some clarity. The stock breaks below the 50, and it breaks below the 30, finds overhead resistance on it. 1, 2, 3, 3 candles, actually 4 candles, 5 candles. And then you get a breakaway candle from the 50. That's very, very much bearish. So that candle's right here, 301.78. That's pretty clear. You're below the 50, below the 6. Yeah, I would have felt very strongly about getting in right here. So 301.68, and yeah, you get a nice dollar move there on your first fully formed candle above the 6. So very nice. Again, you're getting closer to the day, right around power hour. From there, you just get sideways, bouncing off. Again, it rejects off the 21 pretty hard in multiple areas. But again, at this point, when you see it reject off the 21, if you want to take the better to be safe than sorry, you could, especially this time of day, you say, okay, well, now especially when the moving averages start getting really tight in here, say, okay, well, when it busts above or gets above the 21, I am out. So if you'd had that approach, you got in at right at 301, and then you have one candle that finishes above, partially above at 330. So you'd have made a little bit, not much. So that was that. Let's just go here to a random day. Oh yeah, here's a nice fan job right here. I love trading these fans. Again, start of the day right here, 9:30. Oh well, all your moving averages are really tight. I actually like to see that at the start of the day. I love when the moving averages are nice and tight. The candles are pretty close to it, because what that means is I will get some very clear direction. Well, what happens? So comes right here. First candle of the day sets. First candle of the day sets. Well, the first two candles of the day set on the 50, and then boom, jump up, start riding the 6. Maybe you say, okay, well, hey, we're gonna have a bullish day there. Well, keep in mind you're still nice and tight. And again, it's the first. In this 3-minute, first three or 5 candles of the day can be very deceiving. And let's just say you got in there around 310, and that's another thing too. An indicator for me is, where is the price at? Because when you start getting to the start of a number, so 300, or in this case 310.00, again, it takes some effort, some extra work to push through that little zone there. Really, it's that 310 or 3. Really, it's that first 15 cents. Breaking through that can be very tough. Whereas you look at the 15 cents below, 85 cents to the next dollar is very easy. I mean, that's pushed through so easy. But the next 15 cents is always tough. So from 0 cents to 15 cents on any dollar, in that case, that's what we had right here. We were right at 310, and yeah, it made its way. It actually made its way all the way up to 40. Was able to push all the way up to the 340, but it got stopped there. So anyway, let's just say hypothetically you're like, okay, you want to jump into a potential bearish or bullish market for the day. You jump in at right there at 300. All right, you're in. Well, once you see this candle come down, and pretty much engulf, for the most part, engulf where you're at. Boy, I don't know about you, but it's hard to stay in that position whenever you just ran up and then came right back down. So if you'd got out at that point, I would have totally understand. And then especially when you see this next candle, this doji candle, comes down here. Yeah, that would have been even more reason to possibly get out. And then right here, well, what do you have? It starts coming through and piercing through all the moving averages. Goes below the 30, goes below the 50, and at that point you definitely better be out. So, and at this point you better be looking at, because again you're under the 6 at this point. Again, our 6 is right here. You see how this candle, you see how that candle came up underneath the 6 at this point, and the 50 finished below the 50. Hey, you better be out of long positions at this point. So, and sure enough, what happens next? Candle comes up, uses the 6 and the 13 as overhead resistance, hits its head on it. Great entry right there. So, entering there right at 310, 970, and then it proceeds to come on down. Look at that drop, and you don't get a candle forming above that until 307.73. So, needless to say, that was a nice little $2 drop there. And again, let's say you held a position, wanted to see what it did with the 13. Well, what do you know? It jumps up on top of the 13. So, yeah, I would have been very likely to maybe sell another position there. But again, look at this. Nice wide fan. Very strong sign of a strong downtrend. So, let's say you did sell out there. Well, what proceeds to happen? Bam, you jump right back below the 6 and the 13. Well, for me, that's time to get back into shorts there, or puts. 307.69. Again, we wait for our next fully formed candle above the 6, or mostly formed candle. You get one right here. Yeah, so that's a nice what, $3 move right there. But again, holding on to a position, you want to see what it does with the 13. Well, continues on down. Yep, and you get a candle sitting on top of the 6 at 302. 302. That would have been a great place to sell another contract if you were still holding on to one. Once you see here that, again, what's starting to happen is your moving averages are starting to get tighter. See how wide they are here? Well, when you see how it reacts with the 13, look how much closer you're starting to get on these. Starting to get tighter. And the 6 is starting to run through them. Again, 6 runs through the 13, runs through the 21, runs through the 31 again. Showing a bunch of sideways, but again, keep in mind we're still below the 30, still below the 50. So what do we have? We have a what bias? A bearish bias. Yes, we are biased towards the stock continuing to go down until proven otherwise. And of course, what proves it otherwise? Well, when you start busting above the 30 moving average and the 50, then you get my attention. But again, the 50 was still downtrending all day long. So again, not only do you look where it is above or below, but which way is the moving average trending? Because again, whatever the direction is trending, that's, yeah, more than likely that's going to be hard to break. So, beautiful fan there. Again, just trading fans, man, that's a beautiful strategy just by itself. You just want to trade moving average fans. Yeah, I couldn't blame you there. Had one right here. Look at that. All your moving averages start fanning out, sitting on top of each other. 1, 2, yep, all of them. Get below the 50, get below the 30, underneath the 6. Very, very bullish, or bearish rather. And boy, you proceed to not drop nicely. So from the start of that drop, right around 314, you don't have a clear get out until to the end of the day. Nice little, what you got there? Yeah, nice $2 move there. So again, we're keeping an eye. Again, whenever we start looking at our charts, again, we want to see where is the stock in relation to the 50, and where is it in relation to the 30 for entry points. So, and again, we're using our smaller moving averages, our 6 and our 13, as precise exits. And you see on this day, look at the candles, how when they're under the 50, they're downtrending. They're above the 50, they're uptrending. Coincidence? Not at all. Not at all. So, again, the 50 is a serious buy and sell indicator. Again, look at here. Look when it's above the 50. And look how it tends to trend up. And which way is the 50 trending? Is it trending up? Is it trending down? Is it trending sideways? All things that you have to take into consideration. Yeah, so start of a day was right here. 9:30, the market opened. Well, what happens when the market opens? Well, first candle, middle of the 6. Well, you start having them start to run under the 6. That's a good sign that we're heading down, even though we're above the 50. We're above the 50, but again, the stock is starting to run below the 6. That's definitely not somewhere you want to enter a long position. At this, you're in a wait and see. Again, your moving averages are nice and tight. And again, when it starts the day with moving averages nice and tight is great. That's what you want. I hate when the day starts and it's already fanned out and way above everything or way below everything. At that point, it's, you missed a lot of the big move, and it becomes more risky to jump in, try to time the reversal, and then are you going to get a decent reversal, or is it just going to be sideways for the most part? So, but here again, that's what I want to see at the start of the day. Nice and tight moving averages. So I'm sitting here like a carnivore stalking its prey, waiting for the first sign of strong resistance or or strong bullishness or strong bearishness. And what do I get here? So again, it continues. The candles continue to dip under these other moving averages. Dips below the 30, uses it as overhead resistance. At that point, I'm becoming very much bearish when I see it dipping under the 30. And then what do we have here? Ultimate confirmation. Then it dips below the 50 and it's under the 6. That's a strong entry. Strong entry. But again, you say, well, the 50 is slightly uptrending. Well, yeah, but it's more sideways. That's not a strong uptrend. So I wouldn't be too scared to enter here at all. So entry right here, 313.35. And again, you're waiting for, again, your moving average is really tight in here. At this point, I don't know if I would have relied with having the 13 and the 6 so tight together. I don't know if I'd have relied on a fully or mostly formed candle by the 6 at this point because of that. And I would have been rewarded for it, sure enough. Bounces off the 13 because again, I mean, it's what's the difference between these? You're talking about 15 cents between the 6 and the 13. Why would I burn a contract on 15 cents? Yeah, and again, I'm still right here at break even, so it's not like I'm losing or anything. So why not? Why not give it 15 cents to just see what it's going to do in relation with the 13? Because again, right above the 13 is the 50. So you got the 13 and the 50 as overhead resistance. That's strong resistance, and the 13 is piercing, making a cross right through the 50 at that point. Again, strong overhead resistance, and you're rewarded for it. But let's just say you use that as an entry point. 313, yeah, 313.35. And again, you're waiting here. Again, the 6 and the 15 are, the 6 and the 13 are still tight. What's the difference between 15 cents? So when you got that small of a difference between the 13 and the 6, I want to see what it's going to do on the 13. Again, I'll give up 15 cents of potential loss to be able to continue with the downtrend. Because again, why am I have a strong downtrend bias? Well, what do I have? I got a fan. Look at them, nice and wide. It's like you're not bullish right here by any means. So just because it comes up here and you have one little candle jump above the doji candle, jump above the, or hammer candle jump right above the 6, yeah, I'm not bullish at that point. But then what happens? Well, you do jump above the 6 and the 13. 21 becomes overhead resistance. Then it jumps above that. And again, this is where I start getting very interested. What is it going to do with the 30? Because again, the 30 is my major, or my first major buy and sell indicator. Okay. 50, you want to say the 50 is the king. Well, the 30 is definitely the prince. So, but what happens? It comes up to 30, rejects, and continues its way on down. So, again, so you got in here 313.30, and oh man, look at the drop that you would have gotten. Of course, it came down here to a strong support level as far as buyers and sellers. Again, when we get to that, you'll see why I personally probably would have sold on this one. See how this huge wick down here? Probably would have sold right there. Or I would have sold right there, because that's, when we get to that part of the indicators, I'll actually have those lines on the chart, and you'll be able to see those for sure. So that would have been for sure an exit point, because I already know that is a strong level of historical support and resistance. A lot of buyers and sellers at that point. So that's needless to say, that's a monster move all the way down to over a $5 move right there. But worst case scenario, you got out here which would have still been a $4 move. You get one fully formed candle above the 6. So, and then from that point, again, you got to keep in mind, we're getting to the middle of the day. Things are going to slow down, volume slowing down. And our 6 starts running through, crossing through the 13, 21. At this point, sideways, be careful. Very careful again. What am I going to do? I'm waiting to see what it's going to do in relation to the 30 again. And sure enough, what does it do? Runs up to this 30, bam, hits its head. And yeah, then comes below the 6. Good entry point. Very strong entry point. Of course, you could have said when I have the second candle, major rejection candle on the 30, hey, I'm in. But say you want to be super conservative, want to wait till it gets below the 6. Right there, right at 310. And you proceed to come down a good $1.50 until you start getting some sideways and you start getting tight on all your other stuff. But again, what does it do? It comes up to the 30, hits it again, hits its head on it again, and then proceeds to come down again. And from that point where it hit its head, 309, all the way down to 307. Yep, $2 move right there. So, and then from that point, we see that it starts piercing up. What does it do here? Gets to the 30, hits its head. Whoop. Next candle comes down, and then what does it do? Finally breaks through. And then at that point, I'm saying, okay, what is it going to do in relation to the 50? Well, it breaks through the 50. Okay, at this point, the 50 is flat. That gives me a little bit more confidence in a uptrend. Now, if it was still downtrending hard right here and it tried to push through, it might be a very short-lived breakout. But again, it's sideways. 50 is sideways. That's telling me that, hey, this thing was willing to go above or below. There's not a strong bias either way. So, see it support, and then it jumps above the 6 right here. Hey, you want to enter there? More power to you. 309, right at 309, jump in, and then comes down. You have a candle form below, but again, look how tight the 309, 309.27, and then the 13 is 20 cents difference. Right here, I want to see what it, I just want to see what it does in how it interacts with the 30 or how it finishes in relation to the 13. And sure enough, yeah, it pierces through the 50, but where does it end? Yeah, you say, oh, well, it went through those. Well, where does it end? It's not about where a candle, it's not always about where a candle is during the 3 minutes, but it's where does it finish? Where does it finish? That's what you have to keep in mind. Where does the candle finish? When we have our indicator part on candlesticks, then yeah, have a little bit more clarity on that. So again, it comes up here, sits on the 13. Next candle sits on the 13, and then blast off. And then what do we start getting here? Get to the top here. You'll see this in the candlestick portion of the indicator course. Doji candle, red doji candle, red hammer candle, and then a big engulfing red candle or a bearish candle. Sorry, bearish and bullish are too close to each other. I mix them up sometimes. I apologize. I'm not perfect by any means. But anyway, so let's just say here, 1, 2, 3, you got in here 309. First candle below the 6, 310, so $1. So not bad there. And then from there, you start coming down, start running through moving averages, sitting on the 21, breaking through the 21, sitting on the 30, and then the end of the day. So I hope that gives you a little bit of insight. All right, here's a nice day too. Look, 30 or the 50. Tell me that wasn't strong support. And what is it doing? It's inclining. It's on a roller coaster up, and stock Stock rode it up. Of course, you have a lot of sideways, up and down in between there, but you see the 50 proved to be a beautiful, beautiful sport. Every time it came down, when it came down here and kissed the 50 and then jumped off of it, that's entry points. Comes down here, uses that as support, hits the floor, bam, jumps off of it, entry point. Why is that such a strong entry point? Because again, you're on an uptrend. You are on an uptrend, so you have a uptrends bias. So, and again, different time frames. Again, this it doesn't matter what time frame you're using. Nope. So let's look at one of the days that I hate the way it starts. Oh man, this one was great right here though. Look at this. Start of the day, candles the moving averages all tight. And what am I doing? I'm a lion just waiting for my prey to make a move so I can go after it. And bam, what do we get here? Get our first candle above, breaking above the 6 and above the 50, because at this point the 50 is sideways. So indecisive, not sure. I'm not biased towards any direction. I want to see what it does, and what does it do? Breaks above, entry point there at 3010, and it ends up running all the way to $1.50. Quick $1.50 at the start of the day. Worst case scenario, first candle below finish that finishes below 311. So even that's a nice dollar. And then from this point, we start getting a slight uptrend in the 50 and the 30 and all these. So again, it starts coming down, but yeah, am I quick to jump in short positions here? No, because again, I know it has a lot of things to fight through. It's got an uptrending 50, uptrending 30, all these moving averages. It's one thing to break through these moving averages. It's another thing to break through them when they're uptrending. So, and what does it do? Comes down, rejected off the 13, or uses it as a floor, and then continues its way up. And then here, the 13 and the 6 start getting really tight. So, and the 21, what does that signify? Sideways movement. Sideways. And man, this stock was jumping all over the place. Whew. Yeah, you want to talk about getting chopped up. But again, you could, how could you have prevented from getting chopped up? Well, again, you know that the 50 and the 30 is uptrending. So let's just say you just bought a contract at the end of the day or the beginning of the day, and you say, you know what? I'm not buying another contract until I come below, let's say, the 30. Until I have a candle that is mostly or fully formed and finishes below the 30. So at this point, 310. And again, you're just waiting for a candle below the 30. Well, finally you get one. Finally you get one right here. Top of it's 311.60. So again, you can even just use that approach. Again, waiting for the, sorry about that, waiting for the candle to go above, the candles to go below, or the stock to go above or below the 50 and the 30, and then yeah, stay in until, or at least save one contract until, because again, it'll allow you to catch all the uptrend. Because you see on this day, what was the most respected moving average? The 30. The 30 was very much well respected. So really, ideally, if you could have got in right here when it jumped above the 6 and all the other moving, 310, man, you could have had a potential peak of 312. So $2. And again, that's pretty nice. As we see that we go through the rest of the day, what happens? Well, moving averages start to get really tight, and then we finally do break below the 13. And then what happens? Oh, and also too, we're below the 6 at this point, but again, we're still above the 50. For me, I gotta see, because again, the 50 still still trending up. I gotta see what the 50 is gonna do in relation to the 50. I can't jump in at this point. I just can't. Too risky. Too risky. We're trying to minimize losses. minimize losses. So this is not an entry point. So, oh man, that's a huge red candle. And it's like, okay, yeah. But at the same time, this could have easily hit off this 30 and reversed up. Or come down here, hit off this 50, bam, reverse back up. But in this day, what happens? It stays below the 6. Look at that. Breaks through the 50, hits its head on the 50 here, hits its head on the 50 here, and hits its head here, and then comes below. For me, honestly, that's more my entry right there. I'm below the 50 and the 30. I have but again, you know, do I think it's going to be the longest lived downtrend? No, just because all the other moving averages are still, for the most part, above the 50. So let's say nice entry here at 311.18, and it ends up coming all the way down here to 3. Right, quick little dollar move right there. Then it jumps back above here, which really that would have been a 30 to 40 cent move if you were waiting for it to get back above the 6. So now at this point, I'm very indecisive. Yes, it jumps above the 6 here. Then it comes above the 13. But at the same time, like I said, I still got a lot of moving averages jumbled up here. I'm still below the 50 and the 30. The 30 is crossing through the 50. Yeah, honestly, I'm not going to jump into. Personally, I'm not going to jump into bullish positions at this point, or long positions, or call positions, because again, I got to see what it does in relation with the 30 and the 50 at this point. And sure enough, comes up here, hits its head off the 50, rejects again off the 50, comes below the 30. That right there, hits its head on the 30. That right there for me, that's a pretty decent entry point. But again, I'm midday, not a lot of volume, can't expect much of a move. And again, we're on the S&P, if you're on bigger moving stocks, Netflix, Nvidia, Tesla, stuff like that, these are huge moves. But on the SPY, yeah, like I said, I want to show you how to make money on the SPY, because if you can make money on the SPY, you can make money on any stock pretty much. Okay, it's one thing to be able to, a lot of people, I make money on these, big moving stocks. It's like, yeah, but can you make money on the stocks that don't move as much? Because again, if you can be precise with making money on these small moving stocks, then you can make money on the big ones, and you make even bigger money. So, but again, those bigger moving ones also cost bigger money to enter. So, contracts are not cheap on those, or the stock is not cheap. So again, if you can make money on a stock that, moving at 50 cents to $1, then hey, you can make a lot of money on the majority of the stocks in the stock market, vast majority. So that's that for this day. Again, when we start getting some sideways movement, we're above the 30. Rejected here, comes down. Like I said, you get a nice little dollar or so move, and then again, moving averages are nice and tight. We're below the 50 at this point, very leery. Then it pops above. Yeah, you could say, oh, I'm jumping in here. Well, at the end of the day, low volume. Again, all these things you have to take in consideration. Where are you at in the time of day? Where are you at in relation to the 30 and the 50? All these things, how tight are the moving averages together? Which way are they trending? All of these things, all these little pieces of the puzzle help you to get a clearer picture that gives you stronger resolve to get in, or sometimes the best position you can possibly make is not to get in a position at all. So sometimes the best play is no play at all. So that is that. Hope you seen some value here in the 50. Yeah, let me see one of these days that I hate. See if I can find one. Oh yeah, here's one. Oh God, I hate these days. Well, this is actually pre-market, but here's an example of it. Say this was the start of the day. What happens? Stock jumps way above. It's well away from the 6. It's like, man, what do you do at this point? Well, you gotta wait and see what it does in relation to the 6. Well, it comes over here. Okay, that's gets rejected by the 6. Okay, again, but we're still above all this. We got a nice fan, so we still got an uptrend biased. And what happens? Find support on the 13, and bam, starts making its way up. This is pre-market. Again, all these indicators working. Don't matter what the time frame. So here's the start of the day. First candle here. It's nice to be able to see this pre-market because again, you get history. You know that you just had a huge run up right here in the pre-market. Is the chances of you continue to have a huge run up at the start of the day? Not very likely. But you say, well, you know, the 50's uptrending right here. Well, it is uptrending. That it is, but again, you're going to realize you just ran a long way right here, and your moving averages are starting to cross through each other like crazy, starting to get tight. So find out what it does in relation to the 50. Well, what happens? It comes down here, hits off the 50. Well, I'm not going to lie, that's probably one. You have 1, 2, 3 of them hit off. I'm not going to lie, I would be very tempted to enter right there. 3, 14, 30, 34. And then I'm waiting. Oh man, look how tight all this is. Oh, very tight. This situation, I'm just waiting to see what it does with the 50. Because again, they're so tight. So 3, 14, 24, you end up running up $1. Running up $1. And then you fall back down here to the 50. At this point, yeah. 50 is starting to level out. So again, at this point, I don't have a bias. I'm looking for it to go either way. And sure enough, and what I mean by it being flat, right here in this area, the 50 starts getting very flat. Stops, no more hard uptrend. Again, this up in here, that was a hard uptrend. Right here, you're starting to flatten out on the 50. So, and then bam, you break below the 30 right here, and then go below the 50, and now you're below. And now you're below all the moving averages. What are you? What bias do you have? Downtrend bias, bearish bias. So, again, I need to start using uptrend and downtrend bias instead of bullish and bearish because I keep saying one for the other. So, all right. So now we get here, and bam, we're below everything. That's a great entry. 314.77. Ooh, and why the 77? Because again, it's below what makes it, just another piece of puzzle too. Like I said, as far as the value, the last 15 cents of $1 are very easy to break through. But then whenever you can get away from those, you can start. The stock is easier for it to fall down. So all these little things that. That make a little bit of difference. Can give you a little bit of insight, give you a little edge. But anyway, either way, strong entry right here. Strong entry. 314, say 70, and bam. Waiting for your next fully formed candle. Oh man, what does it come? Again, when we get to the historical support and resistance, or where you had historically had buyers and sellers, you would know that you come down here and touch this point, this 307 on the SPY. That's a very, very strong level of support and resistance. We would be selling here, no doubt. No doubt. And then after to see it wick all the way back up here, and then come here and then jump above this, yeah, you better have sold a contract by this point. Because again, hypothetically, you get 1470 all the way down to 30. Oh my goodness! I mean, come on. That's yeah. That is that's a monster move. Yeah, when you get to You get $7 moves like that. Please take some profit. Please. Then comes here again. Look at that beautiful fan. Oh, I love trading fans. So, and then what happens? Comes sits on the 6. But again, I'm still. You got your 50. What is the 50 doing? Downtrending. Okay. What's the 30 doing? Downtrending. That's my major buy and sell, or biased. I'm major biased moving averages. So again, I'm biased. I'm still biased towards a downtrend. But again, stock starts running up, finds support on the 6. Okay, that's a good sign. Then it finds support on the 13. Okay, not bad. You'll see whenever we do the indicator portion on trend lines that at this point we had broke a trend. Go ahead and give you a little preview of it right now. Look at this. All these candles were trending down this trend line. Man, breaks above that trend line, and yeah. So that's just a little sneak peek. Another piece of the puzzle that we'll be using as we go on here in the future. So again, I hope you can see that. Yeah, why there's never one secret indicator. Again, anybody that's trying to say you one secret indicator that's gonna, or this certain platform they got that's gonna tell you when to get in and when to get out. Well, unless they can. Now it's a system that can incorporate. I mean, there's just no way. Maybe 2. Maybe you could get away with 2. I could get away with 2 indicators. I could. But would I be as precise? Would I have the precision? Would I lose a lot more money? Yeah, I would. So, but at the same time, you have to find your own style. Do you have to use all these moving averages? No, you do not. Not at all. Will you need to use the moving averages coming up in the future in the court? No, you don't. Totally up to you. But if you want to be precise, very precise, you want these pieces of the puzzle. You want a bigger picture. You want to see the big picture. This is what you need. But anyway, again, on this day, it continues to ride up. But again, I want to see what it's going to do in relation to, again, the 13. We'll run through it. Okay, 21. What did it do? Okay, busted through it. Use it as support. And then the one, anytime I start uptrending into a downtrend, again, you're going against the stream here. The stream is flowing down here. All these moving averages flowing down. You're going against the stream, the flow. The 30 is always the one to see what it does. And then on top, and even more so the 50. What happens? Bam, comes up to the 13, rejected. Comes up to the 13, rejected here. And then finally has enough strength to bust above it. And then, well, what happens? Gets a hard rejection off the 50. So just when you think, oh, you won the battle with the 30, look who you got to fight through. A downtrending 50. So again, do you see why I'm very cautious? But you could say, wow, well, man, look at that. You know, say if you got in 310 here, you want to, that was like a $3 move there, man. That's okay. Well, more power to you if you want to jump in right here, or even here. You know, which if you'd have jumped in right here to a long position or a call position, yeah, you're not. You're risky based off moving average. You're a risky trader right here. Yeah, I mean, even jumping in right here, still risky. Because what happens? You get rejected right here. Bam. So, again, we're looking for very high levels of successful probabilities. We're trying to reduce our risk. Okay, because again, you can say, oh, I'm going to get in here, and it happens. Bam. But at the same time, if you're willing to watch it and get right back out if you see it going against you, So you said, oh, well, you know what? Bam, it's using support on the 6. It's heading up. Oh, support here. Well, hey, if you want to enter right here and be ready to exit at abandon ship at the first sign of major rejection, which really would have been when it hit the 30. So let's say you got in here around 311-ish. Yeah, $2 move up to the 30. Hey, but as soon as it gets rejected there, all I can say is all bets are off. I know I'm out. I am for sure out. And then right in here, it starts getting really tight, jumbled up. Yep. But when I see it reject off the 50 here, hey, I like that. Because again, what's the 50 doing? It's downtrending. And what's the stock doing? Downtrending. I like that match. That's what I want to find. So 313, falls below all the moving averages. Man, that's what I'm talking about. Yeah, all the way down to 311. $2 move. That's a high probability move right there. And what we get here, you even had a 3-bar player that even gave you even more insight that she was heading down. But then what happens? You jump above your 6 here. Now at this point, moving averages are getting really, really tight. Really tight. Your 50 starting to flatten out a little bit. You don't have near the downtrend that you had up in this area. At this point, yeah, I start getting a little neutral biased. And then what happens? It starts riding the 6, riding the roller coaster of the 6, and bust above the 30. Okay, that's a good sign. When I see it break above the 30, I start getting some uptrend biased. And then it breaks above the 50. Well, I'm definitely got some uptrend bias at that point. So at that point, you want to say you enter there, or same time, even if you entered right here when it busted above the 30 again, because again, 30 is a major buy and sell indicator. And again, the 30 was flattening out big time. See right here, the 30 had flattened out hard and actually started uptrending. And then you were also uptrending above the 6. That's a strong entry point right there. Now, granted, I would have been ready to exit really quick if it rejected off the 50. But what did it do? So you say you enter there around 312. Bam, you say, oh, bust above the 50. Money. Money, money, money. It comes up here, sets on the 6. And also, too, when I start seeing this island, that's another time I start getting very, very cautious. Especially after a big run up like this, I'd start taking very seriously. Taking profits. So, you get almost to right around a $2 move. Oof. Towards the middle of the day. Ooh, that's hard. Hard to ask much more than that. So, take some profit there. Goes below the 6. Definitely taking profit there. Then what does it do in relation to the 13? Well, it starts riding it, then breaks below it, riding it, break below, break below. Yep, sideways. Choppy. Moving averages all tight. 1350, all these. Yeah. All these are nice and tight. I don't want to mess with that. Again, I want to make sure, wait till I get some clear, concise. Again, you could have said here when it broke down here, came below the 13, came below the 30, okay? But at the same time, the 50 is right here. They're so tight, I got to see what it does in relation with the 50. Okay, it comes up here, hits its head on 30, hits its head, finally breaks below the 50. Hey, if you want to jump to a position at that point, I totally understand. Even though it's towards the end of the day, volume is low. Yeah. That said, say you jump in here 318. Oh yeah, well you ended up running almost. Yeah, a good 60 cents. Oh yeah, hey, we may be looking at a big downtrend here. But again, all your other moving averages are still, other than at this point, are still above the 50, and then start trending back up. So honestly, yeah, this one would have been right here. This would have been one where you'd be like, well, let's see what it does with the 50. Breaks above it there, uses support. At that point, you are definitely out. So, but for me, I'm close to the end of the day. Even this, if I get 50-cent move, which right here, I got right at a 50-cent move. I'm taking I'll take profit on a 50-cent move towards the end of the day in a heartbeat. Now you get the power hour, yeah, you get a little bit more movement. And what happens? Bunch of sideways, moving averages are all tight, not a lot of clarity. And then what happens? Bam. The stock starts comes below the 50 right here, below the 6. Okay, runs up, hits its head on the 30, bam, comes down. You start getting separation. You start getting the fan. At that point, 312.86, great entry. And then you end up coming all the way down to, yeah, $2 move. Ooh, very nice. Very nice. First fully firm candle right here. Still would have got a dollar move if you exited here. And again, very leery about jumping into going against the flow here, because again, you're flowing down, fan. You got your fan and it's flowing down. So yeah, that's that. The 50 moving average, again, I hope you see the value of it, because it's extremely valuable. Yep, extremely valuable. Check this day out. This was pretty nice. Look at this whole day right here. Day started here. Man, it's another great day. Look at this. Starts the day right there. All the moving averages nice and tight. And then what do you get? You get an explosion off the 50. It's totally understandable if you'd want to wait for another to see how this played out. So it comes down here, doji candle, see how it reacts with the 6. Okay, at this point, once I see it starts staying above the 50, getting above the 6, ooh, strong entry right there. Right at 299, 299.90. I got to be in at this point. I'm getting my fan here. I'm on top of the 6. Shoot, that's it. Oh, and then you end up running all the way up to 301. Yeah, that's what I'm talking about. $1.50 right there off start the day. Yeah, start the day. And then starts coming back to the 6. Breaks below it. Okay. Hits its head on the 6. Hits its head on the 6 here. Hits its head on the 13. But again, we're uptrending. So we have an uptrend biased. Again, right here, we're fighting. We're fighting through an uptrend, moving out. So again, yeah, if you want to get into a short position here, you can. Always hitting its head on the 6 and the 3rd. But just be prepared to get out real quick. Because what are you waiting to see? You're waiting to see how it reacts with who? Mr. 30. And what does it do? Bam, hits off 30 and continues its way up. That's actually a good entry point. You see it hits off of 30 there, 299.68, and then bam, you don't get another mostly full until right there. Right at 302. Oh yeah, $2.50 move. That's very nice. But again, starts coming down here. Again, you're working against the flow. Okay, everything's flowing up. Swimming against the flow right here. So very cautious about entering short positions. Put positions. Don't fight. You're better off. You'll make a lot more money in the long run if you don't fight against the flow. Well, sure enough, it comes down here. Yeah, you could have got a little bit. Fights against it, but who does it get rejected by again? Mr. 30. Rejected hard, and 3 candles of rejection, then jumps on top of the 3rd. I'd say that's a pretty nice entry right there. $300. $300, and then let me see, where does it go to? So here, see how it reacts with the 6. But again, the 6 and the 13 are so tight here, so I'm not looking at this and say, oh, well, that's a mostly formed candle above the 6. No, the 13 moving average is 20-30 cents away. Again, I'm seeing what it's going to do in the 13. The 13 becomes becomes a stronger indicator. Now, when they start getting, spreading out, when you start getting some nice separation between the 13 and the 6, then yeah, then the 6 is a great exit moving average. But this one I'm using 13, and I was rewarded for it. Because again, say from here, 302, bam, look at that. That is a nice $2.50 before it breaks below the 13. Okay, when it breaks below the 13 at that point, yeah, I'm definitely selling some contracts to say the least. But again, what am I waiting for? I'm waiting to see what it does with Mr. 30. But again, look how they're all getting tight here. You're getting towards the middle, end of the day. I already know that, honestly, hey, I'm thankful for this awesome gain I just got right here. The sideways stuff, you say, oh, well, it broke below the 30. Well, just because it breaks below the 30 for one little candle here, who does it get right below it? Yeah, and then there, because that's, yeah, not a lot of 60, 70 cents to go to the 50. We say, well, I'm going to jump in here and see if, because I've done this before, I'll jump in, especially when it starts getting more sideways here. I say, oh, okay, well, I'm going to jump in. I'm going to take a quick profit here, because a lot of times what will happen is if it does break to the 30, it'll run down to the 50, bam, reject. So what I do is I got a position right here, and as soon as I see it even blink its eyes at the 50, I'm out, just for a quick profit. And then as the day goes on, nice and tight. All the moving averages are nice and tight, but again, we're still uptrending. We see the 50s uptrending again, so we're biased. We're working with the stream, okay? Working with the flow here. Well, what ends up happening, bam, you get a big old candle and it breaks above all these. So about right here, if you want to jump in this position right here, more power to you. Especially 304.90. I know at least it's going to go up another 20, 30 cents. So, because again, once it gets into that 85 cents to the next dollar, it jumps through it so very rarely you're going to have a stock get into the 80s or the 90s and not bust into the next dollar for at least a little bit. Yeah, at least 10 to 15 cents. So at this point, 304.90. Look at that move. That was a nice move. Yeah, really nice move. And really your first sign to get out right here, 307.70. Yeah, $3 move there. Yep, very nice. Very, very nice. And as you'll see once we get to the trend line indicators, look at the strong uptrend you had. Look at that. Support here, support here, support. But you'll see that the 30 acts as a strong trend line as well. So that's another piece of the puzzle that we'll get to down the road. So this video was long enough. I hope that you appreciated the 50 moving average and why it is such a valuable indicator, and why use it intraday, daily, whatever it is, time frame. I always want to know what the 50 is. But again, the 50 by itself, I've seen a lot of people that just use the 50, just have the 50 on a chart and say, yeah, that's okay. But you're not going to be precise with entry. You're not going to have a lot of precision with entry and exit with a 50. Again, it's just one piece of the puzzle. Now, it's a very, very important. It's a big piece of the puzzle. But do you get a full picture from the 50? No, you're not going to get a full picture. So just keep that in mind. I hope you found a lot of value. Again, this works on all the time frames. I know I just did the 3-minute in this one because it's like, okay, I've already seen this a gazillion times, and you can test it for yourself. 3-minute, 5-minute, 15-minute, 2-minute, whatever you want. You'll see how well the 50 is respected. So again, thanks for joining me for this part of the precision indicator course. Sorry if I repeated myself 1,000 times on anything, but I hope I just want to really help ingrain some of my thinking when it comes to trading, because yeah, I've been pretty successful to say the least, and I'd really like for you to to enjoy some of that success yourself. So that'll do it. Our next moving average, one more moving average to finish out the moving averages in the precision indicator course. That moving average will be moving average number 65. So look forward to seeing you back for our next part, moving average number 65. Welcome back to the next part on the precision indicator course. In this part, we'll be going over another moving average number 65. Go ahead and get that put up on our board here, on our chart rather. And I like to go with a lighter gray for my 65 because I just don't like for it to stand out. Anyway, yeah, I try to ideally I try to keep things as clear and concise as possible. But anyway, so you'll remember from our last video we discussed the 50 moving average, how it was such a strong buy and sell indicator. Now the 60 moving average is not that. The 65 is for me just a nice little guide because it does, for me it's almost kind of like the last line of defense in a sense. And anyway, so I just wanted to just show you that a little bit throughout history. Again, we see during our big drop or the crash of 2020, I mean the 65 wasn't doing you any good in a lot of this crash. So but let's look at what it's done, what it's looked like throughout history. And to be honest with you, it's not that far away from the 50 as far as moving average. So you see how they're pretty tight here. But let's go through here and let's see some examples of just why through my back testing I did appreciate the 65. So we see right here the 65, you got multiple days right here using it as resistance and support. So it's respected. We see we had a candle come up, broke through the 50, but rejected at the 65. Had a candle come down here and sit on the 65, or a candle wick. We see that had some come down here. Candles came down. They broke through the 50, but still set on the 65. Didn't go very far. Again, seeing what I'm saying for like a last line of defense on a major trend. And of course, you got all kind of sideways crazy movements in here. 65 isn't going to do you much good in that situation. Came down here. We actually broke below it. Yeah, you don't see that. You don't see that very often throughout history of an uptrend. We see here, came down between the 50 and the 65, found support right here. The 60 stopped it here. You see all these days right here, it ran right up on top, broke through the 50, but then just ran right on top of the 65. So again, whenever I have a pretty, a decent trend in line, see all the moving averages are trending up here, and then I have a break below the 50, it's just, again, like I said, it's just the last line of defense. Okay, what's it going to do with the 65? And if she breaks through that 65, all bets are off. Prime example right here. Broke below the 65, came and hit its head on the 65, and bam, big drop. Big drop. But again, keep in mind, 65 isn't going to do you much good whenever you have a lot of, craziness back and forth, that kind of thing. And again, keep in mind, we're on the daily. Let me see if I can find some other situations here where the 65. We see we came below the 50 here. Actually came below the 65 for a couple days, and then came back to it and jumped on top of it. Needless to say, if I, you had to take a moving average away from me, I'd give you the 65. But at the same time, I still like it. It's still not something I like to have on my charts. You see right here in this uptrend, nice uptrend, you get a candle that comes down, sits right on the 65, and then finally breaks below it, and then down she goes. Right here, see candles break through the 50, come sit on the 65, come right here on the 65, on the 65. So as you can see, it is a respected moving average. See right here, they come up, hit their head on the 65, hits its head on the 65 here, here, and then supports off of it. See right here, it comes down, sits on the 65, gaps below it, hits its head on it, and then finally uses it as support right there. So again, I always like moving averages that when candles get to them, they, not every time, but a good chunk of the time, they react to it. You see right here, candles as it was going down, candles came and set on it, candle there, candle there, candle there. So again, for me, that's when I see that, that's it's pretty strong incentive for me to get it on my indicator list. See here, came down, set on it. So yeah, I like the 65. It's not a world-changing indicator, but again, as you get higher and higher on the indicators, you got to realize they're just not as useful. All these people that, the 200 moving average. It's like, okay, if you want to trade based off of the 200 average, that's fine, but yeah, is a 200 or the 150 moving average, I mean, how can you say that that's more valuable than any I wouldn't trade any of these moving averages that we went over for a 200 or 150, so it's, yeah, but hey, to each his own. Like I said, I like to see moving averages that are useful day to day or even week to week and that are highly respected. Like this 50 right here. Look at that. Look at all them candles just wicking and sitting on it. That's respect. So back to our 65 here. So yeah, I think we've seen enough as far as the daily. I don't know let's see with the weekly. Oh yeah, look at all those years. Let's see what we got here. See what our 65 looks like on the weekly. How much respect do we have for it? Well, it comes down there, wicks on it. Pretty much here, the 50 on the weekly is the man. Yeah. Don't mess with 50. Yep, 50 is a great historical indicator. We see through these years right here. 65. Support. So, like I said, I wouldn't be making a living off the 65, but still nice to know about it. Now let's move it down to a time frame here. We're at 3 minutes. See what the 60 looks like on that, and you'll see it runs pretty tight with the 50. But let's see some examples here where we could use it as a piece of the puzzle. Granted, it's a small piece of the puzzle, but it's one of those puzzle pieces that are definitely definitely doesn't hold a lot of value in the whole picture, but it's still there. But anyway, you see some instances where here it comes down, breaks through the 50, bam, comes and sits on the 60. Start of the day, bam, comes down, hits the 60. Let's see here on a fan. See how these stocks run up and hit the 60, right on it. Yeah, fans is where when all the moving averages fan out, that's when the 60 becomes a little bit more useful, because prime example here, everything fanned out, the stock started coming into it, broke through the 50, like, oh, okay, well, hey, let's start buying put. I was like, well, no, bam, rejected hard by the 65. Hard rejection. So, where is some other examples of our 60? Right here. Oh yeah, moving averages fan out. When it finally starts breaking into it, breaks below the 50, hey, yeah, let's jump in on puts. It's like, well, last line of defense, 65. Sure enough, the 65 held its defense. So, just when you break the 50, it's not always green skies from there. Okay. What else do we have here? And again, I hope y'all appreciate the fact that this is not staged time frames, screenshot certain days and certain time frames just to make everything just look just right for your particular indicator. No, I'd rather just give it to you straight, or show it to you straight, one or the other. And let's see here. Now here's the day. So it breaks out, fans out, comes back into it, and you're like, okay, all right, looking good here. Oh yeah, jumps on the 30, getting bullish. Man, jumps above the 50. Oh yeah, bullish time. Hard rejection at the 65. So again, like I said, it has some value. It definitely has some value. So it's why I like to keep it on my indicator, my charts. Prime example right here. Another example comes up, busts through the 50. Oh yeah, let's go. Get all excited and boop, rejected. But at the same time, the 50 was downtrending, so it's, again, you're wanting to buy into calls or long positions on a downtrending 50. It's risky. And then its rejection at 65 was proof of that. So again, just use the 65 as just a nice reminder that just when you think you broke the 50 and it's time to jump all in, well, just keep in mind you got the 65 to contend with. But hey, you get through that 65. Oh yeah, more times than not you can feel very, very confident in some good movement from that point. So anyway, that's the 65. Again, no point in beating this moving average to death here. It has shown us what value it has. So that'll do it for the 65 simple moving average. Got one more moving average that I feel is similar to the 65. Doesn't offer a lot of day-to-day value, but it's still one that I've found historically is quite respected. So that's going to be simple moving average 105. So 105. So look forward to seeing you back in our next part on the precision indicator course. Welcome back to the Precision Indicator course. In this video, we'll be going over simple moving average, number 105, and I cleared the other moving averages off because, yeah, they just kind of be in the way. And again, the 105 really doesn't build upon those. It's just, again, a nice historical moving average to take into consideration. Again, why the 105? Well, because I back tested it against, a lot of people. It's, they want to go with the 100. The 100. It's like, okay, well, why you go with the 100? Oh, because everybody else is like, okay, well, have you tested it against, the 102 or the 104 or the 105 or the one to see, if it's one, if the 100 truly is the most well-respected, time frame. And for me, that's what I've done, and that's why I have the 105 versus a 100, because it's just, and I'll give you a prime example of that. Let's tell you what, let's put the 100, some extra teaching here. I'm going to put the 100 and the 105 on here. Again, it's not going to be a major difference, but you'll see a little bit of the difference between the two. Okay, so stock market crash. Again, both of them nice and tight right there. And we'll see through history why I feel like this is a pretty well supported moving average. You can see once these candles get through it. Again, you always know it's a pretty tough moving average when it's got a gap over it. That's always a telltale sign that, hey, this is a strong support and resistance level. When you see gaps over, substantial gaps are over or above it. So we see here, see a gap below it to get below it, and then comes up here, and then gaps through it back up. So, and then we see here, coming through here, bam, has to gap over it to get down it because it's very tough. And then here it comes and sits on it, wicks on it, wick, or sits, wick, sits, sit. And then bam, has to gap above it. And then proceeds to sit on it and then gap right back up. And also too, as a reminder, focus on my big crosshairs. So right there, that should be telling us, hey, that's pretty strong. Okay, so here's a little bit of a difference between the 105. Again, our 105 is red, 100 is black. We see here we got the wicks. The wicks sit on it here, but the top of the candle's there. So far we'll say it's 50-50. Let's see if we can break down and see which one's a little bit more value. Oh, let's see here. Here you have on the 105, candle comes and sits right on top of it, right below it, and there. And then you have one that sits right here on the 100. So the win goes to 105 over there. All right, and again, look at this. The stock comes up to it, bam, hits its head, comes right back down. Comes up, hits its head, Again, that's respect. Yep, that is very good respect. Okay, so another example here, comes down, support, all of this. Look at all these candles just hitting off of it. Yeah, that's a pretty strong confirmation there. Okay, so let's see here in this area. All right, so just a little differences between the 105 and the 100. Look here, candle comes up, hits right on the 105. Let me get my line off of there. Another example here, candle comes down, sits right on the 105. All right, another example here, comes down, wicks right on the 105. So that's about a 50-50 right there between the 105 and the 100. But again, you see all this respect. That's the main thing here to focus on, is the major respect that the 100 gets historically. Again, comes down, wicks off of it. Look at all this trending. Again, the 100's trending up. Strong bullish sign. We'll get here. Look at all these candles. Just wicking off of it, sitting on it, wicking, sitting. I mean, that's some major support and resistance there. Okay, another example here. Okay, look, there's actually a little bit of, that's what I like, seeing a little gap between the 100 and 105. And what do we have here? Look, for the 105, the wick comes down and sets on it. Next candle comes up, hits its head on it. Again, that win goes to the 105. Right here, well respected. Tie. Right here, again, candles come up to it. Right here, slight edge to the 100 on this. Yeah, slight edge to the 100 here. The wick hits it. But again, you see all of this respect the market has. Look at all these candles coming and sitting on it. Sitting on it or rejecting off of it. I mean, that is respect, my friend. Okay, what do we have here? I don't have this candle come and sit on the 100, but then this one comes here and hits its head on it. Here, these come down and wick and sit on it. The wind goes to the 100 there. Oh, look at all these candles that just come and sit and wick off of it. Here you got a candle wick that hits it and sits on the 105. That battle goes to the 105. Oh, look at all these candles. Bam, comes down, sits right on both of them. Yeah. Nice support. 100. A little bit more respected than the 105 here. Again, look at all of that. Look at all of that respect. Here, candle wicks off the 105, hits its head on 105, wicks onto 105. 105 wins that one. Look at all these candles just sitting and wicking. Yeah, but to this point, very close race with on the daily time frame, that is. Very close race between the 100 and the 105. Very tight. Here comes down, wicks on the 105, wick on the 105. Slight advantage to the 105 there. Again, the main point is, look at all of these instances where it gets to the 100 and 105, and then the stock reacts to it. Candle comes down there, sits right on the 100. Slight advantage to the 100 there versus the 105. Here, both candles hit the 105. Slight advantage to the 105. Here, right here, a little bit more respect for the 105. Tie here. Tie. So again, you can see a lot of respect for the 100 or the 105. And again, when you see which way it's trending, the stock tends to really follow it. And then when it starts getting flat, notice how the 100 and the 105 starts getting flat on the daily. And you start getting your sideways choppy stuff, downtrending, bam. Yeah, and then so that's something to keep in mind too. What is it? Is it flat? Is it inclining? Is it declining? All things you have to look at. But again, that's the, I think we've seen enough on this. That is the 100 or the 105. Let's see what they look like on the intraday. See what we got here. And here's our first example of it. Look, sure enough, comes up, breaks up, bam, hits its head on the 100, 105. Let's see some more examples. See, here it comes here, wicks on it, sits on it. Again, this on a day-to-day basis is not going to be as valuable. Where I tend to like a lot of the value from it is at the start of the day. At the start of the day, because you ever seen those candles just run up out of nowhere, or you run hard up or run hard down? Well, a lot of times, when they run up like that, they end up hitting their head on the 100 or the 105. Yeah, it's quite interesting. So you see a stock running up like crazy or running down like crazy. In this instance, here, let's get our 50 on here. Let's get our 50. Let's do it in blue so we can have a contrast. So yeah, which in this case they were really tight to open this day right here. The other thing to look at is when you see the 50 cross the 100. That's usually a pretty telltale sign that you're gonna get a nice little trend change. Here's a prime example of it. The 50 runs through the 100, drops like a hammer, and then when they start getting tight, look for a possible trend change or just sideways movements. Another example, 50 breaks through the 100 and starts a decent uptrend. Oh yeah, here's another prime example. Start of the day. Comes up, oh yeah, you think, oh man, it busts through the 50. It's gonna be a day for the bulls. And what happens? Boop, runs up and hits its head. So something to keep in. Again, I love using the 100 or the 105 at the start of the day. Yeah, it's great. Great, because you get those crazy volatile moves right there at the open. And it more times than not, if I see it get rejected hard off of that, nice, can be a very nice entry point. And here too, what do you have to look at this point? You say, well, the 50's downtrending. It's like, well, if the 100 or the 105 is downtrending too, so it's like they're really gonna break through the downtrend of the 105. That's like, ooh, that's tough. Very tough. Let's see what else we can find. Oh, here's another 50 and 100 cross right here. Look at that. Proceeded but into a downtrend. Then we get a lot of choppy. What do we get? Crossing back and forth through it. Choppy. But you can see where they're very, the 100, again, our 100's in black. See, the top of the candles are running. The top of the candles are hitting on 100. The bottom of the candles are running on 105. In this instance, you had a little bit more respect for the 105. More candles and wicks wicking off of it and hitting off of it. But again, it's tight, very tight. So again, I'm not going to fault you for using the 100 or the 105, one versus the other. Let's see here. See examples here where it breaks through the 50 right here, and then sure enough, what's it do? The wick hits right on the 105. Yep. Here's an example. Breaks through the 105, but comes right back to it. Yep, didn't last long. Okay, let's find another. Oh, here, prime example, comes up to the 105, gets rejected hard. Here, comes down, rides, supports on the 105, breaks through it, and then rides sideways, because again, it's the 105 is getting horizontal here, but then bam, what do you have? You have the 50 bust through it, and then from that point, like a hammer. Here, what do we have here? The 50 breaks through the 100, and yep, crosses through, heads its way up. So again, it's a really nice one to look at for crosses through the 50, and again, like I said, looking at for the start of the day. Okay, let's see what else we got here. So start of the day right here, interesting. Comes down, jumps up off the 50, blast all the way to the 100, hits its head on it, and then breaks above it. That's quite interesting there. Yep. That's an interesting day. Here they cross and continues down. Get a big cross here. It was short-lived though. But again, this was the start of a day. You know, your first candle jumps way up here. Next candle, and then comes down and yep, stays below the 150 for quite some time, or the 110 or 100. Sorry, dyslexia. Okay, start of the day. Trying to give you a few more decent examples. Ooh, so we got a hard cross right here, preceded by strong uptrend. Didn't cross again all the way up here. So yeah, I mean, hey, if you wanna, you could make some decent money just playing crosses on the 50 and 100. Let's see here, we got a cross here, and then bam, nice drop. So I hope that you're seeing some of the value of the 100 or the 105, whichever one you choose. See, on this day, it broke through the 50, bam, came and hit the 100. But that was you can even use these for swing purposes. The 100 and the 100 and the 50. Especially if you go to a little bit bigger time frames, like the hourly or something like that. That can definitely be used for swing purposes. Alright, so we see here, it breaks through the 50 and then hits its head on the 100. Let's see here. Here's a nice competition. Got some separation between the 100 and 105. So what do we got here? 100, 100, 105, 105, 105. Yeah, they're just, they're so tight. I mean, this one, yeah, it's 50-50. I mean, they're just pretty much either the wick or the candle hitting off of between the 100 and the 105. So, yeah, it's a very tight. It's just, I've just preferred the 105 a little bit over time. But hey, somebody makes me use the 100, I'm not going to moan and groan about it. So that is the 100. Let's go to, tell you what, let's check out an hourly. Just to see what crosses. Tell you what, let's see if we can get this extended hours junk off of our. Okay, so hourly here. Bam, cross between the 50 and 100, preceded by nice drop. Okay, get a cross here. Not a hard cross, but cross nonetheless, and boom, look at that run up. And again, you're using this using this with the other indicators. Oh yeah, take for instance, let's throw that's my 30s blue. So we're gonna turn that blue, and I'm gonna add. I'll tell you what, we're just going to. It's a very. Since most are more comfortable with the 100, we'll change that one. Change this one to the 50. Okay. Now, we have the 30, 50, and 100. Now, let's see how, let's look at a little swing strategy we could do here. So, using the 30 or the 50, once it crosses the 100 as an entry point, and then we use the 30 or the 50 as exit point. So, how many days with this? Like I said, when they get real flat like this, yeah, I like to see. You see here where the cross is harder, especially with the 30 and the 50. You get a harder cross right here. The 50 and the 100 just kind of kiss each other and continue on. But let's just see there, say right here, really you're waiting. Another strategy you could do is wait for the 50 and the 30. Once you get confirmation for both of them crossing, then you're in. Because right here, your 50 really didn't cross your 100, so it's like, the 30 did, but the 50 didn't. So we want to wait till we get a nice cross or a nice separation between the 50 and the 100, and so you see right here, you start getting it. Yeah, and then right in here, the gap gets even bigger. And of course, look at all these candles just riding on the 30. Man, I love my 30. Oh, anybody that says they like the 20 more than the 30, I'm like, you haven't back tested very much. So, again, we're looking at this for a swing strategy. See what else we got here. Alrighty, man, let me see if I can get more of my candles to show up here, or more days. Okay. Go back to the hourly. Again, we're looking for big crosses. Alright, we get one here. Look at that. Really, the 50 and the 100 cross here. But get across with the hard cross right here with the 30 as well. Led to a nice drop. So yeah, let's look for some other hard crosses. Again, we just looked at this one a second ago. The 50 came down and kissed it, but then you have the 50 and the 30 break through the 100. That would have been a great swing trade. So you got in here 297 and didn't get out until either break below the 50 or the 100. Let's just say at this point 320. 320, you start getting the candle starting to break up underneath. Yeah, I'd say that would have been a $20 swing trade on the SPY. Yeah, I'd say that's pretty good. Hard to complain on that one. Okay, here, let's see here. Next swing trading opportunity. All right. It sure would be nice if I could get more days. Alright, let's see. You gonna give me more days? Come on. Only wants to take me to April. You not so nice chart. But anyway, well, either way, our cross on this for this swing trade would have been right in here. This would have been where the cross was on where the 30 and the 50 would have crossed right about right here. And so the entry point there would have been around right there, 266. And you were waiting for a fully formed candle below the 30. You got one there. So $10, around $10 move there. But again, it didn't cross through the 100. Didn't cross back through the 100 until 280. Yeah, quite a good swing trade right there. Yeah, that's quite impressive. So again, that's another swing trading strategies. Of course, we'll go over more of those with the use of some other indicators. But yeah, unfortunately, my time frame here only wants to give me only goes back a few months. But anyway, I've gave you the basic idea of it here. Again, we're looking for crosses by the crosses of the 50 and the 30 through the 100. And when you get that cross, especially both of them, the 50 and the 30 crossing through, yep, entry points, and then using the 30 or the 50 as an exit point. So, pretty nice strategy there. So anyway, you really just have to test it out, see what you like the most, see what works best for you. But either way, I'm giving you some pretty good tools here. I hope you're appreciating the precision of these indicators. And as of right now, we see a prime example where you notice too that you don't get a lot of distance between. When you start getting a lot of distance between this 150 and 130, get ready for a change. Yep, get ready for a change. Anytime you see those big gaps, you have a telltale sign. So, and on this instance right here, we see, of course, our 30 ran through the 100 faster, but let's say we were waiting on the 50, using the 50 as the primary cross through there, and let's say right around here 311, and we got a cross there, and we would still technically be in this trade down to 300. So $10 swing trade. So yeah, there's your nice swing trade special. Hope you enjoy that, and I hope you enjoyed the 100 moving average and seeing the benefit of that. I know the 65 and the 100 is, didn't have all the fireworks, but you see here with the 100, you definitely get some nice swing trading. Yep, some nice swing trading possibilities to look at. So, and again, you got all the different time frames to consider. Yeah, this was a monster swing trade on the 2 hour. Take for instance here, you see that the 50 would have crossed down here, so really 265. This is on the 2 hour. You didn't get across. You haven't got across from right here. You got across. You got across on the 30 and the 50 on the 100 right here. So that, needless to say, that was you're using that for the 2 hour for the swing trade purposes. Yeah, needless to say, that was yeah, around a $40 move. Again, if you're using just solely using the 100 and the 50 as cross using an entry as crosses. So again, just play with it, see what works best for you. Again, that's the way to do it. So anyway, I hope you appreciated the value in this video, and enjoy yourself, and we will see you back for our next video. This finishes up our moving averages. Yeah, this is we're done with the moving averages. If you like the 150 and 200 and all that kind of stuff, hey, more power to you. I just don't I don't get enough value out of them, so they're not in here. So with that said, we'll be moving on to our next precision indicator, which will be the RSI. Well, just kidding. I know everybody loves RSI. Nope, we're not going to have an RSI in this. There's plenty of videos out there on the RSI, but it's not, yeah, I just personally don't like it that much. But what I do like, and what will be in our next video, is the CCI commodity. So anyway, look forward to seeing you back for the CCI. Yeah, it is, other than moving average, it's my first and foremost indicator to use. So we'll see that one next time for the Commodity Channel Index, CCI. All right. Thank you. Welcome back to the Precision Indicator course. In this video, we will be focusing on our CCI, Commodity Channel Index indicator. Already got it pulled up for us here. Now, the CCI is a very commonly used indicator. Now, what I've been able to find out through back testing and tweaking is to get the most out of this indicator. Now, I'm going to show you some of the details on it. So for our CCI that we're doing, the standard comes with a 20 period average. Okay, so that is not an optimal average. We're going to go with the 30. Okay. The other thing we will have to adjust, we have our overbought and oversold territories. It's very simple. Overbought, that means the stock is overbought. It's getting to the point where it's ready to come down. This is signified by the top gray areas. When we get into this top gray, that's overbought. The other one, oversold. When we get to oversold, the stock is due to go back up. All right. See right here, down here at the bottom, negative 100. Anything below negative 100 gets you into oversold territory. Of course, we're not going to use 100. because it's not optimal. It's not the most precise overbought territory. 70 is much more precise. So that's our settings for the CCI that you want to implement on whatever platform you use. So let's begin. Now the things we want to look for, again, we're using the CCI to give us some insight on when we should enter a trade and when we should exit a trade. Now it's very, very simple. When CCI is entering, when it hits 70, it starts entering overbought territory. Okay? But overbought territory at the start of it is a good entry for long positions or call positions. Another area we can enter for long or call positions is when it leaves oversold territory. So when it's leaving this oversold, we want to be in long positions. So again, the two instances to get in long positions or call positions is when it's leaving oversold or when it's starting to get in oversold. Ideally, the best to catch it early, but worst case scenario, you get in here when it first starts getting into that territory. Now let's see the results of that. Now we have the crash year of 2020. Let's see what we got. Now, as soon as this dips out again, as soon as it starts dipping out, goes below 70, we want to start looking to what? Short the market or buy puts. Well, we got the signal on this day, $334 or $335 rather. The CCI told us to start looking for put positions to short the market. Okay, and we see here that it told us to stay in that position because again, as long as it's in this, as long as it's below negative 100, it's telling us to stay in the position. We don't get out of the position ideally until it comes out of this oversold territory right here. So from that point, 335, CCI told you to stay in the trade all the way to this day, 242, almost $100. That is a massive move there. And again, it told you to get back in, or told you to get in long positions or call positions right here, and that was at 242. And then it told you to stay in the trade. Now this is where it gets tough, where it comes down here right at the 70. We see how it dips down right here. Again, focus on my big crosshairs. Again, it comes down here, just touches the 70. Yeah, no, I like to see it get below that barrier a little bit more. But let's just say you had a contract that you wanted to sell. Hey, more power to you. You want to sell one of your contracts there? Hey, take some profits, please. So 242, 243, and you didn't get a sell point until 275. So yeah, I'd say 30 points is pretty good. And again, this is on the daily. Again, this is a great swing indicator. It's good for all time frames. So if you just want to be somebody that can just set a trade, well, you say, okay, well, it's leaving the oversold territory. Well, I'm going to enter my trade, somewhere in here, and then I'm not going to exit my trade until it starts heading back down. Now, you may say, well, what about instances where it'll go up and it starts coming back down? We're going to cover that because again, it doesn't always for sure leave oversold and go to overbought. So we'll go over that a little bit more here in a minute. But again, we see here The next sell signal we get right here, really just 1 day. It leaves it for 1 day, comes right back into it. Okay, and then we see here we go on. We leave it for 1, 2, 3 days. But really, whenever we start seeing a V, when we start seeing a V in the CCI, we need to start preparing to get back out of that position. So let's say you got in your position here at the start of the overbought, 278, 279, and let's say, okay, you stayed in all the way. Well, so you got out there, sold a contract there, still a nice gain. But then really right here is where you're like, okay, all right, I'm going to get out or sell my positions. But then this next day, you start getting a V in the CCI. All right, this day right here makes a V. When you see a V, when you start seeing a V, be prepared to get out of the position. But what's nice is the CCI is, let's just say you got out right around here, and then the market turned around. Well, you can get back in. More times than not, if you have a quick change of direction, where you entered, you can re-enter the trade, or wherever you exited. If you exited right here, you can re-enter almost at the same price. So that's always really cool. So, well, you get, again, you could have said, well, I'm getting a V right here. I'm going to go ahead and get back in the market, and you would have been, well rewarded with a nice gap up there. But let's just say you waited till the next day. It got into overbought territory at 293, and then you didn't get a signal to get out of that trade until right here, 302. So a nice $10 move. Okay, and then from that point you say, well, I'm out of the market, or I'm out on my long positions. Well, what do you know? Comes up, gets back into oversold territory, spends a couple days there, and then it's out. And from that point, the market has been going down, and the CCI has been going down. So, great indicator. Let's look at a few more instances here. So here's a prime example where it goes up, it leaves this oversold territory, and then what happens? It starts making a V. It's kind of a wide V, but it makes a V. Then it makes another V, and then back down. So again, when you start seeing the V's, in the CCI, just be prepared that you may have to get back out of the position. Okay. So just be prepared there. But what's nice about that is, let's say you exited the position here, 290. Okay, all right, it's heading up. I'm in. Say you got into long positions and changed directions, came right back down. You could have got right back out of the trade. As soon as you see it went back into oversold territory, you could have got right back out of the trade for break even. So anytime it change directions on you real quick, more times than not, you can get out of the trade for break even. Okay, but let's see here. All right, we see we came down into oversold, spent 1 day, started heading back up. Well, let's just say you wanted to enter the trade at that point. Okay, I'm getting in right here, 290. Well, you didn't get a sell signal on the CCI 30 again until 309. So that really nice $10 move there. So of course, before the crash of 2020, hey, the $10 move on the S&P or the SPY was a big move. And then we see here, tells you to get out. Well, what happens? Makes a hard V. How'd you get out right here at right around 309? Next day it comes right back up, $2 difference. So let's say you entered short positions there, but Again, you're in a strong uptrend market here. Again, we don't have our moving averages on here at this time, but once we get everything on there, we'll have we'll be even able to have even more conviction in what we should have done in a situation like this, where it came down like that. Should we get out? Should we get out? That will be covered. But anyway, so we see here, how does this get back in the CCI? Again, we have a hard V heading back up. Say we get in here around 312, and then we don't get another sell on the CCI until 323, over $10. At that point, we're out of the trade, and then we're waiting, or we could have got into short positions, but of course we see the market started, made more of a U right there. But then we get a pretty decent V angle here, and that should tell us to, hey, get ready to potentially get out. And sure enough, the next day starts to slowly go back up, and then bam, definitely out of the market at this point on our short positions. Well, comes back up into overbought territory. Well, that's a good entry point, 328, and it tells us to stay in the trade until 335. So nice move there. And again, the crash of 2020. I mean, this was just why more hedge funds aren't using the CCI index. I have no idea. I mean, look how much money you could have saved yourself if you were a long-term investor. Said, "Oh, okay, well, I'm going to pull out of the market right now until I have more certainty, until I can get back into this, this overbought territory." Well, it would save you a lot of money there. Could have got out of the market right there at 335 and got back in at 242, and then made all of those gains. So CCI is a wonderful, wonderful indicator. And we see that pretty much all the major dips helps us to miss those, get out, and then when to get back in. So to give you an example, here's another one where it leaves the oversold territory right there. Next day starts coming right back down. So again, you're going to have instances where it does that, but again, it still had you get out up here. Had you get out up here, and didn't have you get back in until there. So again, are you going to have instances where it goes up, comes right back down? Yeah, you're going to have those here and there, but you're going to have far more situations where it gets you out of a position. Say here, 379, and then really doesn't get you out of it until right there, 298, $20 move. So yeah, you may have situations where it gets you out of a trade for a day and then right back in. You may break even more times than not, or say you lose a little bit. Okay, yeah, but again, if you respect the CCI 30 historically, more times than not, you're going to make a lot more money by listening to it than not listening to it. So again, great indicator. Here's a prime example. Leaves overbought territory, or oversold territory, and or overbought rather. And then look at that. Yeah, nice move there. As you get out, then you see a hard V, back in, get out. So another thing I like is how precise when it tells you when it leaves the overbought territories. I love how precise it is. As you get out on this candle, this is the top. So I love that it has you get out at right around the high, right around the peak of the stock. So and just a little snapshot of it through history. Again, great, get you out right here. Great time to get out. Miss all that drop. So a lot of money to be saved by respecting and listening to the CCI 30. And again, you move up the time frame. When you do that, of course, you're not going to be as precise as far as entry and exits, but if you're a long-term investor that really just wants to miss the worst of the worst, hey, this is it. Another strategy for a long-term investor is anytime it leaves the overbought territory, you don't buy back in until it gets back into an overbought territory. Smart strategy. If you want to be on the ultra safe side, that's a great way to do it. Just focus on entering, only being in the market when it's being overbought. So see here that if you have this strategy on right there, had you get into the trade in 2017 and you had one day where it told you to get out right here, and then for sure out here. So yeah, almost right around a year that it had you in the trade right here, making all those profits. So again, great indicator. Will save and make you a lot of money. So let's take it down to an intraday time frame. All right, so we're in intraday time frames. Let's make sure we get extended hours off of here. We don't need to see that. Not right now, at least. So, how does it work intraday? Is there value to the CCI intraday? Well, I'll let you decide for yourself on that. So, let's get to the start of the day here. Okay, we're on the 5. Let's go to the 3 minutes. And we see here's a start of a day here on the 29th. Where did it start at? All right there at 9:30. So we see the market starts. It's an over bought territory here. First candle of the day. Next candle, it's telling us to get out of the market. Get out. And that's right there at 300. It tells us to get out and stay out until right around 299. So not much move there, minimal movement, but again, it made sure we didn't, because you could have easily thought here, okay, the market's just going to go down. Well, right there, it helped you get out and saved you a lot of money, because a lot of people say, oh, okay, it's going to go up a little bit and come right back down. Well, not according to the CCI. But let's just say you enter long positions at that point. CCI is trending up, heading towards overbought territory. So good entry point there. That is 299, and then it had you all the way in until 302. So over $2 move right there. And then from that point, little short move there. Let's just say you hypothetically entered short or long put positions here, 302.42, and then whoa, we see it turning around. Let's get out there, right there, break even, 20-cent difference on the stock price. Not much change there. All right, so let's see. So let's just say it got us in right here, right around here, 302.69, somewhere in there, and we stayed in until, well, told us to get out at 300. So 40 cent difference there, but again, kept us from losing money. And then from that point, we have some sideways. But as I mentioned earlier, whenever we have the moving averages on the board here, those along with the CCI make for a beautiful picture as far as entry, and exits. Okay, so tell you what, let me go ahead and put a few of those on here. We're going to put our 6. We're going to put our 13. I'll tell you what, we're going to keep it simple. We're going to go 50, 30, okay. Let's see what we got. Okay, so remember what we've learned from our CCI. Again, the situation we just looked at, the CCI starts heading down. Well, at that point, we see that we're under the 6 moving average, but we see we're fast approaching within 20-30 cents of our 30 moving average. So remember from our studying our moving averages, when they're nice and tight like this, it's, why not see what it's going to do in relation to the 30? Because we know the 30 is very well respected as well as the 50. And then sure enough, what insight did we get here? Well, sure enough, bounced right off the 30, headed back up. And of course, what else do we have? We have the 50 uptrending, the 30 uptrending. So that tells us, even though the CCI was telling us to potentially get out of a trade, well, we know we have our moving averages to tell us, well, it's actually, we're still uptrending technically, and until we break this 30 or 50, we are, we're gonna hang around a trade. Okay, but at the same time, you want to sell a contract right here, hey, more power to you. More power to you. Take those profits. Again, on our moving averages, our 30 and 50 got us in right here, along with the CCI. CCI said get in long, or put positions, or call positions rather, at this point, and kept us all the way in until right there. And of course, what do we have? We had 2 candles underneath the 6. So we got signs to get out, or an early get out on the 6 MA and also to the CCI. But again, we had this 30 and the 50 uptrending, so we still had a bullish biased, or an uptrend biased, even though our CCI left the overbought territory. So let's look at some more examples. The previous day, what do we have here? Well, we have our stock on top of the 50 and the 30. All right. But then we see right here that the stock starts leaving the 70 range and starts heading to oversold territory. So at that point, we start thinking, okay, even though we're still above the 50 and the 30, they're down. They're more horizontal, slight downtrend. At this point, when we see it leave that area, this is where we're just kind of waiting. Okay, we want to see what happens right here, and then of course it breaks below the 30 and the 50, and again we're still heading down on the CCI. That's a strong conviction trade there. We get below the 6, we get below the 50 and the 30, and the CCI is heading for this beautiful oversold territory. That's a great entry. 300, and kept us in right around, kept us into nice little $2, around a $2 move there. So excellent there. And then even if we did get out there, we're still below the 30 and the 50. They're downtrending, so we still have a downtrend bias. Okay, so hope you see some of the value between using the CCI along with the moving averages. So let's see here. Let's go to another day. Where's the start of another day? Okay, all right. So what we have? Okay, big drop day. So start of the day, we're under the 50 and the 30, and It gaps down. It's way below the 6. Well, we got to wait till it gets to 6 to figure out what we want to do. Or you could have said, well, hey, the CCI 30 is oversold. I'm getting in, and I'm staying in until it leaves this oversold territory. So let's just say you waited till it got to the 6. It got rejected. You're still an oversold on the CCI. So you enter there, and you don't get a exit point until right there, right when it jumps on top of the 6 moving average. You get a sell signal on the CCI as well. And then from that point, say you sell a contract there, well, you still got your 30 and your 50, both of which are downtrending, and you're under them. So you still have a bearish bias or a downtrend bias. So you stay in the trade, and then of course CCI heads back down to oversold, and then it stays in, and then doesn't have you get out until right there at the bottom. So we see how the CCI 6 and the CCI 30 are very, they work together nicely. Here's another example. CCI leaves this overbought territory, starts heading to oversold territory, and of course the stock goes below the 50 and the 30. Great sign, great entry, good time to get in. 313, and doesn't have you get out. Has you get out there here faintly, but again, we're still under the 50 and the 30, so we're going to respect that first and foremost. And then keeps going down. Again, our CCI stays in oversold territory, all the way until the next day. So nice move there. Let's see. All right, have another example here. CCI leaves the oversold, heads towards, or overbought, heads towards oversold right here, but at the same time, we're sitting on the 30. We need to see what it does with that. And of course, it finally breaks below the 30 and the 50, and we're heading into our oversold territory. Hey, great entry there. 308, and then it has us get out right here, right around 307. So a little dollar move there, not too bad. We'll take it. So here's another start of a day. We start in oversold, but again, look how far we are away from our 6, so we're going to wait, and we were rewarded for that. See that the CCI starts giving us a sell signal, or to get into puts or short positions right here, and then the CCI doesn't tell us to get out of that position until about right here, and sure enough, it hits off the 50, bounces, hits off the 30, and then pinballs down. And then the CCI tells us to get in here, and we don't get a strong sell signal until all the way over here. So 309. So $3 move. Very nice. So again, this CCI is a very, very accurate indicator. So I hope you got some value for that. Of course, it works on all time frames. And again, it's the CCI 30. Again, settings over. Remember, we put the over. Just one more time here. Pull up the settings. Remember, we went to the 30 period, and then changed our overbought to 70. So again, that's our settings for our CCI. So that takes care of the CCI 30. For this part, in our next part, we'll be going over another variation of the CCI, and that will be CCI number 6. CCI number 6. And you say, okay, why another CCI? Well, in the same reason we have multiple moving averages to get a better understanding or better picture of the stock and what it's doing and where it's going, multiple CCIs I found through backtesting gives you even more indication of where the stock's going. So again, for our next video, we're going to be focusing on CCI number 6. Welcome back to the Precision Indicator course. In this part of the course, we'll be going over the CCI Community Index. Last time we covered CCI 30. In this video, we'll be covering the CCI number 6, period. And remember, we changed the overbought to 70. I can pretty much tell you any period that you may like to use on CCI, 70 on the overbought is going to give you more precise entry and exits. All right, so as we can see, the 6 is a faster moving average. It's going to get us in and out of trades quicker. Well, in some instances that's good. In some instances that's not good. If you were just using the 6 by itself, yeah, it could very easily get you in and out of a trade too early. So, but the good thing about it, it's not going to get you out too late. So with that said, let's look at a little bit of the differences between the CCI 6 and the CCI 30. We see the CCI 30 had us get out on the stock market crash. Had us get out right here on this day, 333, whereas the CCI 6 had us get out the day before, $5 before the CCI 30. And yeah, again, you can see you're going to have more up and down with the CCI 6 than you will the CCI 30. So again, it's more suited for swing traders, somebody that wants to be in a trade for a shorter period of time, quick entry and exit. So very straightforward there. So again, using the CCI 30, one of the best strategies you can do is, if you're just using, let's just say you're just using CCI, you could use the CCI 6 for the first indication to get out of a trade or get into a trade. Okay, that could be where you use the CCI 6 to sell your first contract, and then if it continues in that wherever it's heading, then at that point you can use your CCI 30 as an entry and exit point as your next to sell your next contract. So yeah, it's pretty straightforward there. Like I said, it's going to get you in and out of trades quicker. Here's a prime example. Right here, so we see the CCI 30 told us to get out there. So there's about a day difference here. So it goes up, and then we get a sell signal on the CCI 6 right here. But we never get a sell signal on the CCI 30, because again, the CCI 30 still, it's a longer term indicator. So again, now would that have saved you some money? Oh, sure would have. Take for instance the CCI 6 got you out here at 259 and really got you back in heading back up right here. So saved you from, what was that, $10 worth of loss right there. got you back in right there. Whereas with the CCI, you're using that for swing trade purposes or long-term investment purposes, well, you'd have just had to take on that $10 and then just wait for it to recover. Whereas with your 6, well, you were able to miss that loss and make even more gains. So another example here, as you get out there, then back in, then out. Again, it's going to limit some of the losses, but at the same time, it can get you out a little too early in some instances. That's just the nature of it. So, give you another example where it's nice to have the 6 as a early indicator. Right here, stock right here, 320. You were getting a sell signal on the CCI 6. Well, you didn't get a sell signal on the CCI 30 until all the way down here. So, $20 difference. Again, this is on the daily. So, the CCI 6 will help you to be much more precise on the daily time frame and swing trade time frames. So, let's move it down to an intraday, and let's see if we can see some examples of the benefits of the CCI 6. What do we got here? We're going to minimize our 30 a little bit. I'll tell you what, we're just going to make it full screen so we can see it nice and big here. Let's go to the start of this day. What do we got here? So the start of the day, you get just for split second, it was an overbought, and then bam, starts heading down, and then it just touches oversold and starts coming back up. Okay, once we see that turn, starts turning its way back up, good sign to, again, it tells us to get out of the trade even before the 6. We know our 6 moving average is one of our earliest indicators to get out of a trade. Well, the CCI 6 is even more precise when it comes to getting in and out. It's going to tell you to get out even before. Again, we're on the 3-minute time frame here. So, but again, it can have you get out too early. Prime example right here said get out. Well, still above the 6, still above the 50 and the 30. So again, would I want to use the 6 by itself? No, I wouldn't want to use it as a standalone indicator. But again, in unison with our other indicators, it can be very powerful, especially if you want to be in and out of trades. Intraday stuff, man, it's great. Here's another example. Right here, the CCI 6 tells us to get out at the bottom of this candle. I mean, the 6 is still telling us to stay in the trade. But again, what happens? Well, the CCI 6 was right. It was very much right. It came down, left here, and yep, told us to get back in, told us to get out. So again, it's a very, very precise indicator. Again, the start of this day, going into oversold, comes up, but again, we're sitting right here on our 30, so we're going to look at that first and foremost. We're still above the 50, and then finally it breaks below, riding the 50, and then bam, we get a sell signal there on all of our moving averages and the CCI 6. And yeah, CCI 6 gave us an exit point there, but of course we know we're below the downtrending 50 and 30 and still below the 6, so we're going to be patient, and we were well rewarded for it. So again, the CCI 6 is, when you use it along with the other indicators, it can get you in and out. Really earlier than any. Here's another example. How'd you get out here right at the top, right at the peak of this little hill right here? Well before anything else, before the 6, the 30, 50, it was already telling you to get out. And then and then when it came down here, it breaks out of the, we see it breaks out of the oversold territory right there, right at the bottom of this valley right here. So again, it does a great job getting you out of positions at the first sign of weakness. So that's why me personally, I really appreciate it for that, for my intraday purposes. When I am, like I said, getting in and out of trades, I just want to make a quick scalp on something. And again, it lines up with the moving averages, and I want to get into the position as early as possible, and I want to get out as quick as possible. Yep, it's the best that it is. So, and again, it works on all time frames. I mean, you situation you find, you decide which time frame you like it the best with. Again, a lot of people like the 5, and again, when it comes to 5 minutes, we see that it's not as jumpy. Since the 5 is a longer time frame, it'll keep you in a little bit longer, but it's still extremely accurate. Take for instance here, as you get out right here, bam, the very bottom candle, the very bottom, and then of course it peaks here. As you get out right there, perfect timing. Yeah, the 5 minutes. Yeah, the 5 minute is goes very, very well with the 6 CCI. So I really like it for that. So I'm just gonna scroll to some random days here. We'll zoom in on our first. Where's our first full day here? Okay, here's a full day. Okay, we see we start the day. Shows us that we're oversold. And then right there, CCI has an entry point right there. Well before. I mean, look how far we are from our suit. I mean, at this point, you know, what do we? Again, this had us get in all the way down here. So again, it can get you into a favorable trade before any other indicator. Yeah. So a lot of value there if it's used in the right way. Of course, any indicator can be used wrong, or if it's used standalone. Again, there's, as I've said in previous videos, there's not a silver bullet when it comes to one indicator. That's no. Anybody that's trying to sell you their one indicator that's gonna make you all this money. No, every indicator has its good and its bad. So you're able to negate or make the negative of an indicator much less by using other indicators that give you more pieces to the puzzle. So again, that is the CCI 6. Again, great for quick entry and exits, good for swing trading on the daily time frames. So again, just use it for its strong points, and if you do that, it'll definitely make you some money. So anyway, hope you enjoyed this part on the CCI 6. The only other CCI that I prefer to use is the CCI 14. That's the three CCIs that and really the 14 is just a nice middle ground between the 14, or between the 30 and the 6, and I encourage you to try it out, see if you like it as well. It may be your nice in between for for both of those. It's great intraday and also great for swing trading as well. So anyway, definitely encourage you to check out the CCI 14 and see if you can get some value from it as well. But again, if you use the CCI 6 and the 30, again, you're gonna get the best of both worlds as far as getting you in and out quick, or keeping you in trades a little bit longer to get the most out of them with the 30. So anyway, so try that out, see what works for you, see what, based on the time frames that you use, whether you prefer swing trading, whatever it is. Again, do some back testing, see what your preference is based on the time frames that you use and your style of trading. Again, you do that, I can assure you, you're going to have great results and really, really enjoy the CCI. It's again, it's a great indicator. So with that said, that'll finish up the CCI. The next indicator that we'll be considering will be the stochastic. So right here, Mr. Stochastic. So that's who we'll be considering in our next video. And thank you for your time in this video. Hope you got some benefit out of it. And we'll see you back in our next video of the Precision Indicator course. Welcome back to the Precision Indicator course. In this video, we will be focusing on a historical indicator. This is really a nice indicator to consider for crash purposes. So let's get right into it. The indicator is CCI 313. Now, what's nice about this indicator? Well, this is a great indicator for long-term investors, people that really just want to avoid bad stuff, get their money out, that kind of thing. So let's look at it here at the crash of 2020. We see that we were getting the signal to get out right around here on the CCI. We see that it was leaving this overbought territory, downtrending down, and then very strong once we get to this day. So yeah, and then it tells you to stay out of the stock and to not safely re-enter till about right here. And that's proved to be a very safe play. Got you out early before something really bad happened, and it got you back in at a pretty decent spot. And of course, you look at any of the major or the big drops. I mean, prime example, as for a long-term investor, why this is really nice. Take, for instance, prime example right here. Tells you to get in the stock, 293, and it keeps you all the way in the stock. Yeah, it keeps you all the way in the stock until around 314. And that was, starting in 2019, and a good, many months before. So, we see anytime it comes out of this overbought territory, that's a good area to take your money out and then re-enter when it goes back into the overbought. That's the strategy with this historical indicator. You get out ideally. Now if it goes all the way down to oversold, the dark gray at the bottom, like we had down here, then yes, you can feel free to enter there. But if it goes down, comes down, goes right back up. See, I got the zero line right here. Ideally, if it goes down, heads right back up, jump right back into the stock. and you can see pretty much all the big drops it got you out of throughout history, or it did get you out of the big drops. Had you get out right here, and then you missed all of this craziness, got you back in right here. So safely got you back in the market. See from right here, had you in, buy signal all throughout there, all through this time period. So really nice. Got you in right here, kept you in until we started getting some bigger drops in there. Oh, let's see, we had a pretty decent drop in 2016. Left here, left the overbought area here, out of the trade here, and didn't get a signal to get back in until right there. So decent, very decent. And another cool thing, let's go to our next big drop in history. 2008, 2009. Had you get out right here. I touched it barely right there. So really, right here, had you get out. Said you could get back in here, but then got you right back out. Break even were you from that point. And then it had you stay out all the way, missing this epic fall. And then got you back in right here to take advantage of the profits. Now, one thing about this indicator that I also particularly like, especially on the S&P, back tested it very thoroughly, is the fact that when you leave oversold territory, so the bottom gray area, when you leave this area, so it leaves it and starts heading back up. An interesting point here is if it gets back up to this 0 line that I have right here, so if it leaves from, again, oversold, and makes it to the 0 line, it crosses that line, historically, it has never come back, never ever come back down into the oversold area without going up to the overbought area. So that's pretty handy. Yeah. So again, it has never left this gray area, this oversold area, crossed the 0 line, and then not made it up to the 70 overbought fill area. So that's a pretty interesting thing to know, useful thing to know. Because again, prime example, the crash of 2020. What's everybody was saying for months and months? Oh, it's coming back down. It's coming to test the lows. Well, the reality of it is, it just almost touched it right here. Almost touched it. Not quite, but almost. Even almost touched it here. I mean, you could have looked at that as being, okay, that's close enough. But ideally, you get your cross right here. And yeah, has it shown any signs of coming back down and testing the lows? Not at all. Not at all. So again, just a nice little historical indicator to look at there, long-term investor. So hope you enjoyed that. Just a basic little indicator there, and hope you enjoyed that. And we'll see you. Yep, we'll see you in our next video of the Precision Indicator course. Welcome back to the Precision Indicator course. In this part of the course, we will be going over our next indicator, which is the stochastics. So we're going to go ahead and get that put up on our board here. Studies, stochastic. Now, we don't go with the standard setting. Honestly, stochastic on the standard setting, I have very little value for. But when we make it a little bit more precise, I really like it. So we're going to move it to the 30 period. We're going to go with the smooth. If you're on something like a trading view, it should be 30, 30, and then the other two settings would be 2 and 2. And then our overbought, oversold territories, well, we're going to leave overbought at 80, and then we're going to trade or change oversold to 40. Now let's get that pulled up, see what we look like here. Now, there we go. Let's make this bigger so we can see it. See what we're working with here. Because we need to see a little more of the detail with this stochastic. All right, so first things first, you can see you have two different lines here, two different periods running together, crossing through each other. But of course, they're going to stick very close to each other. It's about a 2-period average moving difference between the two. Now overall, it's the 30. Now we're going to zoom in and just get an idea here what we're looking at. Now, again, the oversold territory is 80. It just has a line here to signify that, but I'm going to put a darker line here so we can see it better. If I can see how close or how straight I can get this line. Okay, that looks pretty straight. Oh, well, I didn't want to set. Okay, looks pretty good there. Well, moved a little bit on me after I clicked it. Alrighty, there we go. That's better. Alright, so that's our 80. Our next line is 40. Right there. Okay. Now, I also like to add a couple additional levels as well. One level being right here around 7. Let's see how close I can get it here. Well, looks like 680 may be the closest it's going to let me. Okay, and then the other level I like is 90. Okay. Now, let's see what we got here. Well, one more level, 20. That was the last one I'm missing there. All right, perfect. Now, these are all the levels for stochastic. Again, if you really want to be able to get a lot of information from stochastic, this is a lot more precise. This is how you do it. Now, the general rule of thumb is, this goofy thing will stop moving. The general rule of thumb is when it goes above 80, it's getting in oversold territory. So when it starts getting up here, it's theoretically getting to the point where at some point we're going to get a pullback. And we see the 80 level, and then the 90. 90 is when you get up in the 90, that's when you get into the upper level of overbought. Okay, so, and you can see the things to look for also too is where does the black and red line cross. Whenever you see a hard cross between those two, you see an example of it here, see an example here, see an example here, gets choppy here, another hard cross. And what I like to look for too is whenever you get a hard cross and then separation between the two. That's a telltale sign that you're getting a strong trend change. Here's a prime example, cross there, and then it spreads out really nice. Again, crosses here, spreads out. So that's the basics there. When you see the cross, you're going to have a trend change. May not be very long, but you'll have some degree of change in direction of the stock. Now let's see our different levels here. So again, we did 80 is our overbought, and then 90 is the upper level of that, and then on the bottom side, oversold. 40 initiates our oversold territory, and then 20 very oversold, and usually around 7. Around 6 and 7 is where you get to your peak. Anytime it gets to that 6 and 7 range, it ain't gonna stay there very long. So yeah, just a good rule of thumb. Good rule of thumb on that. And ideally, on this level, I prefer a lot of times. I actually prefer to be at 95 because I like to be at that upper extreme. So when it hits that 95, in the same way when it hits the 7, it's like, okay, it's hit here, it ain't gonna stay here very long. So ideally 95, 80, 40, 20, and 6, 7 is your levels that you want to be paying attention to. Now let's notice how what it looks like compared to the chart. So we see here we have trying to maybe use another line here, but we have our, as usual, S&P 500 or SPY ETF, and let's see what we can pull away from here. So stock crash of 2020. What do we have here? Well, we see here the stock from this point right here went into oversold territory. All right, we see here that the line crossed both lines, and that's another thing to keep in mind too, is whether you just have one line crossing or both lines crossing. When you have both lines cross, that's a stronger conviction. Okay, so they both cross here, and then what do we see? They come up and they just run along that upper, that upper 95, just running up against it. Because again, like I said, that's a very strong barrier there. For it to punch through 95, that's major overbought territory there. So see here, it just rides that 95, and then bam, starts breaking. Now you could have said at that point, okay, well, you know what? It's breaking away from the 95. Got a nice separation here between the two. Hey, I want to be here at this point. And that would have been a great entry, 335. And then you said, well, I'm not getting back in until I see a hard cross. I see a hard cross on the stochastic. And let's see where you got that at. Let's see, you got your hard cross right there, right at the bottom of this first leg down. So that was beautiful. And where did that leg come to? Came right to 7. Yep, so I see it go through 20. Okay, I'm like, all right, good. Or go through 40, then go through 20, and then when I see it get to 7, oh yes, I am ready to jump into some long positions, because when it gets into this area again, it's going to push back up. It's not a matter of if, it's when. It's imminent. But again, this would have been a great up here. Would have been a great entry, especially when you see these two cross the 80 line, and with this kind of separation, oh, that's a strong, very strong sign of a downtrend. So, and again, we see at the bottom here, cross. I mean, it got you out at the exact day you should have got out. And then from there, what happens? It goes from 7, heads up to the 20. Look at this wide separation here. Very wide separation. Hey, if you wanted to enter there, that's not a bad entry point. Got you in at 304, ran up to around 313, and then the cross was right. Yeah, we got our hard cross there. Well, first of all, we seen that we got rejected at the 40 line here. You see the black line, it came up, got rejected. That's a telltale sign too that, hey, direction, because again, your black line is always going to be the leading indicator line. It's going to be the one that reacts first. All right, the red line in this case is a little bit slower. It's a little bit smoother, a little bit slower. You're not going to see as hard as turns here. Prime example, you see you get a hard V in the, again, Make sure you're focusing on my big crosshairs. You see you get a hard V here in the black line, and then in our red line here was relatively smooth. So, but again, it didn't cross here, just ran into it or bumped against it and continued on its way down. Now, when you see a hard V in this red line, oh yeah, that's a very, very strong indication of trend change. Here's a prime example. Bam, hard V there, and then you get a pretty good V right here in the red. Of course, a very hard V in the black. So in this situation right here, you could have said, okay, well, I get the cross right here. I got rejected on the 40 hard. The red line's getting rejected as well. That's a good entry point. And yeah, if you'd entered there, you'd have been rewarded very nicely. We see it came down, crossed through the 20. Look how nice and spread out they are, the black and red lines. Nice and spread out. Then it gets down here, hangs out below the 20. Again, in this situation, I'm not getting out of this trade until it goes above the 20 or really even higher. So entry, so we entered there. Again, we're waiting for this at a minimum to come back above the 20. And we see here what happened. We came down and we actually hit on this 6 or 7 line right here. Again, just touched it. Spent just a little bit of, spent one day on it. And then we get our hard cross, separation between the two lines, and heading up from there. So, again, we see the points here. Hit the 7. Again, anytime it hits that 6 or 7, it's not going to be there very long. Now, and we'll look back at history a little bit to see that a little bit more. So, again, we see it hit the 6 or 7 here, spend a day there. Hit the 6, 7 here, spend a day there, and then, yeah. So if you want to be ultra conservative, hey, look for the extreme outliers. So, which would be 95, leaving 95, nice spread between the lines, or leaving 6 or 7, nice spread, leaving there. You know, you're going to get some pretty good momentum. But again, in between this 40 and this 7, this whole area right here is downtrend area. It's a downtrend area. Okay. When we get up in here between 40 and 80, you're looking more sideways movements, or if you're changing from a major trend direction. But yeah, you're around here in this 60-ish area. Yeah, you're going to be, for the most part, the line is moving more horizontal. You're going to be sideways, and you'll see that as we go on. So that's the basics of it. Hope I explained that all right. Again, with the stochastic, we're looking for crosses between the two. We're looking for the support and resistance lines, where they hit those. And yeah, that's pretty much it. And what I love too is it just gives you a nice overall view as well. So you see here, up here at the high, come down here, it very, very nicely, the 30 moving average on the stochastic really mirrors what the stock is doing. You see here was the very bottom, so here's the very top, and here was the very bottom, and then you see it gradually moves up, just like the stock is gradually moving up. So I really like that aspect of it. And we see that once it gets above this 80, we're in a very bullish market, overbought market. I like to say more of a bullish market because it's not just because it comes up into this doesn't mean it's imminent that it's coming down anytime soon. You can have a uptrend for an extended period of time. We see here that it was above the 80 on the stochastic for so it got above it here on April 20th, and you didn't have two lines cross. Yeah, you didn't have two lines cross until 2 months later. So, and then from there you had a cross, and then it's been doing some sideways. Yeah, this is a prime example right here. When it comes between the two overbought and oversold territories, starts this moving sideways stuff, sideways. What do you see here? For the most part, just sideways action. So, Yep, great, great indicator. I really do like the stochastic. So, prime example here. We dipped down. We came out of the oversold or overbought rather. Nice separation between the two. Good entry there. Or if you wanted to even enter up here at the 95, that would have been totally understandable as well. Okay, well, somehow my line got moved again. All right, there you go. Stay there. Okay, that's better. That looked right. I was about to say those lines do not look correct. All right, now we got it back at 95, our upper limit. We see it came up here, hit the 95, kissed off of it, bam, and then down. So again, you see how when it gets up to this 95, this is always going to be the upper. You know, a lot of people they want to just have one. They just have one line for an upper, an upper limit on stochastic. Me, I like to be more precise. I want to have indication when I start getting in that bullish area, but I also want to have a line that shows me when I get in overly bullish area. Because again, in that area, it's very, like I said, it can ride it, but anytime it jumps up above it, your pullback is very much imminent. So we had a nice drop here. Let's zoom in and see if we can see it a little bit tighter. There we go. So came out of 95 here. Nice separation on the two lines there. The two stochastic lines. That's honestly a good entry point there. And then sure enough, it comes down and the black line comes and hits the 40, rejects off of it, and then of course our red line rejects off of it as well. But of course we get our nice cross right there to get out of short positions or put positions to get back in long, and sure enough it continues to run up from there. So that is the stochastic on the daily. Again, works on all time frames. We're going to do check out our intraday. But for now, we're going to stop this video right here, and our next video will be we'll be jumping in the stochastic. Can't talk today. The stochastic intraday. See how we can trade it on our intraday time frames. So look forward to seeing you back for our next video. Welcome back to the Precision Indicator course. In this part, we'll be going over our intraday time frame on the stochastic. And again, we're just seeing if it works just as good as intraday as it does on the daily that we considered in our last video. So we see here, start with our first daily time frame that pops up here. We see, so move to the start of the day right here, 7-2. All right, so the start of the day, we see right here our stochastics kind of just in no man's land between the 40 and 80. Then we see we get it on our next candle. From there to there, we'll get a nice cross on our two stochastic lines, indicating a trend up. Get a nice separation. And what happens? From there, the stock runs up. It rides the 95 and then breaks away from it. We get good separation between. Entry point there if you'd like, or if you really want to be safe, well, you could wait till it gets below the 80. And we see from there, if you'd entered there at the nice cross, both lines below the 95, would have got you in around 385, 315, somewhere in there. And we see that it proceeded down again. Usually the way I like to play it is I like to wait honestly until I get a hard cross between these two, which we see we have them coming right here. They're rubbing together, but for me that's not a hard cross. Like I said, I like to see a nice hard cross or an X, almost close to an X pattern. This prime example here, X. That's what I like. That's what I like to see. So we see that from that point we got in there at 315. We really came down here, kissed off the 40, and then rejected off of it. Now that's a sign right there. When you see it reject off, this 40 or this 20 or this 7, very strong indication that there's going to be a change of direction. And we see here they cross, get a little bit of separation in there. Only a little bit of separation helps us to see that this is not necessarily a hard trend change, but it is a trend change, needless to say. So let's just say that we got out there, we seen it reject off the 40, and we seen the cross. That had us get out around 3 in the 312 area. So based on that 315 to 312ish, somewhere in there, yeah, nice $3 move there. And then from there, we see it starts moving in between these two major support and resistance lines, which really indicates sideways movements. And then we see we get a cross here, decent cross. That's a nice little X there, separation. Could possibly be an entry point if you'd like, but again, what time of the day? Oh, it's in the middle of the day. What happens in the middle of the day historically? Volumes decrease. You don't get as big as swings during the middle of the day. So, yeah, you could have got in there, but wouldn't have got much. See, it came down, went under the 40, rode it, and then broke back above it. So, that is that. Let's see some other decent trend changes here. We see it came up. Again, I always like to look for these upper limits when it gets to these upper limits, whether that be the 95 or the 7, or even in the 20. It's that 20 range. That's another sign of a extreme end of the spectrum. But here we see it hit the 95. It crossed. Been a nice entry point there. 3, and again, this is just using the stochastic alone. We have our other indicators, our moving average and stuff like that. The picture becomes much more clear. It's easier to make decisions. But I'm just trying to help you see that you can make money. You can make money with I'm just trying to show you how you can make money if you just had just as an indicator, just using it by itself. So right there, around 313.82, and you get a hard cross right there, right here, and yeah, get out of the trade at that point. Yeah, it wouldn't have been 10 cents, not much there. We see it comes up, almost hits the 95, crosses hard right there, and starts making its way down. So let's just say you entered there at the hard cross, rejecting off the 95, 314, just about 314, and you're looking in for your next hard cross or your hard rejection. And yeah, you don't get it until the last candle of the day, which that would have been a nice little profit there. So 314 ultimately went all the way down to, I mean, you're on the last candle of the 5-minute candle of the day. You get that kind of drop that close. Yeah, definitely taking some profits in this area. But needless to say, that's a very nice little profit there. So let's go to another day here. See what we got. Let's go a few days before that. What do we got here? Start on this day. What day is this? 6/26. All right, so the start of the day right here, we see the candles or the two stochastic lines cross right at the open of the day. Get nice separation between the two. They break below the 80, signaling that we're heading downtrend. And sure enough, let's just say worst case scenario, you entered right there. It's right around 306, somewhere there. And you're waiting for a hard cross or a hard rejection by the two stochastic lines. You see here what happens. It comes down, goes below the 40 right here, comes back up, get a little bit of cross between the two lines here. Not a hard cross. It's really more just bumping into each other. And then the black line rejects off the 40, heads back down. And then what happens? Comes down here. Comes down here to this. Yeah, it gets a red line. The red line gets all the way down to 6. 5, 6. That's an indicator. Again, you start getting in this area, a trend and change is imminent. So let's say there you got out, I don't know, let's say worst case scenario, you get a cross here, separation here, so somewhere in here, around 301, between 301 and 302. But needless to say, that was a nice, yeah, that was a nice, nice $4 drop or so that you could have took advantage of on the stochastic there. And then from there, it starts heading up. But again, when you're still below the 40, you're still downtrend biased. So really, when it busts above this 40 is whenever you start saying, okay, all right, we can definitely be getting more bullish, more uptrend biased at this point. But here, what happens? Sideways. It moves within this 40 to 7 channel or 6 channel. What happens? Stock just moves sideways through it, and sure enough, what's the stock doing? It's moving sideways. Moving sideways. You don't really get clear direction till it busts through this 40. Nice separation between the lines, both lines crossing through the 40. Yeah, that's, if you're anxious to jump in a trade, that's a pretty decent spot right there. 301.89, and then bam, you get a pretty hard cross here. Right there, you get a nice cross. Here they just kind of kissed each other, rubbed up against each other. Here you get a nice separation, and yeah, hard cross and a separation between the lines, and it rejects off this 80. So it gets close to it, 75-ish, rejects off of the 80, and comes on down. So not much there. 301.89 and the cross there. Yeah, 20-30 cents. Nothing. Not much there. But with that said, you see the rejection at that point. Say you enter a put or a short position at that point, 302. And again, you're waiting for the next hard cross. And let's see where that happens. See, it comes down, hits the 7. Hits right there on the 7. Rejects off the 7. Crosses with the red line. And yeah, that's right there, 300, right around 350 cents, somewhere in there. But yeah, nice little $2.50, $2 move. Not bad. And then again, it leaves that area, and now again until it leaves, some people, they want to be, they like to jump in when it leaves the 20, when it supports on that and runs off the 20. Oh, I'm gonna enter there. Me, not so much. Again, I always look at this range right here, sideways, sideways. Yeah, or still downtrending until it breaks this area. I'm not really messing with it. And then finally we get it does break it. Breaks through the 40. Both lines go through the 40. Nice separation between the two. Had our hard cross down here. And let's say worst case scenario, you enter right here. Because again, the black line is always going to run through first, and then the yellow or the red will follow. You want to be ultra conservative. Yeah, wait for the red to cross. So at that point, 300, around 300-ish is where 350 cents, somewhere around there. And then let's see here. Runs up, starts running along the 95. Rejects off of it at the 95 there. Nice separation between the two. You want to exit there, totally understand. Around a $2 move. And then from there, what happens? The line comes here, just barely breaks through the 80. And then reverses right back, and then just moves sideways. Again, in the same way when you're between 40 and 20, or 40 and 7, this is sideways, downtrend sideways movement. Well, when you get up here, between the 80, this 80 and 95, you got, uptrend or sideways movement at that level. So nothing much here. You get a little, nice little separation here coming off the 95, rejecting, coming down there, but you get a hard cross right there, and then right back into the 80. Would have been out at that point. So and then comes up, hits off the 95, hard rejection there, hard cross between the two. You want to enter there, and yeah, you'd have been rewarded nicely for that. You didn't get a hard cross between the two until, bam, right there towards the bottom of that move. So what would that have been? So worst case scenario is that you end here after the cross, 303.80, and after the cross down here, yeah, 302.56. So little profit there. And then here we see we come up. But let's say you enter right here. You say, okay, all right, both lines crossing through the 40, looking good. Well, what happens? The next candle or two, the black line comes just below the 40 again, but the red line does not. For me in this situation, I'm waiting. I want to see the red come back below. It does not, and then boom, it continues up. And yep, nice little profit there. So in here you could say, well, I'm getting out as soon as it rejects. I see this black line reject off of the 95, or you could say, well, I'm staying in this trade until it comes back below the 80. So that's a strategy as well. In the same way that when it comes down here and hits the 7, I'm waiting for it to cross back from the 40 before I enter a trade, go in the other direction. Well, in the same way here, I am more likely, say I enter my trade here when it crossed the 40. Both lines crossed the 40 at around 303.32, and yep, you could have got out there. Yeah, it would have been a nice $1.50 move there if you said, well, I'm getting out as soon as I see a rejection at the 95, or you can say, well, I'm waiting to it until the stock comes back down and breaks through the 80. And yep, that would have been your best bet. That would have had you getting out somewhere around 306.80. So from that point, again, you entered when it left the 40. Entered when it left the 40 line support, and then you exited when it left the 80. So from that point to that point, around 303, exiting around 306.50-ish, somewhere in there. So nice $3.50 move, not bad. So you entered a short at that point. As soon as you got out of your long position, ordered a short position or a put position, 306.50, and then you're looking for your next hard cross. Get a decent one there. So, but that's not much. Again, you get late in the day, low volume, you can't expect a lot of movement. But even from that cross to that cross, 307.50-ish to this cross, yeah, you still about $1. And then from there, you're waiting for it to leave the 40. And what do you have here? Sideways, bam, finally leaves the 40. Nice separation between the lines. Let's say you enter there, 306.66, and then you get a hard cross. Yeah, right there. 20-30 cents difference. Not much. And then from there, the rest of the day, you're just pinballing between the 80 and the 95, which indicates sideways or a slight uptrend. So that's that day. Yeah, nothing crazy happening that day. Let's go to another day here. Okay, then 624. See, we started the day gap down. What do we have? The stochastic is at the 20 line. So what does that tell us? We're in a downtrend. Okay, we're below the 40. We're in a downtrend. And there's separation between the lines, and it's still heading down, meaning that we still got more to go. And then, sure enough, comes down here, gets really, really low. Yeah, you want to talk about the really low levels of the stochastic when it starts getting down here around 1 and 2. Yeah, that's the extreme of the extreme there. Which from that gap to that gap, that's a pretty that was a pretty substantial gap. So anyway, and then from there we see the lines just start still below the 20. If you're below the 40, you're still downtrend. downtrend, sideways biased. Well, you're below the 20, you're very much still downtrend, sideways biased. And what do we get there? Yeah, more downtrend. So again, let's just say you hypothetically got in this trade. At this point of the day, you say, well, we're in a downtrend, separation between lines. And again, I'm not getting out of the trade. Again, you get in at the 20. You can say, okay, well, I'm getting out at the 20. Or you can say, I'm getting out at the 40. Okay, once I break the 20 or the 40, I'm out. So you entered at the 20. Right here at the 20, around $3 or 309.70, 309.75, and then if you're waiting for it to cross, right there, 303.93. So not bad. A little dollar or so move there. So again, this on this is on the 5-minute time frame. Let's check out a different time frame. Alrighty, so we're back on the 10-minute time frame. So let's see what things look like on a 10-minute time frame. Now, what's nice is on the 10-minute time frame is, of course, you'll have a little bit more clarity on the stochastic for sure. It can also be used for also too for day trading purposes or in swing trading purposes. Does well on that. But I just want to show you here on the 10-minute time frame how, yep, still the same thing. Crosses. You see, you have a hard cross here at 95, and then you don't get another hard cross until down here. And then, but again, a lot of times when you come below that 40, again, until it crosses that 40 again, or at least the 20, you're still downtrend, sideways biased until that point. So very very basic here. Like I said, it can be a great little indicator. I mean, if even standalone, you can make some pretty decent money with it. Let's look on the hourly, see what we have on the stochastic. So yeah, so on the hourly, we see that it gives us gives you some nice swing trading. Prime example here. What do we have? Hits the 95, rejects off of it, hard cross, entry at that point on that day. And then we see the next day comes all the way down below the 20, gives us a hard cross right there. What would that have put us at? Around 304. Drop from 312.50 to 304. Nice drop there. So again, then we see it starts just moving sideways in this channel, which indicates sideways or slight downtrend. Then we see it comes up here, breaks below the 20. That means we're going to have nice separation between the two. We're going to have a period of downtrend. And we see that's what we had, a little short downtrend. And then we see it rejects off the 6-7 resistance line and heads back up. At that point, you want to enter there. Yeah, it's good entry right there. So right around 302.50, 302.60, somewhere in there. And again, you're waiting for your next hard cross. And then, well, you see here they just kind of rub up together. Not, yeah. Now, if they'd hit here, crossed here, and it would have came back down to the 20, hey, that would have been an exit. I would have been exiting at that point, but that's not what happened. Continued up, and then we see here it gets to the 95, rides, just rubs up against the 95, riding it. Again, you can have two viewpoints here. Hits this, okay, I'm taking some profit here, or closing a contract here, or you can say, well, I'm waiting for it to go below the 80 before I exit this trade. Well, we see at this point you didn't. So from that cross down there around, like I said, 302, you're still in the trade around 314, 313. So nice little swing trade ability on the stochastic. So I'll have a video on just swing trading strategies, different things you can use as far as the indicators with the stochastic, the moving averages, and also the CCI. So that'll do it for the stochastic on the intraday time frame. Hope you got some benefit here, and we'll see you in our next video. Welcome back to the Precision Indicator course. In this video, we're going to be going over our next indicator, which is trend lines. How can we get indication by means of trend lines? Of course, what is a trend? Base root word there, trend. Trend just means we're going in a certain direction, trending in a certain direction. Now lines, trend lines, well, we're going to be using lines to map out those trends. So we're going to go ahead and jump into that at this point. As usual, we're on the S&P SPY ETF on the daily, and let's see what trend lines we can draw here in the crash of 2020. Now, things to keep in mind with trend lines: they're open to interpretation. Okay, where do you feel like it's trending? And also, two, which candles are you going to base it off of? Candles, off of their wicks. So anyway, there's no one person that does all their trend lines the same. So something to keep in mind there. But here, let's start doing it here at the crash of 2020. Prime example right here. Now, me personally, I like to draw my trend lines primarily based on the top and bottom of the candle, the body of the candle. So, for example, here, again, focus on my big crosshairs. Prime example here would be right here. We're starting to trend down right here. Candles are coming down. This next day trends down. Well, let's say you wanted to start drawing a trend at the beginning of the drop. Well, let's see what we got here. Now, trend is very simple. One side of the trend, you just want to ultimately see where at least two candles, you can draw a line that two candles come up to and touch or reach or wick onto, and that gives you a downtrend line. Now, in this particular scenario, let's just say you started drawing a trend line up here at this top candle. You seen the next day. Next day you had another down candle. You say, okay, well, I'm going to get me a little trend line going here. Sure enough, the next day comes up. It wicks just above it, comes right down. The next day, candle goes right up to it, hits it. The following day, wick goes up, almost touches it. So when you start having 2, 3, 4, 5 candles all running along a trend line, that's very good indication that this is a pretty strong trend and a pretty powerful trend line. So let me get this one a little bit more accurate here. See if I can get a little bit closer. Right, I like to get it right on the edge of that candle. So right there. Okay. So we see here, followed this trend line. Now, of course, you could have drawn one on the bottom as well. You could have been like, okay, well, I want to get my trend line on this bottom, and had a little bit more clarity there. And let's get a little bit closer right there to, there we go. There. So that point, you had a trend. You got trend lines on both sides, making a channel, a trend channel. So we see here the inside of this is the channel, inside of the trend channel, and it's making more of a cone cone shape here headed down. So, and sure enough, what happens? The stock comes down, stays inside of this cone, and then finally we get to this day and it breaks out of the trend. All right, whenever it breaks the trend, when you have a candle, and ideally a fully formed candle outside of a trend, that's a sign that, hey, we're changing directions. And here what happens, we have a candle get outside the trend, come sit right on top of the trend line, and then it makes its way up. So now, of course, you could have started drawing a trend line here, but of course that trend would have lasted you all of 2 days. And then we see that it proceeded to reverse back down. Let's go ahead and draw our trend line here. And sure enough, all right, so at this point, this channel is done. It's already broke out of it. No need to leave it on there unless, of course, it starts getting into that trend again. But in this case, it's not. So again, we see here, we start trending down, have one candle come up and hit it with a wick. Again, whether it hits it with a wick or hits it with the body of the candle, either way. See here, comes right up to it, comes down. Here, candle hits it, riding up against it. We see that this was a strong downtrend line right here, or trend line. And of course, you could have drawn it on the other side too once you started getting some width here. You started seeing here that once you had this candle jump out here, and then you had this candle, well, you got two candles you can connect now. Let's see if we can get that somewhat close there. And yeah, so here our channel starts. So I started at our first one here. Right here, hits the body of the channel, run, just touches that, the wick hits it, comes down. We see here it runs right through this one barely touches it, and then we see that it stays in this channel, this trend channel, all the way down until what happens? It finally breaks out of it. Breaks out of this trend channel, comes and sets right down on it, and starts a new trend. So, very simple. When you have a candle, or most ideally a fully formed candle, form outside of this channel, it's a good sign that the trend has been broke. And of course, in this case, it was very much broke. All right, so very trend channels are very powerful. Yeah, when you use them along with your moving averages, man, you can really see a beautiful picture. Now, when it comes to priority, which ones do I prioritize? Trend channels tend to be more powerful of an indicator than even your moving averages. Again, I've seen it run through moving averages like crazy, but get to that trend line and reject. But when it finally does break out of that trend, yeah, then you got some strong inclination that it's moving on to a different trend. Now in this case, this ended up being the end of the trend here for this particular move, monster move there. And then see, it finally breaks out of the trend, and then what do you have here? You start developing another trend. Now right here at the body of the candle, and let's see what we get here. There we go. Let's get it a little bit tighter here on this one. There we go. All right. So 2 days in a row, we got the body of two candles right here. We got 2 candles worth, and now we can start a trend. Sure enough, what happens? Well, you say, well, this candle went out well. It wasn't a fully formed candle outside. Remember when we came down to this one, candle broke out, came and set on the trend line, used it, because again, ideally, when it breaks out of the trend and sits on top of, or has a fully formed candle above or below a trend line or trend channel, that's a greater sign of a change in trend or direction. Now we see here, this one ran up, well, wasn't a fully formed candle out. Then what happens? Next day comes up, right there, little doji candle, hits, or hammer candle, whatever you want to call it, hits right up there, the top of the trend. Then this one runs right through the middle. This one comes up, hits the wick right off of it. So that right there, that's a pretty, see, we've got us a pretty strong trend channel there. And then what happens? Comes down here, breaks away from that trend line, and starts forming candles here. At this point, we start having 1, 2, 3, 4 candles, and then we start seeing them line up here. At this day, well, at this point, I want to draw a line, and at this point, when I see it drop down here, now I see, because again, at this point, all we had was the top. All we had was the top of the channel. So I didn't know if it was going to jump up here, because again, stock is always breathing in and out, going up and down, up and down. So when you have right here, where you have 2 or 3 candles that are all just straight in a line together, well, that's only one side of the channel. Okay, well, you hadn't been up to this point right here, you hadn't seen the other side of the channel. Well, then finally, what does it do? Bam, drops down. All right, 2 or 3 days. Now we see what the other side of the channel is. And of course, what's it do? It starts running up through here, and now we have a nice channel. Nice channel. Now, of course, it's a wedge, moving into a wedge here. As you see, it's coming down here into a point. Wedge channel. So from that point, you feel very confident until you get a fully formed candle or outside of this channel. And then sure enough, what happens? Bam, you finally get one outside the channel. Next day you get one, and then you get a breakaway from the channel. At this point, well, this channel is broken. Cannot be relied upon anymore. So at this point, we're looking for our next channel. So we see here, and of course we want both sides of the channel. So we see here, we get one here, okay, bounces up, all right, so now we're starting to see, okay, all right, so from this point, let's get these off here. From that point, once we break out of there, and then we get this, we're starting to see, all right, so we got this candle, and then we got that candle, okay, so see, we have 2 here, so that looks like that's probably the top of our trend. And then, of course, down here we have, in this case, this looks like, there you go. This looks like the width of the channel right here. Very narrow channel, but within 1, 2, 3 days, you had the width of this channel, this trend channel right here. And it stayed true for, until it broke out of it. It breaks out here. Now you could say, okay, well maybe we're just expanding the channel. Maybe right here we were just running more towards the middle of the channel. Well, In that case, once you see you have two candles here running pretty tightly, well, let's think, all right, we'll just, we're going to move it on out. The channel, or the flow here, the river, is a little bit wider than we thought. And we're just going to adjust it accordingly. So at this point, all right, let's see if, let's get some cooperation here. Okay, so there. All right, so you see how I'm doing this? A big crosshairs there. See this corner of the candle just hits up against there. Then this little wick hits up against it. So now we see, okay, now we have the full width of our channel here. Okay, all right, very nice. And then we see this was our channel until what happened? Whoop, get a fully formed candle outside of it, and it comes up and uses it as overhead resistance. Now from that point, you have to be, yep, you have to be looking at a trend change. And sure enough, that's what we had. So it continues here, continues. Now you might say, well, that's just really just widening of this channel. Because look at what we have here. We have this candle come down and sit on it. This candle now. This candle now. So that gives us a little bit more direction. Now we're saying, okay, well, we're still in an uptrend channel. So at that point, so it goes here, breaks out of the channel. Okay. Uses it as overhead support. And at that point, for 2 days now, well, we actually have a little mini downtrend. As you can see here, you got 3. So 1, or actually 4. 1, 2, 3, 4. 4 candles. 4 downtrend candles. 2 here. Well, and then what happens? Breaks above all that. Breaks back into the channel that we had drawn previously. So we see here these 3 days just ended up being an outlier. They were not part of this major trend we had going here. And again, look how long this trend held. This trend ideally started on the 7th, and it didn't truly end. It didn't truly end until had this candle right here break outside of it and then break further away. So really, yeah, 622. So yeah, needless to say, two and a half months stayed in this trend channel. And again, if you were trading based on this trend channel, you did very well. Because ideally, the strategy with a trend channel is when it hits the top of the trend, well, you have some confidence to be able to go short because you know it's going to breathe. You know the stock's breathing in here and then it's letting it out. It's going down right here, breathing in, letting it out. Breathing in, letting it out. So, yeah, it's the power of trend channels to really give you some confidence, even more confidence with your indicators. So it's very, very powerful to use. Now, of course, we broke out here, broke down here. Now you finally got to the point where you can expand. We see how it came down here. Well, now we can look to expand the channel. See if we have anything that we can line up here. Line up with this channel. And really, for the most part, yeah, not a lot. Really, we see we can expand it out to about right here. And that proved to be pretty decent because here, what do we have? We have one candle come down here and sit on it, another one right here, and then bam, it jumps back on top of it. So now we can see now that, well, instead of thinking this area right here was a breakout and trend change, well, it's actually just an expansion. Just an expansion of the trend that we're already on. And some people, you know, they like to draw it from down here. As you can see, we've got a lot of points of hit here, hit here, hit here, come down and wick right there. So this is the more, this gives you the whole breadth of the channel here. Of course, up in here, these, that was just little mini channels. Now we see the big picture. We see that, whoa, okay, now this is the monster trend channel here. And then we see here, as we come up, we never had a candle fully break outside of here. This one was very, very close, but not it. So a lot of people in this situation, hey, they were getting out of the market after it. Like, well, I got to see what it does. For me, I said I have to see what it does if it can truly break outside of this channel. And for me, sticking to that saved me from losing a lot of money on trying to go short or puts and all that kind of stuff. Because for me, what did I do? Well, I took this as a buy opportunity. When it came down here in this area, I said, well, I'm banking on it hitting. I think this is a pretty strong trend channel that we got here. So I'm banking on it hitting off and coming back up. And sure enough, that's what it did. And we see from that point, continuing to make its way up. So again, trend channels, and again, the bigger the channel gets, the more weight it holds. When it's just a little bitty trend channel, those can be broken when you start getting a trend channel that's going for months. I mean, what do you have here? This is all the way, back in March. Or beginning of April, March, this trend started, and it's been going now, for several months. That's a strong trend channel there. Get this one a little bit more. There we go. That's more correct. Look at all these points that are hitting on here. Nice and tight. So, yeah. So that's trend channel on a daily time frame, and of course, it works. You can draw them anywhere. Like I said, right here, prime example. You had multiple lines. See right there, that's a strong trend. And then at the top, strong channel there. See that it was in this channel for months and months and months. And then finally was able to break out of it, break on top of it, break away from it. And from that point, new trend. We see that this ended up being our new trend. Right there. Again, look at all these candles. All these different candles that come up here and hit the top of the channel, riding the top of the channel, down to the bottom of the channel, top of the channel. Then we see with the big drop that, drop below that channel, fully formed candle beneath the channel, broke here. So just based on that, if somebody was just using trend channels to, give them some insight on when the big drop here, once you've seen it drop out of this downtrend channel that had been holding for months, that was a big sign. Or if you wanted to draw it right here. There you go. I mean, that was many, many months. Good 5-6 months there. It was in this trend channel. Bam! Finally breaks out, fully formed candle below. Honestly, I don't see how anybody that respects technical analysis would not have been pulling out of some positions right here. And if you did, you were very well rewarded for it. So, that is trend channels on the daily. Of course, again, you have these work on all different time frames. Hence the reason why we're about to go to the intraday and see what we can do on an intraday time frame. So let's go ahead and clear our drawings. And let's see. So we're at 5 minutes. just use a 5-minute for, okay, so we start the day here. Start of the day. What do we see there? Start getting some nice candles uptrending. Oh yeah, we're looking good. Everything's good. And then bam, fully formed candle outside the trend line. Oop, okay. Look to get out of that position, or be ready to get out of that position. And then what happens? We start a downtrend. And sure enough, we start connecting downtrend lines. Let's see if I can get this to cooperate. Oh yeah, so we have two different candles. So this right here, nice downtrend, and then of course we can make a channel. We got 2 points here that we can use to make a channel. This trend is broke. We don't need it no more. And this ended up being a nice little downtrend channel right here. And finally, what happens? Oop, candle breaks out above it, sets on top of it, and a new channel is started. And of course, from this point, don't need this channel. It's done. It has been broken. And then we start getting 2 or 3 candles here to line up. And the top of the channel. There we go. So, nice channel. Again, got the top of the channel, bottom of the channel, running through the middle of it. Top of the channel, hits the bottom. Right here you say, well, this was a close, this was, yeah, technically you say, well, it's a fully formed candle outside. Like, okay, all right, well, you're still in a strong uptrend. And again, that's where having our moving averages on here as well would give you even more insight and indicators as well. Momentum indicators and such. Really where you see this is comes down here, pierces through it, okay, and then bam, next candle, not even touching it. That's a strong sign to get out of there. Again, let's just say when you've seen it start the new trend here, really was right about there, 312. Yeah, almost $2 at that point if you just were trading based on trend channels. And then from there, we get our new channel started, and yeah, it holds well. Get that one off the board. I don't know why it's giving me a new line here. Okay, so that one off the board, that off the board, that off the board. Thank you. Okay, and then you start up here. You get 2 points, multiple points that you can start drawing a channel with, and there you go. Channel holds strong, really until yeah, you got a strong downtrend channel when it falls out of the bottom of a downtrend channel. So there you go. That's trend channels for intraday purposes. So it's not rocket science. You just need 2 or 3 candles to start making a link with, to connect, and from that point you can start getting an idea of your trend. So it's pretty basic stuff, but at the same time very powerful. Trend lines are definitely to be respected. You can make a lot of money just respecting the fact that more than likely, of course, you always have the point where it breaks out, but until it breaks out, look at this, whole day in a trend channel. Beginning of the day here, end of the day there. Spent the whole day in a uptrend channel, or an ascending wedge, slightly ascending. So powerful stuff. So right here, I mean, you can, again, using it to trade off of. You see, you get rejected here, and then rejected here, and then you can trade based off of that. Say, well, when I see it starts getting rejected, I'm jumping into a short or a put. And then when I see it come down here, get rejected. Well, I know that's the bottom of my channel. And what it do? Sure enough, went back right back up to the top of the channel. Down to the bottom, up to the top, down to the bottom. So, that is the power of trend channels. So, hope you got some value there. Of course, trend channels, like I said, you can have a shorter term, longer term, and they're open to your interpretation. Because take, for instance, you could say, well, I want a more precise channel in this situation. So let's just say you were like, well, I want that to be the top. There you go. You could have said that was the top. Or you could have said, well, I want it to be even more precise, even more candles hitting. We see right there. Look at all the candles hitting and rejecting. So, again, it's one of those that, yeah, again, they're channels, trend lines, trend channels are open to your, your interpretation of them. But more times than not, if you're using them, like I said, and of course you can always draw multiple trend channels. If you feel like, in this case, feel like this is the upper limit of it, and this is the more inner side of the channel. Hey, you can use that as well. So all different varieties of ways you can do trend lines and trend channels, but needless to say, they're very, very powerful. So hope you enjoyed that part on trend lines and how they are just another piece of the puzzle that gives us the big picture of what we're looking at. So ultimately we can make more informed decisions. So hope you enjoyed that. Thank you. Welcome back to the Precision Indicator course. In this portion of the course, we're going to be going over support and resistance lines, or buying lines or selling lines, or historical points of buying and historical points of selling. All different names used, but ultimately they mean the same thing. So with our trend lines, of course, those can be going in any direction. They can be different shapes, different cones, all these different things. But with support and resistance lines, these are going to be just simple horizontal lines where multiple body candles or wicks touch, showing that at this level, at this price, we have buyers and we have sellers, or we have sellers. You always got buyers and sellers, but some areas what you'll have stronger areas of buying, stronger areas of selling. So let's get right to that. Crash of 2020, SPY. Of course, let's go back in history a little bit. So prime example right here. What do we have? We got 1, 2, 3, 4, 5, 6, 7, 8. Wick come down here at 9. Wick comes down here 10. 10 candles right here at this $3 or $320. What happens here when we see when the stock got on top of this support? Because again, at this point, we go back in history, it was overhead resistance. Stock was hitting its head on it. So we see it hit its head here at this candle, 3 candles, and then bam, finally was able to break above it. So it proved to be overhead resistance until the stock showed that it could break above it, sit on top of it. Now at this point, it becomes support. Okay, so anytime a stock breaks overhead resistance, it can punch its head through it and jump up and stand on top of it. You can kind of figure it as, say you went through, punched through your roof and jumped in the attic. That's kind of what you're looking at here. So, and in the same way, See, it came down and it finally broke through this support, because again, it was support for months here. And it finally comes down and breaks through this level of support. You can think of it as punching through your floor and going into the basement. And anytime you go from one level of support and resistance, ultimately the stock is heading in a direction. It's heading towards, ultimately it's heading towards another area of historical buying or selling, strong buying and selling. And then we see it comes down here, continues making its way down, and then notice what we got here. This right here, another historical line. Why is that? Look at all these different candles. Because again, if it was support and resistance in the past, more than likely in the future it will pose some support or resistance. Sure enough, what happens here in the past, it came up, again, focus on my big crosshairs, came up, hit its head on here. Oh, so that's overhead support, came down, tested it again, finally broke through it. Not for very long, came back down through it, finally punched through it again, and then it sets on top of it, and then finally is able to stay on top of it and continue higher. So right here, this 312.75 was a historical area where you had a lot of buyers and a lot of sellers. At this point, you had sellers, and then finally, when it finally was able to jump on top, okay, the buyers, you had more buyers than sellers at this point. Stock goes up. Okay, and we see that. Because again, you can have a good idea where the stops will be. You see this drop right here? We have a good idea where a lot of our stops will be at based on what happened in the past. So let's see, let's get us some other lines of historical support and resistance. There's one right there. Okay. Now, see if we can get that line really straight. There we go. Now, why do we say this is a strong level of support? Well, look at all these areas where the candles came down, set on it, wicked on it, came back down, wick right there from touching it. And then sure enough, in the future, what ends up happening? Come down here, wick just above it, and then you have a full body candle come sit right here on top of it. So, but what happens? Well, the next day it breaks through there. Well, where's another level? Sure enough, right there. Why can we say that? Well, look at right here. This was historically another level. Breaks through it, sets down on top of it, finally breaks above it, comes down, retests this level right here. We find buyers. Again, when we say support, when we say it finds support, it finds buyers. A lot of buyers want to buy at this point. And sure enough, what happens? Comes down. You have two candles. Well, actually three. One body candle, one wick candle, and one body candle sit right here on it. So, what about as we make our way down? What's another major level? Well, actually right here. Wouldn't you know? Sure enough, as this major crash was going, it made stops at pretty much all these major levels of, look at this right here, support. Look at all these candles touching and wicking off of this level right here. And then what do we have at the crash? Sure enough, goes down through it, hits its head on it, continues its way down. So, yeah, it's here's another historical level right here. We see all the way back here in 2018, came down, hit off of it, supported off of it, and then we see when we coming through this little mini crash here in 2019, what happens? Breaks through it, then comes back, sits on top of it, and supports itself, and then rockets off. And then at our crash here, sure enough, what do we have here? One candle sitting on it, another wicks it, another wick hits it, here, sitting on it. So again, very, very strong level of support and resistance there. And even here's another historical level. Even with the big crowd, I came all the way down here, and sure enough, at $2 or $233, 233 or 244, what'd you have? You had a lot of buyers right there. A lot of people wanting to buy at that point. And of course, it made its way up. Well, what happened in the crash? Was there buyers at that point? You better believe it. Sure enough, wick comes down, wick, candle, wick sets on top of it, and then rockets off of that. So that was proved to be a strong level of support. Now, what about at the very bottom? I'm not even going to look in the past yet, but let's see what here. See if this ends up being a level of support. What is that? $223. So let's fast forward through history and see if there's ever a point that hits off of that. Oh, wouldn't you know? There's a point. Where else do we get some scoot back in history here? Does this prove to be a level of support and resistance? Sure enough. What happens? It comes up here, breaks through it, comes right there, sets on it. Right there, look at that. Wick literally comes down and sets on that 222 or 223, goes up from there. Let's see if there's any other levels historically that support off of that level. Or that was an all-time high. Yep, that was an all-time high. But see, it was supported all the way back in 2017. So yeah, and we also see that's where it broke out of a big trend channel as well. Yeah, it broke out of a major trend channel there on its way up to big time gains. We see trend channel. Let's quickly draw one here. Okay, trend channel there. And let's get another trend channel. See, this was the bottom of the channel. So, interesting. Yeah, that's a multi-year channel there. Monster channel. So, that was history based on those support and resistance lines. And again, we see all the way down to the crash, it was supported. All those buying, those historical levels of buyers and sellers at were supported. Yeah, very much supported. So, let's see if these lines hold true on our way back up. Which, hold on, I forgot to put one here. Again, when you see an area where you have multiple candles and wicks, what we have here? Candle came down, set on that wick here, so this is another major level. Also, too, here you had two different candles come up, set on it, and then hit its head on it. So that's another level. So basing it off here, and then let's see if it held true on the other side. Well, let's see here. So we come up, we'll start from the bottom here. So we break above that, get to this next level. What happens? Sure enough, candle comes and sets down on this, becomes support, goes up, hits its head right here on this level, comes back down, gets on top of it, sits on it. Candles here on these levels of support and resistance. Finally, it jumps on top of it, able to go up, and then look at all these other levels of support and resistance. So, and then once you start getting all of these points, then if they line up with points back here, that's even gives you even more sentiment of a strong level. And sure enough, this ends up being a really strong line. You got candle hits here, candle wick comes down there, body here, wick there, wick, body. So very strong level of support and resistance. So yeah, very, very powerful. So, and then you can, of course, you want to combine these with your trend channels. That's always a really good thing to do. So let's just say you were doing a trend channel. This was the most recent one that I personally did, and I felt like it was a very, very strong line of support and resistance. Let me see, it ended up being right, where was it at? Right about through there. That's where I drew a channel for myself. So, and it ended up being, here was my other channel that I drew that I was using as my guiding lines. Because again, I don't always go out to the very outside. You know, some people, they want to come, they want to come and do the outside of the outside. Take for instance, you got a lot of people that did a trading channel based on this, and then they were like, oh, candles are broken outside of this, so I'm out of here. For me, I feel like where you have the most amount of candles hitting, I feel for me that's a stronger, because in here you see on this trend channel, look at all of the instances where the candles and the wicks hit this line. This is a strong line. And then sure enough, what happens, because a lot of people, they thought it was going to the moon. Yeah, thought it was going to the moon when it broke outside of this trend line right here. Yeah, people were starting to get, because again, it was supported. Actually, it started all the way back here. Candle there, candle there, candle there. Wick, candle, candle. So they broke out here, and they're, oh, okay, it's going to the moon. Well, it went up too fast, and we see that so far this has proved to be a much stronger trend. I'll tell you what, probably make it easier if I make this channel a little bit thicker. How about that? Well, okay, there we go. Well, we need to make it bigger, don't we? So let's make our line bigger. There we go, that's better. So, and then our top of the channel line is there. So, that helps you to see it. Now, the idea is, as you're going through this channel, you can use these support and resistance levels as areas where, well, you see it gets rejected at a level. You can buy or sell based off of that, or that the stock is more than likely going to make a stop there and have a cup of coffee, hang out for a little bit. And we see that these trend channels, these are the ones I personally drew when I was relying on. Because again, why did I rely on these and not some of the others? Again, you had other people that were going based on, here. So when they seen this, that it came outside of this, broke out of this trend, this ascending wedge here, they're like, oh, I'm out of the market, I'm shorting like crazy. Well, for me, it's like, no, I didn't, because again, you didn't have near the amount of support in here as you did in here. Of course, wants to draw me an extra line. So, again, this was the trend line I was using as my guide, and yeah, it proved very, because again, it was supporting all the way back here in the crash. This was a strong line, and it proved what happened. This is why when it came down here, hit off the bottom of this trend channel, I bought. Because what did I have here? I had this, and I had this level right here that I knew there was a lot of buyers, this support level right here. I knew there was a lot of buyers here, so I felt very confident in this area. So, and I was rewarded for it. So, with that said, that is your support and resistance lines. And what's nice is you leave these on the daily time frame, and then when you go to the intraday time frame, yeah, you can use these lines as guides, knowing that, you know what, whenever the stock gets to some of these lines, it tends to report support or reject off of it. And we see we'll go back through time here a little bit. That's exactly what happens. What happens? It comes up, hangs around at this support and resistance level. Plenty of buyers and sellers here. This day comes up, hits its head on this support level, comes back down, rejects off, comes to this support level down here, comes all the way down, bounces off of it, goes back to the top, rejects off of that, and comes down, almost touched it, goes back up, rejects below. So, yeah, it's even intraday, when it gets to these major levels of buyers and sellers, it supports. It usually will stop, reject, hang out for a little bit, have some coffee. What happens here? Spends a whole day between these trend lines, or spends days rather. Again, we're on the 5-minute here, but this is, yeah. Tell you what, let's go to the 30-minute. Get a bigger view of this, and see what we got here. See if we can get a better view on it. So, look at all this respect for these support lines or areas, historical areas of buyers and sellers. Comes down here, supports off, runs up, goes to the top, hits off, breaks to the next level, goes to the, never fails. It goes from one area, historical area of buying sellers, to the next area. We see this, he had days and weeks. What is this, 2 weeks? 2 weeks stayed bouncing in between these support and resistance lines. Buyers here, sellers here. So it's, yep. And again, it holds true as we go back even further. See here, rejects here, support, reject, support, reject. Finally breaks above it. Support, reject, reject, support, reject, reject. Finally breaks through. And yeah, and a lot of times too, what it has to do is to really get through some of these strong areas of historical buyers buying and support, a lot of times it has to gap through it. See here, gap, get away from it, gap away from it, gap over it, gap under it, gap over it, gap over it, gap over it, gap over, support, gap over. Yeah, because again, that's what the after hours, when you see that big gap there, yeah, what happens is, yeah, this is the aftermarket hours. It's a lot easier to get through support and resistance areas. Yeah, after hours. That's why a lot of times you'll see these major areas of support and resistance will be gapped through. What happens? Comes up here, hangs out, has a cup of coffee at this support resistant line, and what does it do? Whoop, whoop, gaps down below, on to the next. Gaps below it, gaps up to it, sets on it. So yeah, needless needless to say, again, so again, when you're trading, it's good to know these levels. Many times was able to make nice money just knowing that, hey, say right here, when it was going up here, I'm like, okay, all right, well, it's going up. But I know in my mind as it's making its way up to this line right here, that when it gets to it, it's going to, it's going to hang out. It's not going to it ain't going to just blow through this, and run to this one. Nope, it's going to stop, have a cup of coffee, hang out for a little bit, and then do its thing and decide whether, there's enough buyers to continue up or reject down. So very rarely are you ever going to see a situation where the stock totally skips a support and resistance level and just runs to the next one. You don't, you don't see that. You don't see that very often. Nope, not at all. And when it does happen, it's definitely getting stopped to the next one. So take, for instance, here's a prime example. Comes up here, gaps over this strong level of overhead resistance, but it didn't make it very far. Hits its head on the next level, comes back down. So yeah, just keep this in mind. It's nice to go ahead and draw these, have them on your chart. That way, whenever you get into intraday time frames, or you're looking at stuff for swing trading, you can use these lines. Use these lines to give you some insight in when the stock is probably going to make a screeching halt, or at least slow down for a little bit. So anyway, so again, that's historical levels of buyers and sellers, or support and resistance lines. So hope that I helped you out there, and thank you for watching this part of the Precision Indicator course. We'll see you in our next part. Welcome back to the Precision Indicator course. In this part of the course, we're going to be looking at some swing trading strategies, things that you can implement for yourself. Of course, please feel free to put your variation on it. But let's get right to it. First things first is anytime you're looking at swing trading, anything like that, or long-term trading, you want to look at the daily candles, and also to the support and resistance lines in those areas. Okay, that by doing that, it gives you more pieces of the puzzle. Okay, take for instance, when you see these support and resistance lines, and then you see these major simple moving averages, it can give you some nice insight on where the major trend is heading, and which side of the trade that you want to be on. So first and foremost, you want to look at the overall trend that's taking place, and then go from there. And also too, having your trend lines in there, also very beneficial as well. As a matter of fact, I'm going to go ahead and put those major trend channels in that I was trading based off of. And okay, so one was there, if it wants to stay there. Okay, that was one of my trends. Again, all these different points of support and resistance. Let's see here. Other line was right about there. So it's a major trend channel there. I think I went a little bit higher. I actually started this channel right in there. That's where my preferred channel was. Okay, so now with that knowledge, the trend support and resistance line just drawn, your trend channel drawn, now we can go into intraday time frame, and for this particular swing trading, we're going to look at the 30-minute or the 1 hour, and see if we can get some swing trades out of that. So just a basic swing trade strategy is one that I like personally, is the crossover between the 6-period moving average. Okay, again, we're on the 30 minutes. I like to use either the 13, which is here is green, or the 21 as a crossover. Okay, so I'll tell you what, let's clear some of these other studies off of here so we can get a little bit more clarity on what we're looking at. Okay, so just left these up here, left the 30 as our major buy and sell line. All right, so let's see what we got here. So again, let's go to our first cross on our time frame here. We have again, for this time frame, we're looking at the cross. It just depends on your preference, okay? But for this purpose, we're going to look at the cross between the 6 moving average and the 13, or the 6 and 21. Okay, but let's focus right now on the 6 and 13. So simple strategy is when the 6 and 13 cross each other, get a hard cross between the 6 and the 13, makes a nice little X right here. That's a signal to enter a swing trade. And then we're in that swing trade until the 6 crosses back through the 13, or if you want to, or you can scale out when it crosses through the 13, take off some of the position, crosses through the 21, take off some of the position, and then 30, you can be completely out of it, or wait to see what it does based on the 30. So what happens here? So it crosses all the way back here at $302, way back here. And then you don't get another cross on the 13 and the 30 until this very last day right here. So, yeah, nice $10 move in the S&P right there. So, which for me, I would have definitely taken some position up here, because anytime I see, remember from our going through our moving averages, anytime I see a stock or a candle jump way away from this 6 moving average, it's going to revert back to some degree. You're not going to have this crazy amount of distance. And sure enough, what happens? Got way away from it and came right back to it. Right back to it. So, I'll tell you right now, yeah, I see that kind of jump. 1 day jump away from, and also too, something to keep in mind is when you have gaps, major gaps like this, to the start of a day, this more times than not, I'd say about 80% of the time, those gaps fill back. And what happened here? Sure enough, you had this real big gap all the way from 311, ran up to 315, and then sure enough, what does it do? Makes its way back and fills this gap. And of course, there we go. We see that this one almost comes down and touches it, and then this wick completely comes down and touches it. So that gap was filled. A lot of people do gap trading. That's their strategy. They trade gaps, banking on the fact that the stock will fill that gap that it made there. Yeah, fill it back in. So, and again, good percentage of the time, I'd say a good 70-80% of the time, it will do just that. So, can't argue with the strategy. Not a bad strategy. So, we see here that would have been a nice move there. Again, using the 6 MA and the 13 MA simple moving average as crossover, as entry and exit. Okay, so let's go to our next major cross. Let's see here. Well, let's see. See how they're running together right here, really tight, and then it slowly breaks away from it. But then we see this down sloping 30 really hard right here. For me, yeah, you could have got in at this point. Whenever the 6 and the 30 cross each other and they start making a little bit of seperation, you done that. You could have, It ran up real nice. $3-4 move. Jumped above the 30 and then came right back to it. But we see that the 6 MA, what did it do? It ran to the 30. Ran to the 30 right here, ran right up to it and rejected off of it. Came right back down, crossed through the 30. So we got a cross right there at 301. And our next cross was, yeah, so right around break even on that one. But again, you want to be leery. Again, we're looking, in this situation, we're using the 30 as our major buy and sell. Again, we're below the 30. The 30 is downtrending. We're in a downtrend, so it's always good to go with the major buy and sell line and the trend of it. We see when they crossed here. The 30 was leveling out, which means we're more than likely going to get a change of direction. And sure enough, what does it do? Starts trending up in that direction. So let's look at the next example of a cross between the 6 and the 13. All right, here's our next example. Really right here. Hard cross through the 13 and the 6 right here. 6 here, 13 here, cross right there at that point. 312, you're in the trade until you have another cross between the 6 and the 13, and you didn't get that until, yeah, right around 304, so cross right there. So 312 all the way to 304, yeah, it's an $8 move. That's a nice little swing trade there. You were in the trade for about a day and a half, so not bad. And to what here was also some even more confirmation to get in this trade. What happens here? Comes below this support and resistance line, hits its head on it, so it's now overhead resistance. And sure enough, what happens? Comes down to the next support and resistance line. So yeah, using all the little pieces of the puzzle. Okay, so from that point, we just get some sideways, really just sideways. You see like I told you before, when all the moving averages are nice and tight, I don't really like that. Oh yeah, and then we got our major trend line right here. We got that as, so what's a nice example of that? So let's find another area where we get some nice clear separation between the, all right, here's one. So bottom of a downtrend, the 30 is flattening out. We get a cross between our 30 and our 6 right here. Get a nice cross between the two right here. 301, 302, and then we're looking for our next cross. Doesn't happen until right here in this area. Yeah, 312. So yeah, $10 move right there. You're in the trade for, let's see here, about a day and a half. Day and a half swing trade. And again, also too, what you had your this sloping trend channel line right here. So when they crossed here, you should have had in your mind, hey, more than likely when I get up here, we're going to hit off of it. Yeah, or another example is look how the stock broke way away from the 6, jumped way up here. Got to take some profit there. You see that kind of jump away from the 6? Yeah, you know what happens. Sure enough, jumps way up here, and then bam, right back to it. It's like a magnet. Like a magnet. All right, so let's go up here to another point. So we have the 6 and the 13 crossing right. Oh, right here. Well, they were really tight, actually starting to get really tight right in here. So, man, that would have been nice if you could have got in right at this day, because sure enough, what was it the following day? Had a major drop to start this day. Yeah, that was a nice drop. Yeah, if you'd have got in there. Another thing you'd have been looking at as well is the 13. Look at the 13. 13 starts getting flat, and then you see this day, the 13 starts turning down. All your moving averages start on this day. Everybody starts trending down. So even right here, you could already tell that, yeah, we're about to get some downtrend going, and sure enough, we got some hard downtrend there. Again, we're on the 30-minute time frame. Let's see what we got here. Our next point where we get a hard cross on the 13 and 6 was really when it gapped up here. Hard gap there, and then you get a cross right there. They start running beside each other. Well, it wasn't really a cross. They just bumped into each other, and then really your cross doesn't happen until right here. So 321. So yeah, 317 to 321. That's still a nice little trade there. In it for 3 days. Not bad. All right, our next example where we get a hard cross on the 13 and the 6 is the next hard cross is here. Okay, so what do we have here? Hard cross here. Jumps above the 30. That's a good sign. 30 is uptrending. Tell you what, let's get this 21 out of here because it's for this swing trade strategy. It's not necessarily needed. So nice cross here. So let's say comes up on the 30, sits on the 30. We feel confident there. 303, and then where is the next place that the 6 and the 13 cross? Get a nice cross right here. Get a cross right there. But again, in this situation, you can say, well, man, the 30 is right here. It's still uptrending. I want to see what it does based off of the 30. And I know I have this trend channel right here that it's on top of that's using support as well. So, but let's just say worst case scenario, you for sure got out right here at your hard cross 311, and then our entry point was right here at support, jumped on top of the 30, cross right here, 306. Yeah, I'll take that swing trade money. That's hard to argue with there. And then hey, in this situation, you said, well, I'm going to use the 30, the fact that the 6 didn't cross the 30. I'm going to hold a position until I see the 6 cross through the 30. Well, if you would have done that, you would have been very much rewarded. Because again, you don't just have to rely on the 6 crossing through the 13. Again, when it's this close, I mean, what are we dealing with here? Yeah, $1 or so. I mean, very easily just say, okay, well, I want to see what it does, see if the 6 crosses through the 30. Especially when the 30 is uptrending, I want to see it cross through that 30 before. Now, if the 30 was leveling out right here, and it, and this right here was happening, then yeah, I would have been more apt to just get out of the whole position. Even though I knew I had support right here on this uptrending channel right here. But, and if you'd have done that, you would have been handsomely rewarded. Yeah, ideally, if you would have waited till the cross through the 30, because up here they came close, they bumped into each other, 6 and the 30, they cross a little bit here, but again, the 30's right there. When they're that close together, hey, let the 30 be your guide. Wait for the 6 to cross through the 30. And then we finally get across through the 30 right there. 321. Oh, that could have been a monster trade there. Yeah, that could have been a monster trade. Yeah, that's so. Yeah, $20 could have been if you just, again, now if you wanted to sell some of the position whenever you've seen this little cross through the 13 right here, that's understandable. But again, you got an uptrending 30. That should tell you, hey, I want to see what it does on that 30. Because they were that tight already. I want to see the 6. Is the 6 going to go through the 30? Yeah, so if you'd have saved some of that position, you'd got almost a $20 move out of that swing trade. That is some good money on the swing trade. So yeah, not too bad. So again, like I said, you can use the 13 as your exit. When you see the cross, you can use that as that, or you can wait for it to see what it does in relation to the 30. All right, so our next decent cross we got here. Let's see, right here we get a hard cross between the. Let's see, we get a hard cross between the 6 and the 3rd. Oh, is it the same? Is this the same day or is it a different day? Oh, no, it's different. Okay. So, hard cross right here on the 6, 13. Yeah, so say we enter at that point. That's 280, 281, somewhere in there. And then we're in the trade, waiting for a hard cross on the 13. Look at this. Look at this reward you're getting here. We see them, the 13 and the 6 start rubbing up against each other. Not really a hard cross. And then at this point, we're getting so close to the 30. So close to the 30. At this point, it's better to just say, hey, I want to. Now, if you want to sell some of the position, half the position, or just get out, hey, totally understand. Take your profits. Nobody ever went broke taking profit. But in this situation, it's like, for me, I want to see it go through the 30, our major buy and sell line. And we see, where do we get our cross through the 30? We don't get a cross through the 30 until right here. So 294 all the way down from this cross. 280. $14. $14 on that swing trade. Not too bad. That's yeah, I'd say that's a mighty fine gain you get there. And then let's see here. Here's another cross. So we get the cross on the 6 and the 30 and 13. So let's say we entered there, 295, and then we get another cross on the right at there. Yeah, 295. So yeah, out of that swing trade for break even. Because yeah, nice and tight here. That would have been a risky one to stay in. Risky one to stay in. All right, so our next big cross, what do we have here? 13, 6 cross, major cross right here. And then if you wanted extra confirmation, you could have got in when the 6 crossed the 30. And what happened, the 30 was starting to level out, signaling a trend change. And let's just say worst case scenario, you got in when it crossed the 30. So right around 291, and you're waiting for a cross. Well, for me, I know I would. Look at this. Look how far it got away from the 6 right here. I know one thing. This guy right here would have been taking some profit right there. And that would have been what potential move we had there. 291 all the way down to 276. Yeah, that's man, I'll take that $15 move. I'll take it. And then we finally break away from that and start an uptrend. Cross on the 6 and the 30 there. So right around 281. And then we don't get another cross until up here. Yeah, we already looked at that. Was the one we just looked at. So monster move there as well. So what do we got now? Making our way down here. Let's see. You got the uptrending 30 right here. So that is a in this situation, yeah, it's yeah. Why not see how the 6 reacts to the 30? And yeah, because you had some choppy. You're inside the channel, so you have confidence there. You're at a buy, and also too, you're at a level of support and resistance right here. So for me in this area, yeah, I'm kind of hesitant because I know it likes to get a little sideways movement when it gets to one of these levels. So I'd have been a little hesitant to jump, just carelessly jump into anything. But let's see here. Where's a hard cross? Hard cross right here on the 6 and the 13, right around 286, and then they cross back through each other right here. Yeah, right here. So really, you'd got out anywhere in here. So anywhere from 284 to 286. So yeah, $2-3 move, not bad. And then they cross through each other right here. 13 and the 6 cross through each other right there. 287. And then what happens? The 6 comes down here, just crosses through the 13 just a little bit, but again, the 30's right here. It's like, well, why not see what it does in relation to the 30? So let's say hypothetically we entered here 287, waiting for it to cross the 30 or do a hard cross on the 13, and then we get that really right here, hard cross right there, nice little X, or if you wanted to wait for the 30, there's the 30. So, needless to say, that would have been a pretty decent move. So, 286 all the way up to 292. $6 move. Not bad. Not bad. Okay, tell you what, let's go back to the beginning, the last day we get available on this chart. So, well, we got a cross way down here, but we can't see it. That would have been a nice, from there to there, wait, from this to this cross. Oof. Yep, that would have been, and of course the 30 is way away at, way away from this cross. Again, when the cross is close to the 30, yeah, keep that in mind. But anyway, let's just use this hard cross. Nice cross right here between the 6 and the 13. The 30, our major buy and sell, is uptrending, so we feel very strong about this. The 6 is uptrending, 30 is uptrending, hard cross through the 13. Let's get in there. So 271, and then we get another hard cross right in here around 277. So nice little $6 move there, not too bad. You say, well, why shouldn't you have waited to the 30? Well, look at the distance between them. I mean, you got at the cross, you got a $4 move. It'd have been one thing if they crossed, within $1 or so of the 30. Held some position for that. But when they cross way away from the 30, yeah, and it's a nice hard cross like this. Yep, go with that. So that's that hard cross there. So you got into a shorter put there for this swing trade. Looking for the next hard cross on there right here. So 275. Yeah, $3 on that swing trade. Okay, and then they crossed here hard, and so you got into a long position here or a call position. And where's the next cross? Oh man, that stinks. Yeah, would have came down. You'd have stayed in this trade, boy. You'd have been disappointed because you'd had a nice around a around a 274, 275 move all the way up to 284. Almost a $10 move. And then, bam, what do you get? A massive drop. Yeah, but at this point, you're $9 up on the trade. Ugh. Yeah, hard not to take some profit whenever you start getting above $4 or $5 move. Yeesh. Yeah, that's hard. It's hard not to take profit. I'll be honest with you. No, not especially when you see that kind of money in the account. So, yeah, couldn't have faulted you for taking some profit there. But if not, you still would have came out on the trade ahead. Instead of an almost $10 move, you'd have got a $2 move. Yeah, so, is what it is. That happens. And then your next cross right here. But again, your 30 is uptrending right here. Still uptrending, and then you get a cross. For me, that's a no-go for me. I want to see the cross trending in the same direction as this major buy and sell 30. Okay, and that's not what I get right here. And was I rewarded for going with the flow of this major buy and sell 30? Yes, I was. All right, so because really it trends down here, and then it starts flattening out, and then it gaps up to the next day. So yeah, if you'd have been sitting on your hands on that, I totally understand. Because then you start trending up, and then you get a hard. Oh yeah, another thing too about this they're just running sideways, and then you get your cross right here, right in there. Yeah, I mean it's up to you. I mean you could have up to your discretion. You say, well, I get a hard cross here, you know, got a pretty decent X right here, some separation between them, and then they're both the stock comes up and sets on the 30, because that's another thing too. You got to keep in mind, what are the candles doing in relation to the 30? So yeah, if you'd entered here, it's totally understandable. You get a cross on the 6 and the 30 here, separation between the two, and the next candle, this next candle comes and sets on the 30. If you'd have been in that trade, totally understand it, and you would have been, yeah, you would have been nicely rewarded there with a $6 move. So again, these are all things you have to take in consideration. Yep. So yeah, that does it for the swing trade strategy on the 30 minutes. Of course, this strategy still holds true on the hourly as well. You want to hit up the hourly. Now on the hourly, yeah, you probably want to rely more on the cross between the 6 and the 13 for sure. On the hourly, it'll be a stronger guide because the 13 is a stronger, whereas on the 30 minute, the 30 is a very, it's very strong buy and sell. Well, on the hourly, the 13 comes stronger, and of course the 30 is just that much stronger, but it's not. Yeah, on the hourly, I like to, I give the 13 more respect on this as far as getting out of trades. Whereas before, I'm like, oh, I'll wait to see what happens here. Look how far the 30 is 308. Yeah, $4. So, and then now they're not crossing yet, but yeah, if it was crossing the 13 right here, I'd be out for sure. I'd be out. Yeah, but again, on the hourly, like I said, right there, beautiful cross right here. Beautiful, beautiful profit there. Yeah, very nice profit. But again, you got to realize you're going to be in trades a little bit later and out of them a little bit later on the hourly versus the 30 minute. But you are going to get more clear, concise crosses. Like I said, here you get a hard cross there. And then you get your cross there, downtrend. So, at the same time, using the 30, like I said, you could save a trade to keep the 30, keep it in your pocket for waiting for it to cross the 30. Because here's a prime example: the 30's uptrending, 6 crosses through it right there. Cross through the 13 right there, 295. Doesn't cross through the 30 again until really, is it this candle? Well, let's see if we can get a reload here. If not, that'll be the end of this trade. Yeah, that's the end of that one. All right, welcome back to the Precision Indicator course. We got cut short on our swing trade strategies on the hourly time frame, the 60-minute time frame. We were just looking at a pretty monster gain, and again we were looking at the cross between the 6 and the 30. Where were we at? Yeah, we were right here. Okay, we had a cross right there. Cross the 13 right there at the right there at the 30, 295. And again, the 30 was uptrending here, 295. And in this situation, let's say you were playing the wait till it crosses the 30 again. Wait for the 6 to cross the 30. And what do we get here? Oh man, they were like, at this day right here, they were just crossing. I mean, this is pretty much an inevitable cross here. So yeah, if you'd got in there, you'd have been got out there, you'd have been handsomely rewarded. 319. Where did it start at? 295. Yeah, I'd take that 18-point move. Yep, for sure. See another example on the hourly where it crosses the 30, working with the trend. Okay, here's another example. 30 crosses the 6 right there, somewhere in this candle body, 288-ish. And again, for an exit point, on the hourly, the 13's going to be much more precise. A lot of distance between for the 6 to go to get back. Now, granted, you'd have still made some if you'd have exited or got in below the 30 and exited when it went above the 30. You still made a little bit of profit on your swing, but not much. Not much on the hourly. Really, for your exits, at least portion of your trade. Yes, please get out when it crosses. You see a hard. Yeah, look how hard this cross is between them. And it's right here at this. Again, you're at a trend line coming down, jumps on top of it, all that. Yeah, even more insight to get out of a short position. So, again, it just depends on the context and where you're at. Yeah. So, as you just go back and you back test through this a little bit more, the strategy of the 6 through the 13, and in certain situations when they're nice and tight, the 6 through the 30, hey, you'll get a better feel for it. So, just wanted to share this this little swing trading strategy, and of course, too, this, if you throw an indicator on here, you'll even have a better guide. Let me go ahead and, why not? Let's throw one of our awesome indicators on here. Let's throw Mr. RSI on here. See what he can help us do here. Remember our RSI settings, 30, and then our levels. See what? I'm so sorry. I don't really like the RSI. The RSI is just poor man's CCI. I want to show you the stochastic. Spent a lot of time on the CCI with you, not as much on the RSI. So let's get a little bit more RSI education. Let's get our settings straight first. Oh, I love whenever it straightens all my lines out. Okay. Be patient with me. Okay, off, off, off. Okay, so remember our lines, our major support and resistance lines on the stochastic are 95. They are 80. They are 40. They are 20. Come on. You can do it. Okay. And then 6, 7. Right in that 6, 7 range. Right in there. So, okay. Remember, so above 80, we're bullish. We start getting to 95, we get a cross on the 95. With both lines, the fast and slow. Remember, our slow is the red line, fast is the black. Get a cross on the 95, it ain't going to be there. It ain't going to be hanging out there very long. Remember, very short term when it goes above that 95. So this is nice because, yeah, we have multiple levels. We see when we go above the 80, okay, all right, we're in an uptrend, bullish here, and then we'll go above the 90. Go above the 95, they're like, okay, now we're at the upper limit. In the same way down here at the bottom, we go below 40, we're in a stronger downtrend. Below the 20, very strong downtrend. Then we touch this 6 or 7, 6, 7, or even go below it for a little bit. Yeah, it's a pullback. Pullback is coming. Honestly, if you want to do a very safe way of trading, just wait till it comes down here and hits this 6, 7 range, or goes just below it. Yeah, a reversal will always be imminent, and more times than not, a pretty decent one. So let's just say we were using our RSI as well, and we see where it's crossing. Yeah, honestly, it's pretty spot on. See right here, we get a cross on the 6 and the 13, hard cross right here, and of course we get our RSI, or God, I gotta stop saying that. our stochastic, is crossing through our 20 here. Because when it's leaving 20, more times than not, she's heading on up. So, yep. And then really, we see it came down here on the stochastic right here on this candle. Bam. You entered on that candle. You said, "Hey, I'm staying in this baby until it, until at least goes to the 40 on the stochastic." Hey, you'd have been handsomely rewarded. Ideally, wait till you got a hard reversal on the stochastic, which you did not get. You didn't get a hard reversal on the stochastic to get out of there until really right here. We see the stochastic goes up, comes into above 80, and then it breaks below the 80, signifying a downtrend is starting. So, yeah, it's 303, yeah, so nice little $5 move there, so not bad. Not bad. So again, you can use something like a stochastic or a CCI. Let me see, on an hourly, a good stochastic would be 14. Oh man, look at me. Got to correct my overbought. There we go. 70. Let's make it bigger. So, yeah, this even gives us more confirmation as far as when exiting trades and when getting into them. Yeah, so the 1 hour, CCI 14 on the 1 hour, yeah, pretty decent, decent momentum indicator. Also, the 30 I like as well on an hourly. It's probably my preference, probably my favorite on the hourly is the 30. You get a little bit more, yeah, a little bit more. It lines up a little bit better with this particular strategy that we're doing here. So, yep, and it gets us in a little bit, gives us extra insight about as far as when to get in trades. So, let me see, prime example right here. We have the hard cross between the hard cross between the 13 and the 6 right here. Well, the CCI 30 told us to actually get in right here, so actually had us in the trade just before. Had us get out of the trade right here. And this is right about the same area the 6 and the 13 are crossing. Another example. Let's make this a little bit smaller here. There we go. Okay. And another hard cross. There we go. Another hard cross right there on the 6 and the 30. Stochastic actually had us get in right here. Yep. What was the difference there? 280. And then the cross was 282. Yeah, actually had us get in $2 earlier on the stochastic there. And then right in here, the CCI starts signaling. Be prepared to get out. And then it breaks. Then you get a decent little cross right there, and the CCI signaling to get out. So, again, this is just get you a little more insight. Yeah, gives you a little bit more clear picture, a little bit more faith in the direction. So, do not be afraid to use your stochastic or your CCI. They'll give you some nice, yeah, give you some extra added confirmation on your trades. So again, that's a nice little swing trading strategy that I wanted to share with you there. Hope you got some benefit out of it, and we'll see you in the next video. Welcome back to the Precision Indicator course. In this video, we're going to go over an intraday scalping strategy. Now, the idea behind this strategy is we're just looking to scalp 30, 50 cents, a dollar. If we can get more than that, great. But that's all we need to do. That's all we need. That's all the movement we need to make this strategy work. Why is that? Well, we're ideally you can do it on any stock, but I like to do it on the SPY. Why do I like to do it on the SPY? Because the SPY has 3 expirations per week: Monday, Wednesday, Friday, unless there's a holiday or something. Now, what that means is the contract prices are much cheaper, because we know on expiration day the contract prices are substantially cheaper. Take, for instance, an at the money or in the money contract on the SPY right now, which a little bit of an extra implied volatility right now, but still is going to run you around $150 per contract. So not bad. Whereas if you go $2 to $3 out of the money, you can be buying contracts for $50 to $80. Now, we're going to focus more on the $50 to $80 range, something with a around a $20 to $30 delta, or $25 to $35 delta. And why that? Why risk being $2 to $3 out of the money on the day of expiration? Well, the thing is, we're not staying in the trades long at all. So we don't have to worry about time decay. The fact of the matter is, if we're in a trade more than 10, 15 minutes, we've made a lot of money. Yep. Or really, probably more about, I'd say 20 to 30 minutes. If we're in a trade more than 20 or 30 minutes, we've made, needless to say, if we're still in that trade in 20 or 30 minutes, we've made a lot of money. A lot of money. So with that said, we're not worried about time decay. We're going to go $2 or $3 out, get that nice delta, like I said, $25 to $35 delta, and then we're going to buy multiple contracts. Ideally, we're going to buy 5 to 10 contracts. So just for nice round numbers, let's just say we bought 10 contracts. 10 contracts at a 30 delta. Now, what does that mean? Of course, for every dollar the stock goes up, we make $30. So in this situation, the stock goes up $1, we make $300. Now, is that going to happen every time? No. But the point is, having multiple contracts allows us to make money on the little move. Because take, for instance, let's just say it only moves 50 cents. We still make $150. That's still good money. Say it moves 25 cents. We still make $75. That's good money. Now, let's get into the strategy. The strategy is very simple. We're using, honestly, for this strategy, if need be, I could use just the 6 simple moving average. That's it. I could do this short scalp strategy with just the 6 MA. Don't need anything else. I could just do it with just that. Somebody gave me a brokerage account, a 6 MA, and a 2-minute time frame. I can make money. I can make really, really good money. Now, you might say, well, I don't have a 2-minute time frame. Well, you can do it on the 3. You can do it on the 3 as well. The 2, I've just learned that I like the 2 the best. So the thing to keep in mind is you need to be able to get in and out of trades at a pretty decent rate. But at the same time, you can spend 10, 15, 20, 30 minutes, an hour a day looking for a nice setup. And again, we don't need a crazy move. We don't need to spend a lot of time. You make, say, 2 or 3 trades a day. Say at worst, you make 50 to 75 bucks. You do 2 or 3 of these little scalps a day. That's a nice little profit. Nice little profit. So let's check it out here. So we're on the 2-minute time frame, and let's go back all the way back to the 29th. How many days would that be? Okay, so that'll be what, 3, 4. Okay, it'll be 4 or 5 days. I'm gonna give you 4 or 5 days worth of this strategy here. So that should be more than enough. And of course, I could go find just the perfect setups and all that, but no, I'm just gonna go to a day and work through it, because again, you can't pick the perfect setup. You don't know what you're gonna get during the day. It's just you got to work with what you get. So you see here, I got the CCI 30. I like to use it, or the stochastic 30, with again my 95, my 80, 40, 20, and 6 support lines. Tell you what, I'm going to go ahead and put that one up as well, so we can just glance at it as we go. All right, looks good there. All right, let's make this big. Oh, awesome! My line stayed on the page. That's what I'm talking about. So again, 95, 80, 40, 20, and 6, 7-ish. All right, good stuff. So starting on this day, 6/29. Now, this strategy is, strategy's pretty basic. It's quite simple. Start of the day is right here. We start the day way away from the 6. We know the 6. You're never going to get a stock or candle this far away from the 6 for very long. Sure enough, sucks it right back. All right, now, once we get to the 6, what are we looking for? Well, we're looking for some of the indicators we're looking for. Now, we have a downtrending. Remember, our 50 is our major. The 50 and the 30 are major buy and sell. But again, we're on such a small time frame that really the 50 is the big one in this situation. This is the primary. The 30, 30 is going to be good. But again, the 30 is more like, say, on a 5-minute. Now the 30 is more like the 20, 21. So, yeah, and whereas the 50 is more like the 30 on the 5 minutes because of the shortened time frame. So the start of the day here, what do I see? Okay, I see a downtrending 50 to start the day. That's a sign. Okay, so just based on that, I have a little bit of a bearish bias, a downtrend bias, because the 50 is sloping down. And let's see here. So sure enough, candles get sucked in, and now we get all of our candles nice and tight. I don't like that. Well, then why did I say you could just have the 6 MA and make the strategy work? Because what you're looking for is very simple. You're looking for a fully formed candle to come below the 6 MA and support off of it or resist off of it. Really that simple. And I tell you what, for clarity, I'm going to take all these other moving averages off. Tell you what, I'll leave the 50. Now, that makes it a little clearer. So we come down here, what happens? We get a candle that comes up, rejects, hits its head on the 6, and hits its head on the 50. That's an entry point. That's an entry point. And what do we get here? 300 down to, in this situation, we ended up coming down to 276. So about 30 cents. Start a day, please take that profit. Take that profit. Now, what ends up happening here is the start of the day. A few minutes in, you know how the stock tends to whip and go crazy at the first 10, 15, 30 minutes of the day. Well, crazy. Take for you stay in the trade. Oh yeah, everything's going good. Goes down 30 cents. So you bought 10 contracts with 30 delta. Yeah, at this point you're doing pretty good here. You're about $100 profit. Then bam, just blows up over the. But again, we know our debt 50 is downtrending, so we know that this is going against. It's going against the flow. And what does it do? And it jumps way away from the 6. What do we know when we see the stock jump way away from the 6? It's coming back. So it jumps up here and you're like, bam, jumps all the way up here. You're like, oh my God, I'm down big. Oh my goodness, this is horrible. Well, patience. Sure enough, comes back to the 6 and goes right back to where it was supposed to be. Ideally, it should have just went from here to here, but again, it's the start of the day, And again, I'm not trying to show you these, these ideal, perfect scenarios where everything works. I'm just trying to work through the situation here. So, what happens? Jumps up here. You could get scared, sell all your contracts, or you could be like, you know what? Hey, Brett told me when it gets way away from the 6, it's coming back. It's coming back. And sure enough, what does it do? Comes right back to the 6. And then when it goes, what happens here? Goes below the 6, below the 50, supports or uses it as overhead resistance. That's an entry point. Or hopefully you were still in this trade. But anyway, let's just say you entered right here, $3.32. And again, you're waiting for your next fully formed candle, mostly formed candle above the 6. Well, look at this. It ended up coming all the way down to 298. So what do we get there? Oh yeah, $1.50 move. $1.50 move. So what would that have been? $450. You buy 10 contracts right here, it's $450. Right is in your account profit right now. Now, again, we're looking at short-term scalping. We wouldn't be trying to rob the bank here. You get a nice move like this, please take some profit on those contracts. Please, I know if I got $450 sitting in my, profit right now, I'm taking some profit. Especially because again, what happened? Again, this candle came all the way down here. Look how far away from the 6 it was. That's a long distance from the bottom of this wick. That's where the candle was to right there. So when I see it getting that far away from the 6, I'm like, yeesh, I got to take some profits. So, okay, but let's just say worst case scenario, you took profits when you got a fully or mostly formed candle above the 6. When it jumps on top of the 6, signals a trend is changing. So from that point to around 299.50, from there, yeah, that's still an 80-cent move. I mean, yeah, you buy 10 contracts. You buy 10 contracts, that's still around $200 profit. But see the difference right there? 450 to 200 that quick. So again, it's you're dealing with a lot of leverage when you deal with these multiple contracts and the day of expiration. So yeah. So with that said, so it jumps on top here. All right, and then it jumps on. We have another candle, jumps on top, starts riding it up. Now, at this point, you could do one of two things. You can say, well, the 50 is still slightly downtrending. Maybe I'll see what it does based on that. Okay, you don't want to just jump in here willy-nilly, just be super risky. Be like, okay, all right, well, see what it does here. Well, what happens, for me, this is good enough. I know that I get really 1-2 candles above the 6. I like that entry. Again, quick scalps. Again, we're not hanging around in these trades. What was the time period here? What was this? 2, 4, 6, 8, 10, 12, 14. So 14, 16 minutes. 14 to 16 minutes in this trade. Not long. At the bottom of it, you could have made another thing that would have told me to get out, where I would have definitely took some profits here as well. What happens? It breaks down to 298. Remember I told you that 15 cents from 85 cents to the next dollar? Hard to break through. The stock likes to come back up. Sure enough, what does it go down to? 294, comes right back up. Comes right back up. And 2, we were way away from the 6. Situation like that, please take profit. You got $450 sitting in your account. Take some profit. Don't be greedy. Take some off of that position. And let's just say, hypothetically, you said, well, what if it would have just continued going down? Either way, it still was going to come back. The 6, say it was coming through here, it was still going to come back up and touch the 6, hit off of it and go. So in that situation, hey, you could have re-entered the trade or got some more contracts back. Say you sold them here, you could have bought some more back if you seen that the 6 continued down and then it went up to it. And so again, you don't want to mess around with the strategy. This is a get in, get out. Very simple. Is it above the 6 or below the 6? When it goes from below to above, you enter, or when it goes from above to below, you enter. Very simple. So, for me, this would have been, this would have been enough confirmation for me to enter. And 2, right here, I got between these 2 candles, got a nice little 3-bar play. Got a engulfing candle right here. You see right here, this little red one, and then this big green one here engulfs this candle. I mean, that's just an engulf of it. And then what happens here? Boom, this candle just engulfs this red candle. This green candle means the buyers are there, engulfs this one. So, and then, but let's just say worst case scenario, you're like, I don't know. I just want to, okay, well, let's just say it gets above the 50. You find support at the 50. Bam. Say you have a candle comes down, supports itself, and you're above the 50 or above the 6. Say, okay, entry there. So $3, and you're past that, that first 15 to 20 cents of the dollar. You're at $3.27. So you've got out of that. Like I said, the first 15 to 20 cents of a dollar is hard to push through a lot of times. Well, you push through that. You have no excuse not to be at this position right here. And the 6 is crossing through the 50. That's a good sign. Very good sign. And so we enter there, $3.27. And again, we're looking for our first fully or mostly formed candle below the 6 at this point. And we don't get that. If you wanted to say, well, this one was like half, 50% of the body right here. If you wanted to get out there or take some profit there, I understand. Even from there, that's 50 cents. Again, you got 10 contracts, 50 cents on a 30 delta, 10 contracts, 50 cents equals $150. There's no shame in taking some profit there. None at all. But you would have missed out on some goodies. And this is to where where it is nice to have, where I do like to have, I know I took it off, but I need it back. This is where it's nice to have that 13 back. Why? Because what happens here? We show that we got 13 not also crossed through the 50. Now it's also going to act as support. So let's just say right here, like, I want to get out. It's like, okay, so sell half your so you had 10 contracts, you sell half the contracts, take your $150 profit right there, and then you're up on the trade, and then you're a little bit more patient, a little bit less stress. Well, sure enough, what comes down here supports off the 13, and then bam, we don't get another fully formed. What happens here? The 6. What happens? The 6 and the 13. Nice and tight here. Candle comes about 50%. Nope, we're still in the trade. And then what happens? We get a candle right here below the 6. We say that could be an exit point. Totally understand that. But again, the 13's right here, and it's still uptrending for me, and the 50's still uptrending. For me, it's like, but again, it's run up nicely here. You entered the trade at $3.25. At this point, you're at $2.70. All right, let me do some math here. So you got, let's just say you only have 5 contracts. You sold 5 of them here. You still have 5 contracts. 5 contracts, and yeah, you've just went up a good $2 around $2.50. $2.50. That's some good money. Yeah. You only have 5 contracts at 5 contracts out of 30 delta, so $150. So you went up $2. That's 3. 300 plus another 75. So you're at 375 just from this point in the trade. That doesn't count the 150 that you took off right here. You get that? So from that, 475, yeah, that's nice. Yeah, that's over $400, over $400 worth of profit. Yep, around 450, somewhere in there. So that's not bad at all. You'll take that, man. Take that right there and just leave for the day. Don't even worry about trading anymore. You get that kind of move. You get that kind of move to start your day. Yeah, go on about your business. Enjoy your life. Have fun. You just made you a quick buck. And that didn't include the one, you were in this trade over here. Remember we did pretty well on this one as well. Remember this one went down to all the way down to 2. Yeah. Nice little profit we could have had over here as well. A little dollar, what was it? Around $1.50 right here, $1.50 worth. Easily could have had a good $300 worth of profit on this side, and then you make around 450. I mean, what is that? How many minutes? 2, 4, 6, 8, 10, 12, 14, 20, 4, 6, 8, 10, 30 minutes. 2, 4, 6, 8, 10, 40, 2, 4, 6, 8, 10, 50 minutes. 8, 10, an hour. 2, 4, 6, 8, 10. So you're around an hour and 20 minutes at this point, and an hour and 20 minutes, and you could very easily have, at a minimum, should have around $600 profit, up to around $750. Just depends on where you got out or might have took some profits. But again, imagine this position right here. Imagine if you'd have kept the whole position, all 10 contracts here. Yeah, you're talking about, let me see, from this point, 320, what did we get out here? So $2.50, $2.50, 10 contracts, $300 per dollar, $300 per dollar moved. Yeah, $750 just right there. Yeah, right at around $750 just in that if you'd kept these all 10 contracts, and then plus this 400-ish here, you could very well easily been over $1,000. Easily been over $1,000 for 1 hour, for just 1 hour worth of plays. So I'd say that's pretty good. $1,000 an hour. Ain't too many professions that you can make $1,000 an hour. So let's continue here. Man, I don't know if we're gonna make it through all these days. But anyway, we're at 23 minutes in. I'm gonna beat a dead cat here. But anyway, you'll see as we continue here. So what happens? So let's say you out there, you're out right there, and then what happens? You still got your uptrending 13, you're uptrending 50. So you're still a little uptrend biased. But then what happens? You finally, but at the same time, hey, you jump below the 6 and the 13 right here. Man, you want to enter this trade? Hey, more power to you. Because again, look at the 6. The 6 is rounding out, we're starting a nice little downtrend on the 6. So if you get in here, I totally understand. Say you got in here at 302, because again, it's now if I was looking more for long term, if I was going to be in this trade 30 minutes, an hour, multiple hours, would I get in a short position right here? No, this is dumb. You got an uptrending 50. Why in the world? I'm not going to fight this uptrending 50. It's not worth it, especially when it's this close to it. I'm not going to do that. Now, if it was, way away from the 50, then it's like, okay, all right, well, it needs to come back to the 50. Because as you look here, it always wants to revert back to the 50. So, just this little position right here, let's just say we entered right here. And also, too, you got a cross. You got a cross on the 13. remember from our swing trade video, get a cross on the 13 and the 6 right here. So you want to enter this trade right here? More power to you, brother. So 302, right around 302.50, 302.60, somewhere there. Anyway, so again, you're waiting for the first fully formed candle above the 6, or mostly formed candle. So from there, it's 302.60. Look at this. Come all the way down to 302.07 at our lowest point. So a nice little 50, around a 50% or 50-cent move there. Again, you got 10 contracts. 10 contracts at a 30 average 30 delta. Okay, 50-cent move. That's $150 right there. 150 bucks right there. Please, don't keep fighting, because again, you coming. You got this uptrending 50 right here. So again, it turns. You get your first fully formed candle above there at 330. So let's just say, for all intents and purposes, you exited right there. So 302.60, and you exited right here. You get a candle jump on top of the 6. So 30 cents. 30 cents. Yeah. So you're about $80 to $90 right there. Quick low profit. Bam. Okay, take it. All right, but now you jump on top of the 6, and then you got the 30. Well, you say, well, man, the 13's right here and it's downtrending. I want to see what it does in relation with that. Okay, I totally understand that. Well, what happens? Jumps on top of the 13, and let's just say, for all intents and purposes, you say, well, you know what? I want to wait till the 6 and the 13 cross. Okay, but here, I mean, it jumps on top of the 13, sits on it, and it's above the 6. For me, that's a great entry point. But let's just say you're being super cautious. Here's the cross. You see the cross? Okay, wait. You're in at that point, 302.60, and then you're looking for your first fully or mostly formed candle. So from 302.60, you end up going all the way to 303.38. 303.38. So a nice little 70-cent move. Yeah, you got 10 contracts. 10 contracts, you're 240-ish dollars profit right here at this point up here. So again, don't be shy to take profits, especially in this situation where what happens? You see here, the stock starts leveling off. You get this one right here. You get 2 candles. See right here, 2 candles come up here and wick off of it. And this is another point too, where drawing support and resistance lines is important. See, start of this day, what happens? It goes up here, rejects off of that, and sure enough, comes back up here, rejects at the same point. So for me, I see that. I see it come up here and it rejects once, twice. I'm taking some profit. I don't need to see it go below the 6. I got 2 rejections, hard rejections, 50% retracements. Goes from the top right here, retraces all the way down 50% of the body. I don't need it to go below the 6 to tell me, hey, take some profit here or get out of the position completely. So in this situation, let's just say, hopefully you took some profits right there. But say if you didn't, like, I just, one of those days where you just brain wasn't working too fast. Say, well, I'm just waiting right here. Okay, well, it comes down, pushes through the 30. About 60% of the body goes through there. And you say, well, the 13's right here. I want to stick with it. All right, I understand. 13's up trending. Comes up here, comes up, hits its head on the 6, and then bam, jumps back above the 6. All right, man, you're in business here. That's pretty good. And then bam, what happens here? You get a cross on the 6 and the 13 right here. Please tell me that you're out of this trade at this point. 302.70. So from 302.70, so we got in around let's say 350. 350 out at 303.05. 303.05. So 50 cents. 10 contracts. It's 150 bucks. I don't know if you do this. Y'all do this little strategy. You're gonna send me. Tell you what. Considering how cheap this course is, yeah, y'all should send me a nice little send me a gift to thank me for this one. Because if you do this strategy, you're gonna make some money. You're gonna make some money. And let's just say he's even wrong. I mean, really, at this point, just doing this strategy today, there was no situation where we were just, where it just, the strategy didn't work. So far, as long as you're, entering entering below the 6 or when it jumps on top of the 6, so far, you're making money. I mean, you've done great. The only situation where it was right at the start of the day where you get crazy jumps and jerks back and forth was right here. You went below the 6 and then bam, you jump way up here. If you were a crazy man and jumped out at that point, which you already seen that it went up here and got rejected at that candle right there, and then what happens? It comes up here, rejected right there. So even if it jumps on, this crazy just whip, this is one of those ones they call rip your face off, just jumps back against you. Again, you see what happens. Comes up here. You see this trend line where it just got rejected, or this resistance line. And then sure enough, what happens? The body comes up to it, touches it, and rejects back down. So, but again, let's just say you jumped out right there and you lost some money. Well, you know what? You've already made it up and then some so far. So, look how much money you made. It ain't even 12 o'clock yet. So again, you got out there. You get a cross on the 13 and the 6. Really, they're kissing each other. And it's making its way down here. Hey, if you want to enter right there, more power to you. In this situation, what I'm looking for is I got an uptrend in 50. I know that I just went below my 6 and my 6 and my 13. Hey, I'm okay to enter this trade. Now, would I enter it for, if this was for long? No. But again, for 2, 4, 6, 8, 10 for 10 minutes, I'll enter this trade. Because again, what do we got here? 302 or 303. We'll say right at 303. And then what I'm seeing here, what I have in my mind is, what I'm guessing at this point is it's going to get to the 50 and it's going to reject off of it. I got an uptrend in 50. That's what's in my mind. That's what I see is going to happen. And sure enough, when I see that candle come and hit this 50 and start backing off of it, I'm out of the trade. Very simple. So from there it was 303 and the 50 line was 302.64. So a 40 around a 30 to 40 cent move on 10 contracts. Yeah, you're around $115 just on that little 8-minute move. So not too bad, eh? Not too bad. Now at this point, you start riding the 50. You have this big candle that jumps up here above those. It's these moving averages are so tight. The 6 and the 13 are tight. They're really tight to the 50s right here with them. I don't want to enter anything there. That's just too much congestion for me. Too much signal of sideways, and I don't like that. I want to wait till I get some more clear direction. Well, what do we have here? Bam. This candle right here. This candle right here jumps on top of the 6, on top of the 13, uses it as support. So really, once I see this candle come down, hits off the 13, comes up here. I don't need to necessarily let it run all the way up here. I don't need that. I don't have to have that to say that it. Once I see that, again, I'm above an uptrending 50. I support on the 13. I set on the 6. That's strong. Now, the one thing I will say is you are at a support and resistance line here. So that would make me a little cautious. I would have that in the back of my mind. But at the end of the day, I would be okay at entering here. But let's just say worst case, I was like, I was sitting on my hands. I'm like, I don't want to. Okay. Well, it runs up here, jumps above this, breaks through this support, daily support resistance line, comes down, supports off of it, and then goes back up, finishes the candle here. But again, look how it's gotten away from the 6. Look at this distance between the 6. That's a pretty good little distance on a 2-minute time frame. If you're like, I want to see it come back to the 6. I understand. So in that case, you let it come back to the 6. And then what does it do? It starts riding up it. And yeah, at that point, you got it's sitting on this support and resistance line. Supported off of it, jumps on top of the 6. Man, this is a decent little entry point. 303.50. And ends up going all the way up to 303.81. But let's just say worst case scenario, you get here when your candle comes below that 303.68. So 10 cents. Not much there. Not much there. And then what do we have? We have our 6 and our 13 converging on each other. They're riding beside each other. That's signaling sideways movements. Oh, I'm sorry, I forgot all about it. These will tell you you don't even need an indicator down here. But let's just say we wanted to use our indicator to give us some more insight. Again, remember, whenever you're between the 80 and the 95, that is sideways or a slight uptrend or a good uptrend. Okay, so what happens? We come up in here. That's what we're doing. All this sideways movements is in between the 80 and the 95. And that's what it's doing. Now, what do we have here? We finally have a break below the 80. Our fast and our slow average breaks below the 80 right here. What do we look like on the chart? Is that a good entry point? What does it look like? If I could get this to come back down, that would be so good. Yeah, that was signaling with a big candle there. Comes down, sits on this support and resistance line for the day. At that point, yep, got to see what it does. 50's right here. 50's uptrending. Slightly uptrending. Well, what happened? Well, let's see what happens here. So it comes down, sits on the 50. Sits on the 50. Finally breaks above the 50. Or breaks off the 50. The 6. Ooh, the 6 MA. Look at it. Sits right here on the 50. Because if that 6 would have crossed the 50, yeah, we're getting bullish or bearish in that situation. But anyway, comes up here, rides off of it, bounces off of it. Hey, to be honest with you, that's a decent little entry point right there. Decent little entry point. So let's just say 303.40. All right, so from there, you're waiting for your next fully formed or mostly formed candle to be below the 6. And then you get one right here. But again, it's sitting right on the 30. You got look at all this support you got here. At this point right here, you got this intraday support and resistance level as support. You got the 50 as support. You got the 13 as support. You shouldn't be very scared at this point. This is not a scary moment right here. This is a lot of support. And if you would have stuck in this trade, you would have been rewarded. And look what happens. Bam, blast off. Well, for scalping purposes, this is a blast off. On the big scale, you're blasting off 40 cents. So, yeah. But for our scalping purposes, a 40-cent move, well, really, we're in the trade. Yeah, we're in the trade back, where did we get in? We had a cross. Tell you what, for all intents and purposes, we had a cross right here on the 6 and the 13, and we're above the 50, and we're supporting off of it. So let's say worst case scenario, we entered around here, 303.40, or I'll tell you what, this one, get this nice supported candle right here. This is a lot of support. 303.40, and then we're in. Man, look at that. 303.40, 70-cent move right there. Yeah, that's just over 10. We had 10 contracts at this point, right? Well, again, for me, I see a run up real quick like this, and what does it do? It runs just over the next dollar, 304.02. Man, I gotta take some profit there, because again, I know when it breaking through that first 15 cents of a dollar is tough. And more times than not, it wants to do it, and it's gonna come back, and then it'll try to push through it again. So for me, I got to take some profits there. And why else do I got to take profits? Look how far away I am from the 6. Long ways away. Anytime we get this far away from the 6, it's coming back. It's coming back. So, needless to say, I would have took some profits there. If not, took my whole position off, just waiting for it to come back to the 6, and then see how it reacts with the 6, and then go from there. So, or at least sold most of my positions. Say out of 10 positions, 6 to 8 positions, and kept 1 or 2. And then, but of course, once I seen it come over here, tractor beam right to the 6, and then come under it right there, I'm out big time. I am for sure out. And then from that point, I'm looking to get in another trade, because look what I got here. 2 candles. I got 2 candles underneath the 6. Yeah, that's good entry. Yeah, let's say here you got in at the bottom of the candle, 303.78. Waiting for your next fully formed, mostly formed candle. But again, I know the 50 is right here, so I don't expect it to bust through it. My first expectation is going to hit off the 50 and then come back up. And if you would have had that mindset, you would have been right. So 303.80 down to 303.58 or 303.60. So 20-cent move there. Yeah, $60. $60 off 10 contracts. But let's say you sold half your position there. And then from there, you're like, okay, all right, well, I'm still under the 6, even though it bounced off the 50. It comes up here, rejects off the 13. And then the next candle rejects off the 13. But again, we got a nice downtrending 6, and it's on a collision course to cross through the 50. That's a good sign. Okay, very good sign of a downtrend. So, let's say you stayed in the trade. Bam, crosses through the 50. That's a beautiful, beautiful sign. Now, we got our support and resistance line. Comes back down to that. Sure enough, hits on it, hits on it, hits on it. Yeah. I see 2 or 3 candles hitting off of a support and resistance line like this. Yeah, hard not to take profits. And to look out for a pretty decent ways away from the 6 right here. So from that point, say you entered again. Remember, so you entered at the bottom of this candle. 303.80 comes up, supports on this. I'm out. That's pretty strong conviction to see it bounce all 3 candles. So yeah, from that point we're around 50 cents. 50 cents on 10 contracts at a 30 delta. You do the math. Oh, making all this money making me tired. 50 cents. 50 cents, that's 200 nope, 150. $150. $150. And then of course, worst case scenario, you're out here. Jumps above the 6. Fully formed candle above the 6. Yep, I'm out at that point. But at the same time, am I getting into, no, what do I have now? Now I have an overhead 50. I have a downtrending 13. So this 6 right here, uptrending. No, I don't have a lot of faith in it. I'm not going to fight the trend, fight the flow. Again, the 50's flattening out, getting ready to change direction. Because again, look how it's been going up all morning. Man, it's time for that baby to. So again, we got a slight downtrend here. Very hard downtrending 13. So I'm not getting, just because it jumps above this 6 right here. I'm not getting into this trade. Nope. I gotta see it at a minimum, cross, make a hard cross through this 13. And it does not. What happens? It goes up to it, kisses the 13. Oh, I love you, but I don't like you that much. Breaks away from it. 13's downtrending nicer now. The 50, 13 still downtrending hard, and then bam, we start getting some nice movement here. Candles jump below, really right here when you see this. When it jumps below all of these, 50, 13, and 6, right there. Oh yeah, that's a great entry point right there. 303.34, and man, look at that, it goes all the way down. Yeah, a quick little 30-cent drop. But the thing is, it dropped too fast. Why did I say that? Look how far away from the 6 it is. I see that. I see it come down here really fast, and then it starts drawing back, taking some profit. taking some profit. Sure enough, next candle comes up here, comes down, draws back. What's it doing? Tractor beaming right over to the 6, like clockwork. Now let's say you stayed in some of the position, waiting for to get a candle, mostly form candle above the 6. Finally get one right there, 303.18. So even from there, that's yeah, still a 30-cent move. Not too bad. But again, this point, what happens? It comes up. You still got a downtrending 13, downtrending 50. So again, just because this, the candles start jumping on this 6 right here. Yeah, you can say, oh, I'm going to jump in that. But for me, this is a tough one to jump into. Yeah, it's a tough one to jump into, to be honest with you. Because again, I got all this overhead support. But if you did, you would have been rewarded. 2, 4, 6, 6, 8-minute trade. What do you got here? 303.20. So gun ran all the way up to 303.50. 30 cents. Nothing crazy. But anyway, so what happens? It rejects off of this 50. Rejects here. 2 candle rejection. And then a drop down here. Let's see here. You got a downtrending 50. Downtrending 13. And then you get the start of this candle. And then it breaks below resistance. Yeah. Very, very strong likelihood that this stock is going to continue down. And sure enough, it does. Nice little candle. But let's just say, for all intents and purposes, you didn't enter until it went below the 13 and the 6. So that's right around 303.20. You got in there. But then, look at it. It runs. Oh, man, it's doing great. All the way down to 302.70. Yeah, that's a nice 50-cent move. But again, look how far you got away from the 6. You got to know it's going to moonwalk its way back over to it. So you did get in here. Got to take some profit. Got to take some profits when you get that far away. Just got to. Tractor beams over. Bam. Rejects off the 13. Again, remember, downtrending. We're below our major support resistance for the day. We're downtrending 50. Downtrending 13. We reject off the 13. Bam. Now we get under the 6. That's an entry. That's an entry. 302.80. 302.85. And you can say, well, man, it drops really hard, really quick, 40 cents, a really quick 40 cents. You want to take some profit there? Totally understand. Look how far you are away from the 6. That's good distance. So if you take profit there, I totally understand. But at the same time, I'm very confident in this downtrend because I got a downtrend in 50, hard downtrend in 50, hard downtrend in 13, hard downtrend in 6. So I'm not taking all my positions off for sure. Maybe half. Then what happens? Comes here, rejects off the 6, and we get some more. Ends up going all the way down. Yeah, all the way down to 30. Yeah, so that's nice. Very nice. Yeah, dollar move. So 10 contracts, 30 delta. That's $300. That's $300 worth of move there. Just 2, 4, 6, 8, 10, 12, 14, 16, 18, 20, 24, 26. So 26 to 28 minutes, $300 move. Pretty good. But let's just say you didn't take profits there. Well, surely you would have taken it when you got jumped up above here and had a candle sit on top of it. 302.40. Still made some nice profit there. Now, what do we see here? Well, you can say, well, jumped on top of the 6. I'm entering, but to say, well, I still got this downtrending 13, slightly downtrend, about to flatten out. I'm going to hold off. Okay, I understand. But then you get a cross. You get a hard cross on the 13 and the 6. Hey, that's an entry point there. 303.64. And again, I see the 50 coming up. I'm already getting ready for some rejection here. I ain't gonna lie. Yeah. I'm not going to lie, but sure enough, it gets right here. It blows through that 50. Where's it going? Going right back to that doggone support and resistance line, like a tractor beam. Ugh. So I see it get to that point right there. Set on it. Next candle sets on it. I'm taking some profit. More than likely, she's going to get rejected. You got 2 candles worth of rejection, and sure enough, she got rejected. Yep. What else was signaling that? We still got a downtrend in 50. So right here, we're fighting through a downtrend in 50 and going to fight through this major support and resistance of the day. That's tough. That's not likely. The percentage is not there. But anyway, needless to say, we jumped in here at the cross, 302.60. And we got up here, we see 2, 3 candle. I mean, come on, third one, please. I mean, hopefully by then. So 303, yeah, so 40, 70 cents. Yeah, 10 contracts, $200. Now from that point, we reject. And then you say, well, I'm going to wait for it to go below the 6. Once I see it start forming below the 6, you can say, well, that's an entry point for me. Well, keep in mind, you do have an uptrending 13 now. So, and then your 50 starting to flatten out. So for at this point, it's kind of a sideways deal. It's kind of a side. I don't like that. I don't like that. It's too much going on in here. 50, 613, all bundled up here. I don't like that. I need to see a little bit more separation. And then also too, what I grant you my. Okay, let me try to predict this. This would be sideways movement on the stochastic between 40 and 80. Ha! Should have known it. Look at that. Between 40 and 80. So there's 40, there's 80. Sure enough, look at that. Man, that's pretty spot on there. Almost dead center. Dead center. 60. Right around 60. So I don't want that. I don't want that. I don't want to mess with that. Nope, I don't want that. What I want, we see you come here and we get a nice little split on the stochastic right here. Look at that. Look at that gap between them. And then bam, look at this. They go above the 80. That's a good entry point there. And then what does that also look like on our map here? Oh yeah, look at that. Jumps on top of the 6, jumps on top of the 13 and the 50. Bam. And then pops through there. Let's just say worst case scenario, you're like, oh, I'm waiting to find support on that support and resistance line. Okay, all right, that's fine. Whatever. Okay, so that would have been right here. 303.42. Oh man, look at this beautiful ride. Blast off. Start getting a little distance between the 6 right here. That's always a little scary. Or even right here. That one's right there. I ain't gonna lie, that's hard for me not to take profit right there. Yeah, that's a good little distance between the 6. And sure enough, what did it do? Moonwalked over to it and then continued up. So for me, yeah, don't be mad if I had to take some profit there. 304.44. 304.44. Yeah, dollar. Dang, look at that. That was a dollar move on that one candle. Yeah, I got to take some profit there. I got 10 contracts, $300 profit. I got to take some profit there. At least a couple hundred, or half of it. But again, you know, I've been kicking myself taking profit there because what happens, like, oh man, it comes down here, supports, and hits back up. So, could have been a monster move there. So really, first candle that comes under and supports itself, 304.90. Oh yeah, that's a nice $1.50 move right there. Yep, that's $450 potential if you'd held on to all 10 contracts right there. Yep. So, guys, we're hitting on an hour here. I don't necessarily think I need to continue to beat a dead horse. Again, we see that. Look at this, all this money that would have been made. Oh God, look at that move. That's a monster. And look how tight the 13 and the 6 are. You're waiting for. In this situation, I'm waiting for a fully formed candle below the 13, or a cross. Ideally, also to a cross between them. And man, you could have had. Let's say you got in worst case scenario right here. Right around 305.15. Man, look at this. Right there. Oh god, that's almost crazy. 303.15 to right around 307. Yeah, 307. Almost a $4 move right there. So let's see, a $4 move on a 10 contracts. Let's just say hypothetically here, 10 contracts. So you got everything out of it. Yeah, for $4, $1,200. $1,200 off 10 contracts in this move right here. This $4 move. Yep. That's good money. Again, you don't get a cross. You don't get it. Again, you could say, well, I'm waiting for it to. Well, it went below the 13 and the 13 and the 6 right here. Yeah, it did. It did. I will give you that. But the thing is, the 6 and the 13 were just kissing each other. They didn't cross. No hard cross. So if you want to sell half your position right there, that's fine. Do you sell all your position? No, not a good idea. Because again, you didn't get a hard cross. Where do you get a hard cross? Your first hard cross, right here. Nice X right there. Enter right there. Or exit right there at a minimum. Or worse. At worse. But again, you got an uptrend in 50 here, so it ain't like I'd be scared to death that it's about to fall through the floor. So anyway, battery's about to go dead on this video. 1 hour in. Yeah, please just play around with this. It's a beautiful strategy. Yeah, it's a moneymaker. Nice moneymaker. If you don't want to mess with the swing trades, the credit spreads, all this other junk, man, just get in here, do this little scalp strategy, make your money, go on about your business. Let all the other people take the risk. Because again, this for me is probably the least risky in day trading strategy you can get. I mean, it really is. And again, what allows it to be so profitable, and again, we're just on the spot. It ain't like this some big moving stock. But what allows it to be so profitable? Well, again, we have 3 expiration days. And what does that mean? The contracts are dirt cheap. We can spend $50 to $80 depending on the time of the day to get a $25 to $35 delta. So again, you say it worse, you pay $80 for a $30 delta. 10 contracts going to cost you $800. Yes, $800 going to cost you $800, but you can make a lot of money off that $800. Again, here we're just in this day right here. I mean, we had several trades where, yeah, we were where we were, yeah, where we did a good 50 to 100% return, 100 to 150% return within 10, 15, 20, 30 minutes. So I don't know. I mean, it's hard to beat this strategy, guys. It really is. It really is. It very well. It probably is the top of my list. Yeah. It's an awesome strategy to say the least. So, hope you enjoyed that. Hope you get to make a lot of money with this strategy. And if the little bit that I seemed like too much to pay for the course or more than you wanted to pay, well, just this scalping strategy right here will more than compensate you for little premium, and then all the future profit that you can make. So again, this is Brett with the Precision Indicator course. Thank you for your time, and go make some money. Welcome back to the Precision Indicator course. In this part, we're going to cover a very unique indicator. It's not something that you have to be keeping an eye on at all times, but it is a great reference indicator, especially to people that are trading options in the market. And it's very, very important, especially whenever you're trading, swing trading, holding trades, option trades for more than a day at a time. Yeah, you definitely want to know. You definitely want to know where you are in regards to this indicator, and of course, it has benefits for long-term investors as well. So, what is the indicator? Let's go ahead and get it up here on the board. It is the volatility indicator. So just whatever your standard volatility indicator is, ideally you want it to be able to show more importantly, an implied volatility. And the historical is fine as well. If that's all you got, that's, yeah, that'll do. But ideally, for option traders, anybody that's in the option market, you want to know what this implied volatility is. Why? Because implied volatility dictates how much contracts get inflated or deflated. So let's get that up on the board here. And let's get it. We can possibly get it raised up here without trying to draw a line. All right, there it is. Now, as you can see here, as usual, in the S&P 500 ETF for the SPY ETF. So, as you can see here was our monster drop back at the beginning of 2020, March 2020. Now, you can see here, I'm going to zoom in a little bit more so we can get a better idea of what we're looking at. As the market started dropping, the implied volatility started going up. So you see the correlation there? Now, when implied volatility starts shooting through the roof, question, do you want to be buying calls and puts in the market, in the option market? Or do you want to be selling calls and puts or spread contracts that take advantage of that? Well, take for instance, I'll give you a prime example. Say right here, the market peaked, implied volatility peaked right here. Now, let's say this person bought a call or bought a put. He bought a put at 241. He's thinking, man, this market's going down more. I'm about to make me some money. Well, he was right. The market did continue to go down. But the thing was, the implied volatility had already hit its max. And what happened was the implied volatility started going down. So contracts started losing their value. So even though he was right, he was going in the right direction, he had it pegged right, the market had already started nosediving as far as volatility. So in essence, instead of making a big payday on getting on the market here, he didn't make much. He didn't make much at all. Might even lost a little bit. And why? Well, again, because of implied volatility. Now, another scenario. At here at 240, implied volatility is maxed out. Say this person sold a put. Okay. Now, put, when you sell a put, it's a bullish, position. Okay. You think the market's going to go back up. Now, what happens was these, at this 240 right here, contracts were just so inflated. I mean, they were just like a balloon ready to pop. They were just so juiced up with premium. Well, so this person sells the put, and the market actually goes against him. But the reality of it is, the market started decaying, and so did his contract, which decay when you sell an option. When you sell an option, decay works in your favor. You're collecting. That's free money. So in essence, this person right here, even though it was going against him, he was still right around break even. And then, of course, once it started coming back up here, then yeah, and that's where the big money was made. Not only was the market going in the direction, the bullish position that he expected, but the implied volatility was continuing to just decay. So this right here, when the market was at 240, was literally the easiest money to be made in all the market. Truly was. Now, you want to keep an eye on implied volatility whenever you're entering a position, especially, again, if it's going to be a position that's, days, weeks, months long, especially in options. Because the idea is you want to be buying contracts. The best time to buy contracts, buy a call, buy a put, is when that implied volatility is nice and low. That's when you want to buy it. But of course, once it starts spiking, that's when you want to be focused more on being a seller. And you can see here, when the market is going up, implied volatility creeps down. Okay, so as the market creeps up, bullish, the implied volatility creeps down. But what happens when that market drops hard? Prime example right here. Bam, poof, big drop. What happens? You get that big drop, implied volatility shoots up. So even if the market is shooting up like crazy, implied volatility is still decreasing. So you want to get implied volatility to spike. Well, you need a drop. Now it will, if the market's just blindly just going up day after day, yes, your implied volatility will creep up, but you won't get your hard spike until you get that drop. That's that short, quick drop. Faster the drop, the higher the spike. So that's implied volatility, guys. Again, very valuable to anyone in the options market. I mean, I've been there, done that. I was buying. Once upon a time, I was out there buying calls and buying puts, and didn't even realize that the implied volatility was at its highest. And it's like this. Looking back, I'm like, golly, I can't believe I was buying options at that time, when the easy money was to simply sell options, or do call or put spreads. So, well, with that'll do it for this part on the precision indicator course. I hope you got some benefit from that.